Ones from London, Paris, Singapore, Saudi Arabia, Nigeria, and Ghana. This is the first conference we've had since COVID, and as Banking Commission of Kenya, we are very delighted with the turnout that we've seen today. I would like to give a brief introduction to ICC for those who joined us for the first time. The International Chamber of Commerce is the world's largest business organization, representing 45 million companies from all sectors and company sizes in over 130 countries. It's the only business organization with the UN observer status, which is quite high. For ICC Kenya, this was launched in June 2017 and was formally registered in August 2019 as the National Committee of the ICC in Kenya. ICC Kenya's membership is made up of business associations and corporate organizations of all sizes from all sectors of the economy. The main objective of ICC Kenya is to work closely with the ICC on policy advocacy on behalf of Kenyan business communities with international operations, as well as linking members to the global business community, thereby exposing them to an array of opportunities. And I think we've seen that pretty well happening. It is currently hosted by KEPSA. This is the Kenya Private Sector Alliance. We've been their babies since we were formed, and I think they've really taken good care of us. The ICC advances its work through 11 commissions, but in Kenya, we've only established 2. That is the Arbitration and ADR. You'll also be seeing them speak today, and Finance and Banking Commission. We are currently in the process of establishing 3 other commissions. That is the Corporate Responsibility and Anti-Corruption. The other one is Trade and Investment Policy. And the third one is Digital Economy. Those are the immediate ones that we'll be looking at. And we encourage most of you to join. And I've talked to a few people in the room that I know from the industry. And for you to join, you can visit us in our website. That is www.icckenya.co.ke. And you can download the form. Or you can get in touch with Leod at leodmaniki@icckenya.co.ke. And maybe, Leod, you could stand up for people to see you. You can wave to everybody in the room. Thank you. And I hope at least by the time we finish, I think the commitments I've gotten so far from the few people I've talked to, I probably have 3 applications. That is me doing my sales. Today's program is going to be officially opened by our chair of ICC Kenya, a man who doesn't need a lot of introduction. Engineer, sorry, I forgot to add that word, it's very critical. He is also the chairman of Kenya Private Sector Alliance Foundation. He has extensive experience serving in diverse boards. He is a mechanical engineer by profession with vast experience in oil and energy industry. He is well accomplished with over 35 years experience working in senior management positions in private sector, including Shell, where he served as the Managing Director and Country Chairman for Kenya Shell Limited and Shell Tanzania. He is a former Chairman of Board of Kenya Private Sector Alliance and currently serves as a trustee. He serves on the boards of various NSE-listed companies as well as public and non-profit institutions in Kenya, and is currently the Managing Consultant with Eduardo and Associates. He is a Fellow of the African Leadership Initiative, East Africa, and a member of the Aspen Global Leadership Network. Let's give him a hand as he comes to give us the opening remarks for the forum. Welcome, Engineer.
Thank you very much for that introduction. And for those online and those in the room, welcome, and thank you for making the time to come and join us in this second commission that is being formed in Kenya. You've been given a brief history of the ICC in Kenya, so I won't go into that bit. I'll just go into the core issues for today. So today we're talking about the nexus between global rules and access to finance. So before I open, I'd like to recognize the presence of Andrew Kigira, who is a Vice President of the International Chamber of Commerce Banking Commission. And that is obviously one of the opportunities that we would normally have for people. If you get involved in the commissions, you can go up into those kind of places. I mean, I formed the ICC Kenya, and I'm now on the board of the ICC International. So as we form the commissions, it gives you the opportunity to serve at international level and get recognized in that area. I'd also like to recognize the ICC Banking Commission Steering Committee leaders here, Ken Miriti, Mary Mulili, and all the others who are present. And also just to also recognize my fellow director at the ICC Kenya committee, Sam Deritu, please, if you could stand up and be recognized. I know he's very busy, and he just created time to come here and support me. And all of you guests who are here today, it's my pleasure to welcome you to this banking conference. And allow me to start by thanking all our partners this year, the ICC Academy, the Kenya Bankers Association, who you may have received information about this conference from, UBA Bank Kenya, Spire Bank, and NCBA Bank, whose support has made this conference possible. I would also like to recognize the ICC Banking Kenya Committee, led by Kenneth Miriti and Mary Mulili here, and the ICC Kenya Secretariat, Pascaline and team, for the many hours that they put to make this event possible. Most important, this conference would not have happened without the participation of all of you, both physically and digitally. And the different sessions and panelists from Kenya and around the world, for whom we are grateful. We will have people joining us digitally to impart the knowledge about the Banking Commission activities. Thank you all for taking time to come in and participate, and I believe that the outcome of this will actually be an inspiration to you, not only to your profession, but also to join this conference. The conference serves as an opportunity for those of you in the trade, finance and banking value chain to meet and share and talk about ideas on sustainable trade finance, access to trade finance for SMEs, the role of the ICC Academy, which allows you to talk a lot about those items in empowering professionals in these sectors. And then there is also the big thing in the world now, which is digitalization of trade finance, the global rules which keep changing, and SWIFT, among other banking and financing issues in Africa. I think the key thing about being a member of this commission is that we know what happens in our environment. And by being a member of the commission, you actually are able to articulate the issues that affect us in our environment at the international level, so that the rules that are created are not created by people who are used to their own jurisdiction and do not fully give consideration to the jurisdictions where we sit in. And that really is the opportunity that being a member of this commission will give you. I've been a chair in one of the banks for many years, and I also sit on the executive board of the International Chamber of Commerce. And the conversations around what is happening here and what is happening globally is very important, and that has really helped me personally in actually discharging those duties. These discussions spur us into deeper engagement and contribution at the global level. I mean, there are many banks in Kenya and across the continent, and some of which you actually represent, which have come from other parts of the continent. And we really need to be part of global rulemaking within the trade facilitation area as banks and financial institutions here. So let's take advantage of this commission and make sure that we actively participate in the global area. So as the ICC, our objective, the Kenya Committee, our objective is really to strengthen all the commissions that we have. We've had a couple of sessions like this with the ADR and Arbitration Commission, and now we are starting with the Banking Commission and the others you've been told about, which will be coming in the future. So there's a lot of activities, both on a personal level and the company level and with some of your stakeholders that you could benefit from by being a member of ICC Kenya. So, somebody is talking somewhere. We have partners in the country, and we enjoy fruitful partnerships with them. I would like to announce to you that our partnership, our partnership with the ICC Academy, this is one that really brings learning to you directly. The ICC Academy has got a wide range of opportunities for self-development, but mainly within the area of international cooperation within the commercial and trading areas, and also just in the private sector. And this allows you to keep up to speed with what is going on globally. And you will hear a lot more about this during Priyanka's presentation. And two of you in this room, at some point, will be awarded a free scholarship on ICC's professional trade finance certifications. And those of you here today, if you sign up, you will enjoy a 30% discount. So that is a reason how you can recoup already the investment of paying to come into this place from that point of view. So please leverage these opportunities. They are not very many, but you will be able to have a taste of what the ICC Academy can offer in terms of self-development going forward. So as I conclude, I'd like to actually single out the Kenya Private Sector Alliance, of which I've been involved in for a very long time. When we started forming the ICC, KEPSA was approached because really nobody was willing to house ICC in Kenya. And some of you will ask, what is the difference between the ICC, the International Chamber of Commerce Kenya Committee, and the Kenya National Chamber of Commerce and Industry? What's the difference between the two? The big difference is as follows. The ICC Kenya Committee is primarily involved in policy interventions and feeding into global policy. The Kenya National Chamber of Commerce and Industry is a member of the World Chambers Federation. And the World Chambers Federation is one of the constituent bodies of the International Chamber of Commerce. I hope you got the geography. Yeah? So as a member of ICC Kenya committee, you are talking primarily on policy and influencing the direction of trade globally. But if you're a member of the National Chamber of Commerce, you are participating in what those policies have created. So that's the difference between the two, in a nutshell. So the Chamber of Commerce is all around making sure that people who are in this country are able to use those instruments and work with them. But that policy is what you as a commission will be responsible for. So it depends on where you want to play. You can play in both places or this particular one. My encouragement is play in this one. Thank you. And so I'd like to really thank KEPSA for supporting us. Since we came back, we were formed, and still continue to support us with basically as secretariat to us. And the team here today from KEPSA and the secretariat, please stand up and be recognized. Thank you very much for actually being here. You can see the whole lot of them who are here who have made today possible. And for this, we are really grateful. So I would now like to officially open and welcome you to this Banking Kenya conference, and hope that you have a good day and are able to interact and really appreciate what the opportunities are of being a member of the Banking Commission in Kenya. Thank you very much.
Thank you so much, Chair. And I believe we've all gotten the distinction and the role that you are likely to play if you take the rightful position in terms of shaping policy, not only locally but globally. When I was talking to a few people, they were saying that the ones who attended the sessions with the ICC at the global level, some of the things they discuss don't relate to us. But how will they know what really means or what can drive businesses from where we sit? So for not wanting to use some of the words which have some political connotation, I told them we probably need to move from the bottom where we are seated locally to where we need to go as a country. So those are the words that I would like to. Our next speaker, who is going to give us the keynote address, is Andrew Kigira. Andrew is actually sitting, he's a vice president of the International Chamber of Commerce Banking Commission. He sits in the board that is structured out of Paris. So it just tells you how you can play locally and as well take our policy suggestions at the global level, and it's possible. We have our own, Andrew Kigira, who is the vice president at that level. Andrew is an experienced trade finance expert who has worked in the banking sector. He has skills in credit risk, financial risk, business relationship management. He's a strong finance professional who graduated from Jomo Kenyatta University, and I've realized in the room, you've actually worked with quite a number of people. We say banking is like a small room. You get to know each other. So welcome, Andrew Kigira, to give us your keynote speech. Thank you.
Good morning, everybody. You know, you can always tell the digital people and the ones who stay in the old ways, you know. Engineer had a very good digital equipment. I think for some of us, we take the safer route of making sure that the papers do not fail, you know. They're always here. Even the president has papers, if you've noticed. So it's good to be here. Thanks a lot. I think I will, I know I have 15 minutes, so I'll try and keep within my timeline. Yeah, but I think just a quick introduction of myself and how I got here. So very interestingly is that in that Jomo Kenyatta University that you've been mentioned for, I actually did chemistry, nothing to do with finance. So never did anything to do with finance at that point. Joined Citibank as a graduate trainee, where my work was to do scanning. So when everybody applied for a job in Citibank, I said I don't mind where they'll allocate me, but everybody had a choice. So the guy who said can work anywhere was given the role of scanning. So I used to wake up in the morning at 8 and scan a whole day until 8 p.m. If for those who know Citibank, Dennis, you are aware that it's a paperless organization. So the entire papers in the organization stop at the door, and I was the guy at the door. So scan everything and then run that to the bank. So after 3-4 years, I was seated in a meeting for the trade finance operations team, and somebody used, I never pronounce it well, but excuse me, so force majeure. So I was sitting there and this guy uses this word, and the rest of us feel like we don't belong. And I went to the boss and I said, what? I mean, if these guys have so harsh words, that's where I want to go. Like, these guys are the real deal. So I went to my boss and I said, look, I've been scanning for 2 years. Can I move? And that conversation started my journey in trade. So I moved into trade operations, worked there for 5-6 years, then moved into Barclays, where I then moved from operations into the front office. Doing sales, I think up to 2013. Then I started running the trade business in Barclays before it became ABSA. Then following that, then I moved into equity in 2010 to look at the global group trade products for equity. ICC Global, I got a call one day from an individual who I did not know, and he said, we need to talk to you about whatever. So I said, yeah, let's have a conversation. Little did I know that it was an interview for joining the global ICC. So I did this for almost 2 hours, having a discussion around business, and the next thing there was an appointment, which I was then to accept. So that's how I ended up. So from a chemistry individual to an ICC, I think most of you are better suited to be seated there than myself, but it just tells you how a lot of things evolve. So thanks a lot. So that's just a brief introduction. Now, why are we here? I know we'll have a lot of discussions today, but what is most important, and I keep trying to remind people, is that business is part of our lives to an extent where we take it for granted. Like if you look around where you're seated at the moment, every single thing around you is somebody's business. Whether it's a laptop, whether it's water on the table, whether it's a pen, whether it's a notebook, that is somebody's business that has made that item be where it is. So if you start from there, then everything else fits. So during the day, we'll be discussing about SMEs. We know that they represent 80% of the market in whichever market you look at. I know we'll be looking at global rules. Sustainability has become a big discussion. So when you look at ecosystems of the businesses that we're talking about, what does that ecosystem involve? So we are talking about communities, we are talking about employees, we are talking about distributors, suppliers that form the business ecosystem. That ecosystem essentially is what then informs some of the discussions we are going to have today. So when looking at SMEs specifically, we must have a paradigm shift in how we want to finance them. So the biggest challenge is that SMEs struggle to get financing, and more importantly, they also struggle to get affordable financing. So as banks, we are a bit stuck in our ways in terms of how we look at business, and then we must have a paradigm shift when it comes to SME. So I'll just show you a slide. So when I was coming here, I thought to myself, how do we get this going? How do we get this going to an extent that we're able to get a framework of today's discussion? So if you move to the first slide. So I called a few of my SME customers and I said, what are the issues you have with lenders? What are those items that you believe lenders should do to make sure that you get the financing you require? And I summarized that on a slide. I think, Lloyd, you have the wrong slide. So one of the things that the SMEs mentioned is that, one, they want to grow and make profits. That is their primary concern. So whatever business they do, they are there to make profit. For those who know the definition of business, is that business has to provide something of value. It has to provide that item of value to people who want that item and who want to pay for it and can afford to pay for it. And at the same time, it makes profit for the person doing the business. If you take away any of those, then for sure, that's not a business. Which is why I always tell people that when somebody sells you Quill business, you have to look at those 5 factors. If one of those 5 factors is not there, then there is no business, you know. So he has sold us the value on quails and said it offers some medicinal value. Remember, that was that story. But the question I ask myself is that when you walk into your home, how many houses do you get quail eggs as breakfast? And so long as that does not exist, then there is no market. Then everything else just collapses. So one of the things was that SMEs want to grow and make profits. So that is one of the fundamentals of business. They require financing. And that has to do with either its working capital or capital expenditure. So they need financing to grow. The other thing is that they need fair pricing. You know, so they need fair pricing. Remember, these are SMEs that are trying to grow. And lastly, they need quick and flexible decisions. So these are the 4 or 5 items that the clients I called mentioned. There's one that is missing there, but we'll talk about it later on capacity building. But basically, they need quick and flexible decisions. Now, what do SMEs feel about lenders? I think that was a secondary question. So they said that a lot of us lenders, and I don't think I'm speaking for all lenders, we are large, bureaucratic, and traditional. Large, bureaucratic, and these are not my words, by the way. Large, bureaucratic, and traditional. We have stuck in our ways, you know. So we don't move. One of the SME clients said he goes to his branch and there's always this, he calls them faceless credit people, that he's always told, there's another guy in the back office who has declined your application. So you're telling me, why can't I talk to that guy personally? Who is that person? You know? So he said, we are large, bureaucratic, and traditional, and we've refused to move. Then he said, we are blind to business owners' point of view. We are blind to business owners' point of view. You know? So the business owner in an SME or any other corporate is having challenges. But for one reason or the other, the bank can't see it. You know? We either refuse to see it or ignore to see it. So he said, we are blind to business owners' point of view. The other thing is that we only focus on collateral. So he said, the only discussion I have in my bank, the first two questions is, how much tangible collateral can you offer me? You know? And then we are expensive. And the last one, which was the biggest, was on the back and forth, moving goalposts. Today, bring a board resolution. I bring it. The board resolution lands in the bank, and the front office person says, this is not the format of board resolution that you should have brought. And the guy has to do a new board resolution, and that takes another 3 weeks to resolve. So he said the back and forth and moving goalposts was the issue. So as we have today's discussion, we need to put into context some of these things that these clients feel and see how the discussions in today's conversation form the solutions that we will come with, given that this is what the side of the supply of the clients feel with respect to the lenders. Now, I was a bit fair, so I said, let me put in what the lenders feel and want. So in the next slide, I said, what do lenders want? So the lenders want to lend while minimizing risk. That is clear. So one, we also want to grow and make profits. Remember, we are still a business, so the fundamental of growth and making profits still retains in the banking sector. But the lenders need to de-risk lending decisions. If there's one major pain point in the bank, is having a lending decision that goes bad. So whatever facility you lend, the bank needs to know that they are protecting depositors' funds and that item will not go bad, rather it is going to be repaid. Now, digitization is a major discussion. So one of the biggest problems when we look at SMEs is the sheer volumes. Sheer volumes. So with a huge number of SMEs, you cannot do business as usual. You must try and digitize. So the banks want to move into electronic data, big data type discussions when it comes to digitization. We also want security or collateral, and lastly, we want regulatory compliance. So regulatory compliance is becoming a big deal to lenders, and that's where some of the global rules will support us when it comes to regulatory compliance. But how do lenders view these SMEs? So we view them as lack of, having no capital and low profitability. They don't have money. We only give money to those people who have money, isn't it? Give an umbrella, when there's sun. True? So they lack capital, low profitability. There's lack of track record and credit score history. There's no track record. So how do you make decisions based on lack of track record? There's founder dependency. I think in the banking sector we call it key man risk, but there's founder dependency. If this guy is not there, nothing happens. So you worry. So if he's not there, then what happens? So most SMEs run on founder dependency, There's low management skills, knowledge, and experience. So when you look at it, you ask, so how many other businesses have you done? And lastly, there's no tangible security, which, remember, came from the lender side. So with those is how the lenders view SMEs, and I hope today's discussion can then try and bridge the gap when it comes to trade finance with respect to some of these items. So today's discussion points is sustainable trade finance, so that there will be a topic around that. We will also have a discussion around access to trade finance for SMEs, So we will try and cover some of those solutions that we are seeing in the market that are trying to bridge the gap between the first two slides that we've seen. Digitization in trade finance, I think the new rules are out, uniform rules for digital trade transactions. So those are out. Please have a look at them. The whole point is to try and have some global rules that take care of digitization within the trade finance space. Risk AML and compliance, trade register, and ADR for finance and banking sectors. So those are some of the areas that will be covered in today's conference. But my hope and belief is that all those conversations should still align to the client, is what are the challenges they are having, and how can we bridge the gap between how they view lenders and how lenders view clients in a way. So I will end my, my keynote with one short story around a client, an SME client that we met while I was still in Barclays. And I want you to think around how you would have funded this client in your own space. So we went to this client and found that this client does not have financials. He did not have any types of records. He did not have any type of management structure. But the individual had a warehouse, which I would probably say half this hotel in terms of the size of the warehouse. And just didn't make sense. So how do you grow, So the first thing is to say wash, This is not legit money, But very interesting story. So we asked the guy, so how do you do business? So the guy said, look, I put in 5 million shillings when I started, and I bought a container of what it is I sell. So I won't say what he sells so that you guys don't know who he is. So I bought a container, and that container cost me 5 million shillings. After I sold that entire container, and I had 5 million shillings on the table, I looked back at the container, and there was a quarter of a container left. So I had back my 5 million shillings on the table, because I never spent a cent. And when I looked into the container, there was quarter container left. So I figured that quarter container is my profit. I took the 5 million and I bought a new container. And by the time I got my 5 million back, I had half a container left, quarter of the new container. And I did that over and over again. And now I have a warehouse, which is 20 meters by 40 meters. And all this you can see is my profit. I just need you guys to finance me 20 million. You can imagine trying to explain how you are supportive of this facility to the bank and to credit and even for yourself. It's crazy. So we believed that this is really the kind of client we want to finance. But just putting that in paper and getting the bank to understand the paradigm shift that we need is extremely difficult. So I think that just gives you a context of today's meeting and what we should do to build these SMEs. Thank you.
Thank you so much, Andrew. I think for ladies will probably be shoes. By the time you finish a few pairs of shoes, there is more shoes. That is on a lighter note. But at least I hope by today's meeting, by the end of the conference, we'll have come up with some of these solutions. Because these are things that we face on a day-to-day businesses. And people keep on saying banks don't support SMEs. And that's why we've seen now the mushrooming of what we call Shylocks, or people who are going to borrow at very expensive rates because they've lost faith in what you called the faceless people. And I hope we'll be working to change that narrative of being faceless people who don't understand from the business owner's point of view. Allow me at this point to introduce our chair for the ICC Kenya Banking Commission, Kenneth Miriti. And Mr. Kenneth Miriti currently serves as the chairman of the Banking Commission Steering Committee. He is also a member of ICC Kenya ADR and Arbitration Commission Committee. He's also a member of the Chartered Institute of Bankers and Kenya National Chamber of Commerce and Industry. He is a banking and trade finance consultant, offering consulting and advisory services to organizations and businesses involved in import and export. He is previously a banker and currently still a banker because he's working with us as a banking commission and has represented both local and international banks in the country in various positions, and also to stay in support of the banking sector. He conducts trainings in international trade and banking operation. He is a member of the Chartered Institute of Arbitrators and is an independent arbitrator specializing in financial and commercial dispute resolution. Let's welcome Kenneth Miriti to walk us through ICC Banking Commission. Karibu, Kenneth.
Yes, good morning, everybody. As you've heard, my name is Kenneth Miriti, our chairman, director, vice chair Mary, steering committee members, the secretariat, ladies and gentlemen, and those who are also attending online. We have a good representation in this conference, online, including panel members. Mine is to welcome you to this inaugural ICC Kenya Banking Conference. The aim is to add value to both the local banking fraternity and the users of banking services. Before I go into my slide, Andrew has mentioned scanning. and you've taken me back 20 years or so. When you were scanning in Citibank, I think I was also scanning at ABN AMRO. Scanning checks, customer deposit vouchers, carrying suitcases of checks to the clearinghouse central bank. We did that. Much as now we are trying to be digital, we walked the walk. Yeah, so we're in a new era now. You'll hear a lot about digital trade finance. There'll be a session on that in the afternoon. I'm sure that will be a key area for the banks. There's a realization, and we had a discussion, I think, amongst the panel, that in Kenya, we are very good in our payment system. Our payment ecosystem is world-class. We are digital, instant payments. We are ahead of even many first-world countries. But when it comes to trade finance, perhaps even credit and so on and so forth, we are still very paper-based. And there'll be a very good presentation on that, on digital. So mine is to quickly go into the core of what ICC Kenya is about. ICC Kenya, or rather ICC, I'll begin with ICC, the International Chamber of Commerce, is the world's largest organization working to promote international trade, responsible business conduct, and a global approach to regulation. As you've heard, we deal with policy, and in policy, we would like to bring the local banking fraternity to plug into the policy-making decisions that affect the global banking industry. The ICC does this so as to accelerate inclusive and sustainable growth to the benefit of all. The ICC was granted observer status by the UN General Assembly. This means that private sector concerns will be represented in the world's largest international forum. In its capacity as the world's foremost business organization, the International Chamber of Commerce functions in three primary capacities. The first is an advocate for policies and to benefit members in every area of business. The second is establishing rules that help members achieve such policies and adhere to them. And the third is solving disputes between members. ICC has a direct reach to over 6 million businesses throughout the World Chambers Network, which comprises a further 40 million companies, giving us a total employment footprint of over 1 billion people. Members include many of the world's leading companies, financial institutions, SMEs, business associations, and the local chambers of commerce. Much of the work of ICC is of a very practical nature, focused on making it easier for businesses to operate internationally and do more as a force for good. ICC works through 11 policy commissions, which I think was mentioned earlier, which these are specialized working bodies composed of business experts that examine major policy issues of interest to world business and prepare policy products, including statements to contribute to intergovernmental discussions, as well as rules and codes to facilitate international business transactions. The strength and legitimacy of ICC policy statements and rules are derived from the fact that they are developed through extensive consultation within the membership of the ICC. The ICC's normal consultative procedure requires policy documents first to be adopted by one or more of the commissions in consultation with the national committees, and then approved by the executive board before they become public to the ICC. In ICC Kenya, we have, or rather in the ICC, those are the, and you can see on your screen, those are the 11 commissions that comprise the work of ICC. The first two are in blue because those are the active commissions in Kenya. The first commission that was activated was the arbitration and ADR, which had a good conference, inaugural conference last year. And then the second is this one of which we are presenting today, which is the Banking Commission. And then as organic growth takes place, other commissions will be set up. And there is a plan by the end of this year to have another 2 commissions activated. So you can see we in ICC Kenya are trying to be relevant to the needs of not just the local, but also the regional environment. The national committees. Now, national committees, ICC membership spans more than 130 countries, and joining ICC makes good business sense, and it is simple to do so. Membership is through affiliated local national committees, such as the ICC Kenya. To ensure a wider reach of ICC services internationally, the organization has created national committees in various countries. Through the national committees, the ICC is able to convey to governments in the respective countries the business views formulated by ICC. It is in this regard that ICC Kenya was created as a national committee to serve Kenya, and in the long run, serve the region. The national committees are expected to replicate the ICC Paris structure of creating commissions. ICC Kenya is the local chapter, as I've mentioned, of the ICC International Chamber of Commerce based in Paris, and ICC Kenya was incorporated in August 2019. We are currently kindly anchored by KEPSA, as was mentioned by our chair. The ICC Commission benefits and opportunities. There are practical benefits of being a member of the ICC Kenya, specifically for today, the Banking Commission. ICC produces universally accepted rules and guidelines that help business, particularly SMEs, to access the financing they need to grow. Banks and other financial institutions help companies engage in world trade, mitigating risks that goods and services can flow across the globe in a smooth and secure manner. Trade finance is especially critical to small and medium enterprises, which may lack the resources to advance the necessary funds to import and export valuable goods on their own, as was earlier mentioned. In order to ensure that companies are able to access the financing they need and level the playing field worldwide, ICC produces voluntary rules and guidelines for issues such as documentary credits, forfeiting, demand guarantees, bank payment obligations, and dispute resolution. In providing this common framework, ICC allows companies and governments around the world to speak the same regulatory language without burdening banks with red tape that could keep them from financing valuable trade opportunities. I will quickly go through the 5 benefits, practical benefits of membership of ICC Kenya. The first is training and capacity building. ICC provides a very wide range of good training and capacity building opportunities to its membership, and those are available through membership of the National Committee. So in training and capacity building, you can see a very good list of courses that are available, and you can get more of this from our secretariat. The next page, you'll see still more courses, capacity building and training opportunities that are available. In the last group, you'll see a large number of specialized training and rules touching on specifically international trade finance. As we go on, you'll see more benefits in Incoterms. Incoterms are the rules that guide trade finance. There are vast publications that are available in this area: supply chain finance, non-bank letters of credit, international standard banking practices, digital trade finance, which we'll mention today, export financing, uniform rules for contract bonds, documentary credit disputes, and international banking law and practice. So you can see by membership of ICC Kenya, you can tap into this global information platform and also be involved in the decision making so that we can format the needs of the banking industry to our local unique environment. The training in ICC is conducted by the ICC Academy. The ICC Academy is a groundbreaking e-learning platform brought to you by the International Chamber of Commerce. They offer online certifications and professional development services such as customized face-to-face trainings to meet the educational needs of banks, corporates, and other organizations at the forefront of international trade. The next slide, you'll see the global map of ICC. You see now we are represented in 170 countries. And there are some of the global participants and partners of ICC. On the next slide, you will see the certificate programs in 3 major areas: trade finance, where you have 2 certified courses; international business, there are 5 certified courses; and then regulation and compliance, where you have 3 certified courses. So this helps in the professionalism that is needed in running the local banking sector. The second major benefit for the local banking industry would be access to the correspondent banking relationships in over 130 countries in all continents. This is accessible through the membership of the ICC network. The third is access to ICC Banking Commission reports and expert opinions. These are important in helping our local banking industry in policy formulation and their processes. The fourth is an opportunity to articulate issues affecting the local banking industry and contribute to ideas and policy decision-making at a local level. The final group of benefits is access to expert solutions for contemporary risks and challenges facing the banking industry. There is a discount on membership, 50% for conferences like this, training and publications. There will be an extensive session on training today from a representative of the ICC Academy, and also there will be discount on ICC global events through your membership. The final benefit of this is the arbitration and dispute resolution services. This is a new area, and there will be, again, a very good discussion and panel discussion on the role of arbitration and mediation in banking and financial disputes. This is an area that banks can tap into as we seek to move away from the traditional litigation, which we've done for over 50 years in resolving our disputes. And that will be presented by a panel that is going to come very soon. So very quickly, there will be the role of the International Court of Arbitration. I'll very quickly mention that, though that's a sister steering committee. The International Court of Arbitration is the world's leading arbitral institution, helping to resolve difficulties, international, commercial, and business disputes, to support contracts, commerce, trade, and investment. It performs an essential role by providing individuals, businesses, and governments alike with a variety of customized services for every stage of a dispute. Although called a court in name, the ICC International Court of Arbitration does not make formal judgments on dispute matters. Instead, it exercises judicial supervision of arbitration proceedings. Its responsibilities include confirming, appointing, and replacing arbitrators, So the ICC Court of Arbitration is actually a facilitator of the actual dispute resolution process. It confirms and appoints arbitrators. It monitors the arbitral process to make certain that it is performed properly and within the required speed and efficiency. Unlike the local arbitration, the ICC Court of Arbitration, it will scrutinize and approve all arbitral awards to reinforce quality and enforceability, setting, managing, and if necessary, adjusting the fees and advances, and finally, overseeing emergency proceedings before the start of arbitration. And that's an area that will be covered later on emergency arbitration. Finally, the main purpose is to ensure proper application of the ICC rules, as well as assist both parties and arbitrators in overcoming procedural obstacles. These efforts are supported by the Court Secretariat, which is made up of more than 80 lawyers and other support personnel. It continuously seeks to improve efficiency, control time, costs, and aid in enforcement and confidentiality by introducing innovative new arbitration tools and procedures. The ongoing focus makes certain that ICC Court of Arbitration is always in touch with the concerns and interests of the trading partners in the world. There are two legs of arbitration. There is institutional arbitration, as you can see on your screen, and then there is the ad hoc arbitration. Under institutional arbitration, we have a few of the best-known international arbitration bodies, which include the International Chamber of Commerce Arbitration Court, which I've just mentioned, the London Court of International Arbitration, and the Nairobi Center for International Arbitration. This is where international disputes, touching especially on international trade and cross-border disputes, can be arbitrated. And it's good to see our own NCIA, of which one of our directors is here, is big in that area. So you can see we're well represented even on the global platform in areas of dispute resolution, not just between banks, but also between banks and their clients. So the era of this dispute must be done in Singapore and London need not apply. We have equally qualified, recognized arbitrators in Nairobi who can handle regional and international disputes in this arena. Finally, we also have ad hoc arbitration. Ad hoc arbitration is conducted under rules adopted for the purpose of the specific dispute without the involvement of an arbitral institution. The parties can draft the rules themselves. However, they usually either leave the rules to the discretion of the arbitrator or they adopt rules specifically written for ad hoc arbitration, for example, the Unison rules or the Arbitration Act of Kenya. Appointment of the arbitrator. Appointment will be made in accordance with the terms of the arbitration, whatever the parties have agreed, and the silent rules of the institutional arbitrators. There will be more of that in today's session, touching on the arbitral process. And I think I will not go too much into that so that I don't hint into the particular session. So, ladies and gentlemen, I hope by the end of today's conference, our objective of being relevant to the banking industry will be achieved. And with that, I say thank you and welcome.
Thank you so much, Chair. I wanted us to welcome our participants who are joining us online. I think you can project them. The same way the room is full, we also have the virtual session also equally full. And it's important to acknowledge the participants who are online. And as we go to today's discussion, I think it's important to take notes. As Chair said, we have 2 scholarships, and 2 lucky people in this room will walk away with those scholarships. And how we'll do it will be by a Q&A session in terms of some of the takeaways in the discussions for today. I'd also request the next team that will be leading the discussions for today, which is a panel discussion on sustainable trade finance, to take the stage. And I would like to introduce the moderator for that session, Mother Morunga, will be introducing the panelists. Martha is a senior trade officer, and she's also an alumni of ICC Academy, class of 2021. So, Martha, please come introduce your panelists as we project. I know they've been able to project the participants online. Liod?
No, I'll call them.
Okay.
Thank you very much, Mary, for the introduction. I'd like to welcome the online viewers today. And before I start, I would like to start by quoting the Secretary General of the ICC, Mr. John Denton, on the position paper about the sustainable trade finance and standards published during the last COP26 in November. He says, more now than ever, it is evident that enabling businesses to be sustainable is not only of critical importance, but also central to our purpose and values as ICC. End of quote. Therefore, this very day, we are working on bringing up the trade finance industry towards sustainable practices in a broader sense. We are also looking to bring forward the aspect of trade finance sustainabilities by raising awareness. I would therefore like to introduce my expert panel team to advance this conversation, but I will actually give them the chance to do it themselves. With me is Frederick Nyasaka, on stage, the head of finance and administration at Bank. We also have Kevin Odero, who's a relationship manager, trade finance at Stanbic Bank. We have Cyprian Rono, he's a relationship manager and lead trade sales from UBA. And joining us online is Bob Lower, the CEO of Clarency Singapore Limited. Welcome. Welcome, Bob. So I'll ask each and every one of them to introduce themselves. Thank you very much. We'll begin with Frederick.
Good morning. My name is Fred Nyasaka. I'm currently the CFO at Bank. But my experience is across the industry over the last 18 years. This is my 19th year. I've worked at Equity, Andrew. I've been at KCB. I've been at NCBA. I've been at, I think, Citian Bank as well. I'm not an expert in trade finance. I'm more of from a financial reporting perspective. But you know, everything converges in finance. So I have an appreciation of what goes on in that space. Thank you very much. And I hope we'll have an interactive session. Thank you.
So we shall have Kevin go next.
Thank you, and good morning, participants. I'm Kevin Odero. I currently serve as a specialist for trade finance at Stanbic Bank, taking care of local corporates. I've also been a trade finance practitioner for quite some time. I've worked with Andrew, I've worked with Cyprian, Mary, I see a number of colleagues. I started my trade finance journey in 2007 at Barclays Bank. Since then, I've worked at the former NIC Bank, KCB, and currently at Stanbic Bank. And I also happen to be a student of the ICC Academy currently. Yeah, thanks.
Thank you very much. We shall have Cyprian go next.
Okay, thank you, Martha. Good morning, everyone, both here and online. My name is Cyprian Rono. I currently work with UBA Bank. I oversee the regional trade. Sorry, technology. So I oversee trade in Kenya, Uganda, Tanzania, as well as Mozambique and Zambia. I have been in the industry for a while. Started, I was at Copa, I was at KCB at some point, Standard Chartered at some point, currently with UBA. So I've had an interesting journey in trade finance, corporate banking, as well as commercial and SME space. So I bring on board experience in terms of trade, knowledge in terms of, even from the business side. And I really look forward to this discussion and how we can be part of this. Thank you so much.
Thank you very much, Cyprian. We'll have Bob online. He'll be joining us online. Would you kindly introduce yourself, Bob?
Yes, hello everybody. Sorry I couldn't be with you in person. So I run a company in Singapore which does provides liquidity to banks around Africa to make international payments in US dollars, etc. We currently work with about 25 different banks across Africa, including Mary's Bank. Before that, I was the global head of trade at a Standard Bank based in Johannesburg, and I've worked for National Bank of Abu Dhabi and HSBC in Hong Kong, where I was global head of IT and operations.
Thank you very much, Bob. So I would like to kindly have you give my panelists, and I think we'll begin with Bob. I'd like you to please give me an overview of what you understand by sustainable trade finance.
Yeah, I think this is a big issue. I think there's two different views around sustainability. One is that is around green and around the whole agenda around taking carbon out of the atmosphere and trying to meet the various goals around temperature in the world. But equally, I think that goes alongside that is that many of the businesses that are being set up now need to become sustainable. They need to be able to find ways in which they can create their supply chains which are sustainable. They can import when they need to import, or they can export when they need to export. And they need to be able to have employment practices, and they need to have, which reflects the best practices in the communities. And overall, I think it's really about sort of how do you sort of create an ecosystem, if that's the right word, in which people can prosper. I think when we look at markets as they emerge, generally speaking, what you find is that sort of people start off with transactional services. They start off making payments, and then they start building up small amounts of savings. But very quickly, they then move on to making their own businesses. They start small businesses. Those small businesses often fail, but very often they also grow. If you look at the companies which are in the top sort of 30 companies in the US, for example, at the moment, hardly any of them existed 30 years ago. So it's really a sort of question of sort of saying, how do we, as in the banking world, provide things which meet all these multiple ambitions, these multiple goals around sustainability for the environment, sustainability for temperature stabilization, sustainability for employment, sustainability for businesses. And I think your keynote speaker at the beginning had it absolutely right. That if we carry on thinking about things in the same way that bankers have traditionally thought about things, which is show me where your collateral is, then we will not be sustaining those businesses. I go back to my own life. When I was 18 years old, I became homeless as a result of the bank taking the security which my father had pledged against the overdraft just before he died. So I saw directly the results of the way, the negative impacts of that. And I think, I spent a lot of my life actually trying to find ways which repair that, which support small business people and help them to grow their businesses and support their families.
Wow. We actually hope that you're going to soon find a solution to that. Would you kindly, Fred?
Yes, thank you for that question. I would say that up to around 2013, we used to prepare financial statements as basically, we used to call them annual reports. The annual reports basically included the primary financial statements as we know them, the balance sheet, the P&L, the statement of cash flows. But around 2013, 2014, things started changing. And instead of just reporting your financial statement, people wanted to know more. And the concept of the triple bottom line became in. So rather than just reporting your profit, then you had to also go out and explain to what extent has your business affected the environment, which is the second P. So the first one is profit. So now we've decided to also give an impact of how our business affected the planet. And the other part was also how does your business affect people, which is basically the third P. So my definition of sustainability is basically having a long-term business that not only takes care of the profit objective, but also has the other aspects which include the people and the planet that we live in. So when we talk about sustainable trade, is basically what activities do we do around our business to try and ensure that we not only achieve long-term profitability, but also ensuring that all the stakeholders are taken care of. Thank you.
Thank you very much, Fred. We shall have Kevin.
Thank you. Thank you for that question. In my opinion, first of all, you cannot define sustainable trade finance before you talk about what sustainable trade means. Trade happens to be a very intricate concept, if you ask me, in my opinion. I was just reading somewhere this morning that trade and related activities contribute to 80% of the global carbon footprint. But over and above that, it also contributes to employment and livelihoods of quite a number of people. So then when you talk about sustainable trade, basically it's with a view to understand or appreciate how do the trade activities that our clients participate in within the value chain drive towards the sustainable development goals of the United Nations. Then having defined sustainable trade being that, then now sustainable trade finance basically relates to those activities that now and solutions that the banks will provide to enable our customers drive the sustainable trade as envisioned in the United Nations Sustainable Development Goals. Thanks.
Quite insightful, thank you. We shall have Cyprian.
Thank you. Coming last after everyone, you had your definitions set, and then now when everybody spoke, you realize they have said everything you wanted to say. So I think I'll just try and pick it up from my, from where I sit. I'll look at it, in a very simple way, yet it's a very complex subject. When we say sustainable trade finance, what are we looking at? What are we saying? We are looking at something that is, let me remove sustainable and look at it alone. Sustainable means maintain or sustain something over a period of time. And trade finance, is a key part, an integral part in financing businesses, the entire supply chain system. And what happens is that when we marry the two, then we're looking at how then are we able to sustain or maintain trade finance to have positive impact, with the current and future generations? And that's why when we talk about sustainability, we're looking at, are the activities, being done right now, being facilitated in the trade finance space, enabling a future, for the environment, for the society, is it encouraging governance? And that's really how I'd look at it in terms, when we look at sustainable trade finance. Thank you.
Thank you. Thank you very much, Cyprian. Also now, this goes to Bob. I'd like you to kindly guide us. Where do we really draw the line between sustainable trade finance, green financing, and ESGs?
Yeah, so I think this is quite an interesting topic, because obviously one of the things which is happening as bank capital has become more constrained. So we've seen a lot more entrants into the marketplace who are trying to differentiate themselves in different ways. So we see funds which are supporting just straightforward trade. We see funds which are supporting different types of sustainability goals. And then we see funds which are coming in sort of supporting green causes and of various sorts. So I think what's happening is that we've got this new capital coming into the marketplace, but of course I think our auditor will tell us that one of the biggest problems is how do you know that the money is being used for the purposes that you want it to be used for, and more importantly on the other end, how do you meet the various goals which are there? So when I was in Johannesburg, for example, after leaving Standard Bank, I set up a fund there which funded small businesses in the green sector. And to qualify for capital from the United Nations Green Climate Fund, we had to fill out an extremely extensive questionnaire which set out sort of what we were doing in terms of the community, what we were doing in terms of carbon footprint goals, what we were doing in terms of the way in which the business was being run, and how we were supporting the various businesses. At the end of it, I think we were able to justify that we supported more than 40,000 new jobs and nearly 200,000 metric tons of carbon emission mitigation as part of that. But that was a huge amount of work for a small business to go through, huge amounts of administration. And the differentiation between what we were doing and what banks were doing is that banks, generally speaking, when they're given money by the DFIs, by the development finance institutions, I think most people will say that sort of your job is to roll out the balance sheet first, the bank's balance sheet first, and you'll only really worry about the DFI money once you're pushed by somebody inside the bank. There's in my experience, it's not been sort of a priority for banks to move that money out. So I think it's really sort of about sort of trying to get a framework in which people can really justify what it is they're doing. It's not just window dressing. I think a lot of the time what we see is that people are just attacking the immediate issue. They're not really attacking the downstream issues like sustainability in the communities, like sort of potentially pollution offsets, those sort of types of things. And I think that's got to develop a lot more. And I think ICC should be in the forefront of developing those frameworks to help us judge where we're really making an impact and where we're just simply sort of showing our virtue to people.
Oh, thank you very much, Bob. Fred, you go next. I would like you to kindly give me, in your opinion, is sustainable trade finance about the goods? Is it about standards? Is it about trade, supply chains? What do you feel about that?
Martha, thank you for that question. But before I respond to that, I just need to put a rejoinder on what Bob was saying on the green finance. Right. So according to the World Economic Forum, around $2.36 trillion is out there in terms of green finance. But the key issue here is that out of this global amount, the 2.36 $6 trillion, most of it is in debt and in equity. So you can see on the trade space, this is something also that I think there's an opportunity. And that's why the topic we are handling today is an emerging area. And it is something that, of course, if we go green, then again in trade finance, we have an opportunity there. Now, as to the question that Martha, you have asked, who are the players as far as sustainable trade is concerned? I think the way we are looking at it is we have a position paper from the ICC that basically has defined how we need to look at this issue. And they have defined 5 players. So, and all these 5 players, we have to look at sustainability in all those aspects. So the first really is where the originator, where the seller is coming from. To what extent are the activities green? Then, of course, you have to look at the good or the service that is being sold or that is being transacted on. Is it green or not? Then you also have to look at the transportation module. So, for example, if you are importing something from abroad and you are using a financial instrument, you have to go back to where you're getting the good from to find out whether at that level their practices adhere to the standards, the sustainable finance or sustainable trade standards. So I said the first one is the first component is the seller. We have the buyer. We have the goods themselves. They must be green. Then we also have the transportation module. So if you're going to use a ship, you also need to ascertain to what extent is it sustainable. Then finally, the purpose with which that good is being used. So you have to do an assessment, and the position paper from the ICC is very clear on that. We shall be able to share it with you for a deeper insight on this issue. So to your question, yes, when you're looking at sustainable trade finance, you have to look at all those components. From a standards perspective, I know my colleagues maybe will talk about the other issues with ESG, but what the ICC is doing is to map. We have a rating matrix that maps the testing of these 5 components vis-a-vis the Sustainable Development Goals that were issued by the United Nations. And we know there are 17 in number, but you cannot map them directly to business. So the ICC has mapped them into 3 categories, of which we know. So you have the economic category, you have the environmental category, and also you have the social category. So you have to take these 5 components and map them up. From a standards perspective, ICC is yet to issue the standards around this, and I know Bob maybe can add to this. But what we are saying is we can use any available standards out there, but map them to what we have. Thank you.
Oh, excellent. So you actually feel like it encompasses all these things?
Yes, indeed. We have the 5 components. Yeah.
Thank you very much, Frederick. So we will move on to Kevin, and I'd like to note that currently various industry bodies are trying to come up with a proper definition for sustainable trade finance. What do you think could be the impact of having a proper definition for this? And what ways do you think this would benefit the banking industry, both globally and in Kenya?
Thanks for that question.
Thanks for that question, Martha. First of all, I'd like to just take a bit of a detour from what my other colleagues have said. One, in my view, when you talk about sustainability, people sort of tend to narrow it down to environmental impact and climate change alone. But that is not the case. There are other facets of sustainability that needs to be looked at. There are elements like social development and economic development, financial inclusion. In trying to define sustainable trade finance and sustainable trade, we need to take into account all those facets of sustainability. With regards to the various entities that are trying to come up with a definition of trade finance, we must recognize the work that the Chamber is doing towards coming up with a standard, to just have a global standard, so that it's sort of like a blueprint that all global banks can refer to on matters sustainable trade and trade finance. Going by the presentation that was made by the chair earlier about the role of the ICC with regards to setting standards, there are a number of rules that we in the bank rely on when we matter trade finance, like rules that govern the demand guarantees, rules that govern letters of credit. Before those rules were in place, those who've read can tell you it was very, very chaotic. For example, if you have a dispute between a supplier in Singapore and a buyer in Kenya, and when there's a dispute, what do you resort to be able to arbitrate the matter? So on matters of sustainable trade, also coming up with that standard set of guidelines or rules will be able to help to overcome such challenges. Mm-hmm. And with regards to the impact on banks, I think it's going to make business seamless for banks, okay, in that you have a global guideline that you can refer to just ensure that you're complying to, one, what the ICC expects, and all the other banks that subscribe to the ICC rules. Mm. Thanks.
Okay, thank you very much. Is there anyone who'd like to add something, Cyprian, regarding the same?
Not really. I think I'll just shoot and just proceed. Most of them have talked about the challenges that come out of this. And as I was just reflecting on this particular question, I asked myself, how did we as in the world, how did we agree that shipment will be done in 40-foot containers or 20-foot containers? That is currently what is an acceptable means of handling cargo. And before that, there had to be lobbying, a lot of advocacy, and intentional discussions between all parties, so that you can have a standard way of addressing issues. And right now, I think that is where we are with sustainable trade finance. This discussion, there is no standard per se in how to address this, because when there is a standard, then you can easily come up with ways and policies and systems on how to handle things. So one of the challenges that I'd actually put right now is that there is no standardization. We still have a long way to go in terms of addressing what principles or what mechanisms will then form as a basis for that. The other, just stemming out from what my colleagues have said, is different organizations will offer different certificates. And these certificates, let's say, when it comes to carbon emission or environmental impact assessments, etc., fair trade, all these certificates being offered, by different organizations in a bid to try and standardize or quantify how sustainable a practice is. And when assuming today I want to issue a letter of credit from my bank, a long time ago we never used to bother on who the beneficiary was. I remember we just open the letter of credit, you send it to the advising bank, and you leave it there. But right now you will notice that there's a lot of interest on who is on the receiving end of these letters of credit. I believe that's a good way, or should I say, is a step towards trying to address this issue of sustainability. But for instance, if I am importing, assuming I'm importing bitumen or something from another country, the question is, what certificate will I use to measure the standard of, or should I say, the impact, let's say, on environments, or even the social impact when that particular bitumen was being extracted? How are the employees treated, etc. Those are some of the things that really form up where we are and the challenges that we probably need to address. One of the other challenges is political goodwill. You could be interested, one country could be interested, let's say Kenya, in focusing on, let me give an example, green energy, and probably restrict transactions towards that space. But if this is not standardized, or there's no political goodwill in other jurisdictions, then that alone also becomes a challenge. And a classic example was when Kenya banned the importation of plastic paper. You could see other countries were okay with it, but we really struggled. People were coming here with paper, and as you're in the plane, you're being told Kenya is a country that does not allow plastic paper bag. And so these are some of the challenges that we expect. When I look at Africa, and that's where we play, when you look at how businesses are being conducted, the mode at which most of them are doing their business is not, you can't really say they are sustainable, because we have to industrialize and we have to use the cheapest means to do that. So some of these business practices are not sustainable. So yeah, it is really a challenge. There are so many that we can think about. Those are just a few that I can mention here.
Thank you very much, Cyprian. So I'd like to find out from Bob about the issue of greenwashing. Do you feel like it's actually a hindrance to sustainable trade finance? Like sustainable trade finance, this is especially when marketing the products and the services. Do you feel like we are actually, and honestly, greenwashing in global trade, or it's just like double speak?
I think there's undoubtedly, people who put a spin onto projects in order to try and get them to appear to be sustainable and investable. Because increasingly the investors are looking at how their money is being used, and they're being held accountable by their investors and by the governments which are sponsoring them and other things. So greenwashing is very real. It's a halfway house, of course. So you could argue that on one hand, at least people are becoming more aware of sustainability and on adopting green policies. But on the other hand, there is a tendency always, as we know as human beings, that people will do whatever they can do to get access to the money. And in trade finance, we see that all the time. From people who present us with fake invoices, all the way to people who present us, give us unusual documents, to try and sustain what they're trying to do. So I think it's something we have to be aware of as an industry. It comes back to standards, about how we can measure those standards. Because the whole point is that sort of standards are no use unless you can actually hold people accountable to them. And unless you've got real measurable sort of goals around there, and you've got methods of measuring. So it's something which we need to be very aware of. And overall, I think as we progress, of course, what will happen as these standards emerge is we'll see more investors coming into the marketplace. We'll see more money coming into the marketplace to sustain those goals. And for banks, that means, I think, adapting to really work with these partners in a different way to the previous way. As I said earlier, the tendency in the bank is you deploy your own capital first, and then you think about what other capital you might have available to you. But in the world of scarce capital, of course, using other people's capital is much better.
Thank you for the feedback, Bob. So we'll go back to Fred. And I'd like to, to find out from you, from a KBS perspective, what are some of the sustainability priorities that you have managed to implement and that can be adopted by all the other Kenyan banks?
Thank you very much for that question, Martha. I sit in the KBA Finance Committee and see that we can see that our members, KBA itself has been quite proactive in terms of the issues of sustainability. And we know from around 2013, we signed the Sustainable Finance Initiative, and we've had quite a number of our members sign in and do the courses. I think I checked as at yesterday, I think we had around 36,000 of us who had done that SFI training. Apart from that, if you look at some of the banks that are leading around the issues of sustainability, we have our key Tier 1 banks. I think in 2015, when I was at KCB, we were the first bank that produced an integrated report. So we've been on a journey on the issues of sustainability. I know we have the multinational banks who are also involved around the issues to do with sustainability. In addition to that, organizations are also doing their own sustainability reports, separate reports. And through the KBA also, we organize the Catalyst Awards, of which I know majority of the people in here have participated and have also gotten awards. So I will say from a banking perspective, since 2015, we've been on a good journey. And even as ICC releases their position paper and also guidelines on how to review transactions from a sustainability perspective, will have already appreciated what is going on. So there's a lot that the KB is doing, that there's a lot that the membership is doing around the space of sustainability.
So what do you think? So what are some of the things that you feel like the banks can, like the local banks, the really small banks can adopt?
Yes, I think the key thing is to really, like we have seen on the components, is to work with our clients so that we have an end-to-end from a value chain perspective on how we can be able to achieve sustainability. Because like we have seen, the issues of sustainability are not at a corporate level only. You have to engage people in the value chain. You have to engage your customers, you have to engage your suppliers at every level. So as much as we have the knowledge, then we have again to work with our clients. The key thing here is, for example, you can arrange a seminar with your clients just to take them through the importance of issues of sustainability and basically how to ensure that we achieve the triple bottom line that we are pursuing. Thank you.
Thank you very much. Kevin, I'd like to understand some of the key drivers that your bank focuses on ESG issues. Do you have some key drivers?
Thanks for that question.
Yeah.
Maybe let me just give a background first. Like I mentioned, I work with Stanbic Bank Kenya. Stanbic Bank is part of the Standard Bank Group of South Africa, which is happens to be the largest bank by asset size in Africa. Standard Bank is partially owned by ICBC Bank in China. So you find that by the global nature of the bank, we actually signatories of the United Nations Sustainable Development Goals. We signed that in 2019. The purpose of these goals was basically purposes of just guiding banks with a view to helping in addressing and reducing mitigating the negative impacts and supporting the identification and scaling of the positive impacts. So with regards to that, the bank has identified a number of key pillars to focus on towards driving the
driving this agenda. There's financial inclusion, there is job creation, like I mentioned, infrastructure development, Africa trade and investment. So to start with what we are doing internally, one, we have a risk grading matrix for purposes of ESG. So basically, any client that approaches us for financing, we take them through matrix to first confirm that the rating that we get is in line with our aspirations towards achieving these sustainability goals. And over and above that, we are in partnership with a number of entities that we work with towards training to help with financial inclusion. We have a partnership with the Ministry of Trade where we usually have engagements to just train youths around matters of business development and entrepreneurship. We also have a pillar to drive access to financing for women in business. I'm sure you've seen lots of our billboards along the road with DADA. So we identified that as a sector that we think that if we invest in and finance them, we'll be contributing towards just helping to achieve some of these ESG initiatives. I think in the interest of time, I'll just pause there.
Okay. So, and finally, I think we'll have Cyprian give us the benefits that our banks and clients get from the practice of sustainable trade finance.
Okay, thank you, Martha. Yeah, I know because of time, I'll just quickly mention a few. Some of the benefits, for instance, the banks can obtain from this is innovation. What happens is, if, just giving an example, green energy. Banks, the development of green energy is now forcing banks to come up with solutions, finance solutions around it. The other thing about the benefit about, having banks in implementing sustainable trade is its ability to mitigate reputational risk. When you are part of a transaction that has negative impact on the environment, on the society, e.g., that has a negative impact on you as an organization and as a brand. So it is very critical that with this, the bank will be able to mitigate such risk. When they focus on sustainability of trade transactions. To clients, we do expect that they will be able to get good credit ratings. Just as my panelist here has mentioned, that when you're able to meet certain criteria, then definitely your risk rating goes down. The other things that you also are able to obtain cheap funding, etc. And the list is numerous, and I think that is why we are all trying to come up with ways of approaching this, because we do know that it has massive beneficial impact to both the banks as well as the customers. Thank you.
Okay, so just a quick brief of like a sentence or something for the panelists. Would you kindly just give me a brief of where do you see us heading with this whole idea of sustainability trade finance in the next 5 years? Just a sentence.
Okay, maybe I can just go. I see a journey of 1,000 miles begins with one step. I believe we are headed towards the right direction. In 5 years' time, most probably will be, hopefully, probably 100 steps in this journey. But I think government, for me, will probably be included around that time, who's a very critical part of this. Thank you.
I think my parting shot will say is that some years back, issues of sustainability were like just something good to talk about. But where we are going now, we have no choice. Our businesses have to be sustainable. They say that if the world temperature increases by 2%, we'll have no earth. So we have to model our businesses and include sustainability at the center, at the core of it. Thank you.
Thanks. I think, in my opinion, one I would like to mention, we are in the right direction. If you look at the local authorities, some of the initiatives that they've already taken towards environmental risk management that NEMA is driving, so I think we are already in the right direction. And of course, if you also take account the work that the ICC is doing with a view to coming up with standards, so well, I would not want to be a prophet and say that in 5 years we'll be at X place, but just to acknowledge that generally we are on the right track. Thanks.
Okay, I think Bob, we'll hear from Bob. Bob? Bob?
More about the communities in which, well, I'm hoping that we'll get a view from banking where we'll be much more involved in the communities we operate in. You know, one of the strengths of the ICC is it brings together banks and corporations into a single forum, and I think you know, driving that agenda and sort of bringing together the different elements to come up with more innovative solutions. You know, starting with things like digital, but sort of later on moving to different ways of financing.
Thank you very much, Bob. Therefore, I'd like to give a very big thank you to all the online participants, the members who are present in this room, and the panelists for the time you have taken to join us in the interactive panel discussion. Thank you very much for your time, and enjoy the rest of the session. For those who have questions, you could kindly post them
on Mentimeter.
Yeah.
I think you can pull up the instructions on how for them to post the questions. We should be able to address them in the essence of time. The panelists will be more than happy to respond to those questions. And also just remind every comments there as we progress. I want to release you for at 15 minutes tea break. Tea will be served at the end of this corridor where you had tea in the morning, and let's meet back for the next session by 11. Is that tenable? What time is it? Okay, sorry. So we can meet at 11:15. That is in order. Okay. So enjoy your tea, and let's regroup at 11:15. Thank you very much, the panelists. I think this is a very interesting topic and a lot to be done from what we've taken to be able to address the issues of sustainability in how we do our businesses. And my key takeout was not only as a bank, but with all the other 5 players in this sector that we need to look at, even as we look at sustainability. So enjoy your tea break. Thank you. ICC alumni. She hosts a podcast titled Trade Insider, and I believe all of us can look at it and just follow her on that as well, that explores the latest trends and best practices within the global trade landscape. She has successfully hosted the ICC Academy's annual flagship supply chain finance summits, both in Dubai and Singapore, and the Academy's product launches as well as the webinars. This year, our key focus is to work with the national committees to ensure that we build capabilities for banks and SMEs in Academy's industry-validated trade finance and international business certification, and she'll also be collaborating with other national committees, including ourselves. Before she joined ICC, she's previously worked for another entity in Singapore, Open University in Scotland, and Scottish Executive and Evaluation Support Program. She was previously a journalist in India, and has worked for Times in India as well as a statesman. So welcome Priyanka to walk us through training and capacity building within the ICC Academy. Over to you, Priyanka.
Now moving on to the presentation on training and capacity building. Let me introduce myself. My name is Priyanka Satapathy. I'm the Communications Manager at the International Chamber of Commerce Academy. I will be making my presentation today about who we are, the importance of training and capacity building, and how our industry-validated trade finance certifications programs have helped thousands of banks and professionals across the globe keep their knowledge up to date. Now about the World Business Organization. The International Chamber of Commerce is the institutional representative of more than 45 million companies in over 100 countries. Its core mission is to make business work for everyone, every day, everywhere. Through a unique mix of advocacy, solutions, and standard setting, ICC promotes international trade, responsible business conduct, and a global approach to regulation, in addition to provide market-leading dispute resolution services. ICC members include many of the world's leading companies, SMEs, business associations, and local chambers of commerce. Established in 1990, ICC is known for setting new standards, from setting up the International Court of Arbitration in 1923 to publishing the first rules for the Uniform Customs and Practice for Documentary Credits in 1933. And from being the first to publish the Incoterms rules in 1936 to the most recent edition in 2020, to be the first organization to issue anti-corruption in 1977. So back in 2013, members of the ICC Banking Commission realized the knowledge and skills gap that existed among trade finance professionals and the need for trade finance qualifications for professionals working in banks, financial institutions, as well as corporations. They had clear objectives and insight, developed specific knowledge and professional capacities in the regions, strong commitment to empower practitioners with the opportunity to improve their skills while staying up to date with the latest policies and practices, and strengthen and further international trade by providing banks with the core knowledge, industry knowledge, and thereby underpinning support for the SMEs. After 2 years since its ideation, ICC launched its educational arm, the ICC Academy, in 2015. Designed by the expertise and experience of the ICC Banking Commission members, senior industry leaders, and policy managers, comprising more than 600 members across 110 countries, ICC's flagship offerings were introduced. It included 2 professional trade finance certifications. the Introductory Level Global Trade Certificate, and the Advanced Level Certified Trade Finance Professional. Now a bit of facts and statistics. According to the Asian Development Bank's 2021 Trade Finance Gaps Growth and Jobs Survey, the global trade finance gap is estimated to have increased to $1.7 trillion during the COVID-19 pandemic in 2020 from $1.5 trillion in 2018. And this is concerning. One of the recommendations is investing in expertise, that is plugging the knowledge gaps around trade finance and its various instruments that will help professionals improve SMEs' access. Several trade finance facilitation programs therefore include technical assistant components that extend training to trade finance professionals and banks. Building capabilities among trade finance and international trade professionals is core to the ICC Academy's mission, and this is where our professional certifications come in. Our Global Trade Certificate is an introductory level professional certificate program providing solid knowledge on trade finance products. It is an ideal program for professionals wanting to build a comprehensive understanding of global trade finance. Comprising of 6 core courses and 3 electives, the industry-validated syllabus has been tailor-made to learn the essentials of global trade finance, from documentary credits, collections, guarantees, receivables, distributor finance, supply chain finance, compliance, cross-border trade. We cover it all. The program is designed for professionals working in banks and other financial institutions, generalists from relationship management and agri-commodities teams, legal and compliance officers, risk management officers, specialists within transaction banking functions, and other key support staff. Professionals from corporates working as treasury executives as well as in business development, compliance, and legal officers can also benefit from this certificate. Now, when you take up this program, you acquire a foundational understanding of global trade finance solutions, learn to use trade finance tools effectively to mitigate risks, and understand trade finance process flows, from the steps and responsibilities to the required documents used. Now, moving on to the next level of training that we offer, which is called the Advanced Level Certified Trade Finance Professional. This program focuses on key trade finance products, techniques, and compliance issues. Comprising 5 core courses and 4 electives, this program has been tailor-made to develop the skills needed to sell, deliver, and process global trade finance solutions. The courses include working capital for trade, factoring, digital trade finance and fintech, trade sales, trade operations, trade products, commodity finance, and standby letters of credit. The program is designed for professionals working in banks and other financial institutions, within senior corporate banking as relationship managers, senior corporate treasury professionals, and specialists within transaction banking functions. Professionals from corporates working as treasury executives as well as business development, compliance, and legal officers can also benefit from this certificate. When you take up this program, you explore advanced characteristics of trade finance, including processes and legal framework, gain an understanding of the roles and relationships of all parties involved in a transaction, and become an expert in complex financial instruments to make viable commercial contracts. This was all about our trade finance certifications. Now, when you enroll in either of them, we do support you in your learning journey. We provide 1-year access to the professional certificate program for both core and elective courses, interactive learning with pre-assessment games and assessment questions on a range of topics, a searchable and printable glossary containing all the key terms to refer to throughout the program, new study guides for core courses to help candidates prepare for the final examination, case studies from companies or individuals to help apply learning to real world, a live proctored final exam with the opportunity to receive an industry-recognized certificate, and dedicated full-time IT support to assist with any issues or questions. In spite of our courses being created by industry leaders, we still strongly believe in accreditations, because accreditations help determine if an institution meets or exceeds minimum standards of quality. Both our trade finance certificates are accredited by the Bankers Association for Finance and Trade, the London Institute of Banking and Finance, the Institute of Banking and Finance Singapore, and Global Trade Professional Alliance. What is more, the ICC Academy's trainings are ISO certified, meaning anyone who enrolls in our programs can attain the relevant competency standards for ISO IEC 17024 certification, the only international standard for the certification of professional competence in the global trade discipline. Not only that, we know that our candidates are busy professionals who are in full-time job and are simultaneously pursuing courses for continuous professional development. Hence, we have ensured that our learning management platform is both efficient and seamless. We partnered with our technology solutions provider to offer our courses on an e-learning system that is intuitive user interface and UX, a platform that provides a seamless, engaging, and customizable user experience. We are delighted to announce that recently we received the Brandon Hall Group HCM Excellence Award under the Best Advanced in Business Strategy category for our robust e-commerce powered learning management system. When we started way back in 2015, 5 banks, Commonwealth Bank of Australia, DBS, OCBC Bank, Banco Santander, and Standard Bank were our early adopters. Well, even today, these banks are our B2B clients. But today, 6 years down the line, we have a global presence in more than 170 countries. And we have trained staff from banks like BNP Paribas, HSBC, Emirates NBD, to corporations like MVP Solutions, DB Shankar Rolls-Royce, and also universities like Singapore University of Social Sciences, INSEAD, and China Council for the Promotion of International Trade. We do thrive on feedback from our candidates. According to a survey, 96.8% of our respondents gave positive feedback on our certificates. Not only that, we also keep our content up to date through our spring and autumn update of the Guarantees e-course on the ICC Uniform Rules for Demand Guarantee 758, the URDG. The International Standard Demand Guarantees Practice ISDGP is an indispensable companion of URDG 758, representing international best practices in demand guarantees. Other than the course lessons, we offer educational guides written by industry experts from time to time. These can range from topics such as trade finance digitization, reverse factoring, Islamic finance and its impact on trade, and policy sustainability in export finance, to name a few. For additional learning, you can also choose from our range of ICC's best-selling ebooks now available for purchase from the ICC Academy website itself. Some of these include Guide to ICC Uniform Rules for Demand Guarantees, URDG 758, Uniform Rules for Documentary Credits, UCP 600, and the International Standard Demand Guarantees Practice, ISDGP, for URDG 758. Also, to support you in your learning journey, we offer a podcast series titled Trade Insider. In these episodes, we explore the latest trends and best practices within the global trade landscape with industry experts and our ICC Academy alumni. Some of our topics include impact of IFRS 900 register and automation of document examination under documentary credits. Along with the podcast, we also host webinars followed by Q&A sessions on recent trade finance topics such as URDTT and ISDGP for URDG 758. Once you take our course and complete the final examination, both core and electives, within the 12 months access period, you will need to take the final examination. The 1 hour exam is live, proctored, where experienced proctors will monitor multiple test takers online from start to finish. On passing the final exams, our alumni proudly showcase their achievements, not only within their departments, but also across the LinkedIn network. As you can see from some of these clippings here, well, we are very proud of them and showcase the same. Thereafter, you can join our alumni community with professionals from more than 170 countries and network with each other. Today, in partnership with ICC Kenya, we have 2 offers for you. The first is, as members, we would like to offer you a 30% discount on both of our certificate programs, the Global Trade Certificate and the Certified Trade Finance Professionals. Something that is always saved for only the Black Friday sale. You can use the code ICC Kenya in our catalog and avail the discount. Our web address is icc.academy. And the second is we are offering 200% scholarships for our trade finance certifications, the introductory level global trade certificate and the advanced level certified trade finance professional. This is all for today. If you have any questions, please do email to me directly. My email address is priyanka.satpathy@iccacademy.com.sg. Thank you.
Thank you so much, Priyanka. Are there any questions on the chats that we might give her like 2 minutes before we let her go? You can probably pull up again the instructions or directions on how to post the questions on menti.com, and there's a code. Okay, as we get that ready, I can't see that. I need to wear my glasses. Oh, sorry. I was trying to read that far. Okay, I think this one was for the previous panelists. Is there a central body which audits sustainability linked to financing programs? That was for the previous one. Then we had another question. Although over 55% of African SMEs are owned by women, they lag behind in terms of access to finance. How are financial institutions bridging this gap? I think Odero picked on that a bit, and I think he can expound on that. We'll probably give him time on that. The next question. I think that's all for now. No question for you now. For now, Priyanka. As the questions come up, we'll make sure at least we share them on email as well as at the platform in the course of the day for you to address that. I would like to introduce now the next panel. We say today we are talking about SMEs, and we want to see from our panelists how we bridging that gap. Something that Andrew left in my mind when he was speaking. That faceless banker and the needs of the business owner. So I think the next panel will be trying to address this. How do we address access to trade finance for SMEs? And I think that will also address the second question that we've seen. A lot of businesses are owned by women. So how do we ensure, even as we do the products from where we sit, then we speak to those specific needs of the women? And I'd like to introduce the moderator who had earlier introduced, who will introduce his panel, Kenneth Miriti, the chair of ICC Kenya Banking Commission. Can take up the stage and introduce your panelists. Thank you.
Good morning once again. This is the second interactive panel discussion. and our topic is access to trade finance for SMEs. We have three panelists who are very well versed in this area. I'll introduce them in alphabetical order. First, we have Andrew Kigira, who as well you know is the Group Head of Trade Products at Equity Bank and the Vice President of the ICC Banking Commission Global. The second panelist is Dorcas Mugambi. Dorcas is the Head of Trade Finance at Cooperative Bank. Dorcas is also a trade finance expert with over 20 years experience in trade, structured trade finance. That will be useful later today. She's also started her career with KCB prior to joining Cooperative Bank, where she's currently the head of trade finance. She's an experienced guru in supply chain financing and other working capital solutions. She has in-depth training with Euromoney on matters trade finance and possesses an advanced diploma in credit risk management from Omega Credit of the UK. Dorcas holds an MBA from the University of Nairobi and a leadership training from the Strathmore Business School. She has also done training on trade policy, development from TRAPCA, East Africa, and ICF certified coach. The last, not least, panelist for this group, I'll introduce Gordon. Gordon is going to be with us online. Gordon Charlie is a global policy lead at the International Chamber of Commerce. I don't know if he's with us live at the moment.
Good morning, Kenneth. I am.
Good morning, Charlie. It is morning here. Gordon is a global policy lead at the ICC in Paris, where he focuses on policy issues linked to small and medium-sized enterprises and the digital economy. Prior to taking on this role, Gordon held several posts with the UK Foreign Office and the Department for International Trade. He's a graduate of the London School of Economics and Sciences. So to get us into this topic quickly, we shall begin with Gordon Charlie is going to give us a short presentation and address the issue of the role of ICC in addressing the trade finance gap for SMEs and the solutions available. Welcome, Gordon.
Thank you so much, Kenneth. Good morning, everyone. It's really a pleasure to join you today to discuss what is a critically important topic for ICC. Before I jump in and share a few slides, as mentioned, Kenneth, I really want to thank Kenneth, thank Lord and ICC Kenya for organizing this conference. So I'm going to try to share a few slides. Fantastic. Can you see the slides?
Yes, we can see the slides, Gordon.
I'll just...
If you can enlarge slightly.
Perfect. Okay, I'll jump right in. So before into this topic on MSME access to trade finance, and it is a critically important topic for ICC. And as the representative of the real economy and with over 45 million businesses in our network, we're particularly active in this space. And so before setting the scene, I thought I'd give you a quick overview of our work in the trade finance space. And this work is quite extensive and covers the whole range of our activities, from policy advocacy to standard setting. First, you may have heard of our annual global survey and trade register on trade finance, which provides every year an overview of the credit profile and key characteristics of trade, supply chain, and export finance. They can then help inform policy and regulatory decisions, and I believe my colleague Tomasz Kubiak will be presenting the latest iteration of that report later today. We also have an advisory group on trade finance that recently published a report on reconceiving the global trade finance ecosystem, which looks at how we can address the global trade finance gap through a digitally harmonized and interoperable trade finance ecosystem. As I'm sure many of you know, we're also quite active in standard setting with the UCP 600, URF 800, and this is the ICC Uniform Rules for Digital Trade Transactions that I believe David Anna will be presenting in due course. And then all of these insights, all of this analysis is then channeled to inform policy discussions in key international fora like the WTO and the G20. And so, for instance, just last week I was participating in the latest session of UNCITRAL's Working Group 1 on MSME access to credit. So to set the scene, I thought I'd share a few key numbers to give you a sense of the breadth and scope of the challenge that we face when we talk about SME access to trade finance. Overall, the global trade finance gap was estimated at about 1.5 to 1.7 trillion in dollars in 2019. It's predicted to grow to 5 trillion by 2025, which in effect means that many businesses struggle to access the funding they need to trade internationally, and this has the potential to really jeopardize the inclusive economic recovery that we need in order to drive renewed prosperity in the years to come. And this trade finance gap and the broader finance gap, for that matter, is particularly pervasive and acute for SMEs, which means that many small businesses are de facto excluded from the global economic ecosystem and from tangible market opportunities. And this is a critically important issue, seeing as SMEs represent often 95% plus of businesses in national economies, more than 60% of employment, and they contribute an important share of national income, particularly in emerging economies. And if you look at the Africa region, for instance, SMEs provide an estimated 80% of jobs. And there's as many as 44 million SMEs across sub-Saharan Africa alone. But while SMEs account for 90% of all businesses and jobs in Africa, they account for less than 30% of the trade finance portfolio of banks. And so the African Continental Free Trade Area might create substantial new opportunities for SMEs, but many will fail to capitalize on these opportunities if we can't solve this finance gap. And so why do SMEs struggle to access trade finance? So there's, I think, both demand side and supply side issues. On the demand side, SMEs face three types of trade finance related challenges. The first one is around access to B2B markets. SMEs are prone to gaps in working capital, often due to inflexible payment terms. SMEs are often looking for new buyers and new revenue sources, but they often struggle to gain access to new clients because of a lack of knowledge sometimes and lack of capacity. The second challenge is around access to liquidity. SMEs often lack the collateral or are unable to meet the risk assessments criteria that are imposed on them. And KYC and onboarding are often seen as big challenges for SMEs. And then the third challenge is around transaction complexity. As you all know, trade finance is built around complex workflows. It involves multiple parties, and this mechanically results in high operational and credit risks. And this is often compounded by the diverging regulations across jurisdictions. And then there's a number of issues on the supply side as well. And here our trade register is particularly insightful. I think generally speaking, challenges on the supply side can be aggregated in two broad buckets. The first one is around information asymmetries. Financiers often lack sufficient data and information on SMEs and the nature of the transactions to properly gauge risk. And in response, financiers will either outright reject applications or charge very steep interest rates that ultimately squeeze SME margins or squeeze SMEs altogether from the opportunity. And then there's a second bucket around operational costs. Financiers have to contend with some costly application processes that reduce the overall profitability of lending to SMEs. And then in response, mechanically, financiers will prefer to lend to larger firms where the margins are higher. And so the key question is, how do we address these challenges and try to bridge the SME trade finance gap? And there's obviously a series of actions that can help alleviate and address some of these challenges, and Priyanka mentioned a few previously. But one of the answers to these issues is digitization, because the digitization of trade finance processes and the broader ecosystem can really help address information asymmetries. It can reduce operational costs and ultimately lower the barriers for SMEs access to credit. And this is why we launched at ICC the ICC Trade Now campaign, which aims to leverage our network to build the business communities that can help unlock the benefits of digital intermediation in trade finance. And so by working with innovative fintechs, we can build a portfolio of tools and solutions that can address the many facets of the trade finance gap. And by bringing together SMEs, fintechs, and financiers, we can, number one, help scale up innovative trade finance solutions. We can unlock new opportunities for SMEs by working closely with our national committees and with our chambers. We can create new opportunities for financiers to service SMEs profitably. And then ultimately, all of this can help us chip away at the trade finance gap. And so far in the context of this campaign, we've partnered with 3 solution providers, Finastra, Tradeflow Capital Management, and FQX, each with their specificities. And we're in talks with many more to onboard new partners to this campaign to grow the portfolio of solutions. One example is of these solutions within this campaign is ICC TradeCom. This is a project that we're leading in partnership with Finastra to design and deploy an online marketplace that matches accredited financiers with SME buyers and sellers to unlock working capital by financing SME e-invoices. So SMEs will have a wider and more seamless access to financing from a broader set of financiers. And financiers, both bank and non-bank, will be able to more easily offer finance through TradeCom's streamlined KYC process and processing capabilities. At this stage, we've finalized the product, and we'll be launching our pilot market in Ecuador in a few weeks' time. We'll be launching the second market in 2022. And then in 2023, we plan to establish a foothold in Asia and Africa. And we believe here that Kenya is a promising market for ICC TradeCom, and we're eager to discuss this project with local stakeholders to see how we can implement this solution to support SMEs in Kenya. And then ultimately, we're aiming to deploy this marketplace in 40 countries over the coming years. But I think this is just one of many digital tools and solutions out there that really aim to address the trade finance gap. What's quite clear is that digital technologies are not a silver bullet. And I want to close by highlighting some key actions that need to be taken at a policy level to make sure that digital technologies can indeed unleash their full potential in the area of trade finance. The first point is around digital divides. The global business community continues to be marred by persistent and pervasive digital divides. Many businesses and many small businesses in particular can't leverage digital tools due to gaps in connectivity, gaps in skills. And so we have to promote universal, meaningful connectivity to ensure broad industry transformation and adoption. The second point is the fact that legal and regulatory fragmentation around the recognition of electronic documents creates significant uncertainty and increases costs on businesses, both SMEs and financial institutions. So we have to create the enabling and harmonized legal environment that can support the growth of digital trade finance. Third, we also have to promote international and interoperable trade standards to make sure that the paperless trade systems can be easily connected to one another. And we need to break down the digital silos between the component parts of the trade finance ecosystem, between the buyers, the sellers, between the banks, the shippers, etc. Fourth, it's critically important that we promote the free flow of data. We have to create that enabling environment that can ensure that the free flow of data that underpins global digital trade and trade finance. But perhaps most important of all, we need to do this by implementing multi-stakeholder dialogue and action. And this is precisely what ICC is looking to achieve across all of these areas, and this is why it's particularly important that we have these conversations today. So I'd like to thank you once again for hosting this conversation and discussion. So I'll stop there, but I look forward to the conversation with Andrew and Dorcas and answering any questions. Thank you.
Thank you very much, Gordon. Your presentation certainly resonates with all of us here, because in Kenya, the SME sector is also the backbone of the economy. And like you've mentioned, especially in the area of employment and the challenges. So kindly stay online. I'm sure there'll be a Q&A on that. And would gladly wish that Kenya can be included in the pilot for this project. Would appreciate and be honored in that area. Next, I'll have Dorcas. Dorcas, following from Gordon's presentation and from your experience in the SME sector, how do local banks respond to the need for SME trade financing, and what type of products and solutions are available?
Thank you very much. Yeah, maybe picking from where Gordon has left in terms of who is an SME, I think in most of the times you will find that we all have different definitions of who an SME is. And again, depending on whether you're a tier 1 bank or tier 2 bank or a global bank, so the definition really varies. So I will use mainly the local, definition, where we look at, the businesses that, with who go up to a certain level of trading or in terms of turnover. So if you look at who an SME is from our, perspective, an SME is that entity that, is working, to solve certain challenges within the market. And what they do, just like Gordon has said, in most of the times you will find in the process of trying to solve a problem, you will find that most of them, because they are family-based, you will find most of them are really family-based. They may not have the necessary, structures that you will find in a corporate, entity. So because of that, then you realize that for banks, it becomes very difficult, and the appetite for banks also becomes lower, because then if somebody doesn't have the right structures, then it becomes very difficult to even do an analysis. So you find the banks have very little appetite, and these are the people who really need financing, like Gordon has said, and for them maybe to boost their sales, or even for them to be able to step to the next level, or even to be able to innovate. So because of that, then as a bank, what we have done, and and in this I'm talking about all the banks, what we have really tried to do is try to look at that entity and ask ourselves, how do we then de-risk some of these entities, either through capacity building, or even through using other development partners, so that then we can be able to support them. If you look at their biggest challenge, of course, would be some of them will tell you they do not have collateral. Yeah. So as a bank, then, how do you come in to support them using the trade finance instrument that we do? And by doing this, what we have done, and you know, this is also happening across the banks, is you will find that we will be able to finance this entity by maybe requesting them just to do a small contribution, while the bank seeks for a partner who can also de-risk part of their risk, so that either we can do a 50-50, we can do a 30-70%, and out of that, then we are able to support the SME. The other bit, which is also very critical, is the fact that you know, you will also find you have some customers who you can actually be able to do some solutions that will not necessarily call for traditional collateral. And that is where maybe the structured finance comes in, where we are able to look at the underlying transaction or the underlying commodities, which now we convert or we utilize as our collateral to be able to finance the transaction. So these are some of the things we are doing. Of course, you will also find most of them operate within an ecosystem, a supply chain ecosystem, where, for example, a customer is in trading and they are dealing with the various partners. Either they require suppliers, then we bring in supply chain, where we are able then to support them either backward or downwards. That is using distributor finance for their distributors, or supply finance, where we are again able to support them so that they can be able to stock appropriately, or they can actually be able to do whatever supplies they may want to do. So those are some of the interventions that we have seen most of the banks do, and of course ourselves as Cooperative Bank. And you know, even looking at one of the questions that you know had come through from the screen earlier, where somebody talked about if you look at the kind of SMEs we have currently within our ecosystem, you'll find that 55% of those are women-led businesses. And of course, you will find that most of these women are people who may not be able to raise the necessary capital, maybe to be able to do business, or they are not able to have the right stock in place, or even where they want to invest in plant and machinery, then it becomes very difficult for them. So what, again, we have done in that area is to look at that entity and ask ourselves, how do we support such? And where then we have had challenges by saying that we have not been able to maybe finance them because they don't have collateral. Again, we have partnered with the likes of AGF, that is African Guarantee Fund, USAID, and other de-risking entities, where we have been able to go up to 75% coverage, and you know, the sponsor then just contributes 25%. And this really has supported that, that business because then we have been able to support such businesses to grow, and even so that we can also bring sustainability, what we have had before, that we need to bring inclusion into it. And out of that, then we are also able to support the women. Thank you.
Thank you so much for that, Dorcas. It seems the SME sector needs have been identified as a unique sector with special requirements. Perhaps the area is how to bridge that gap. Andrew perhaps can share on how the local industry is responding to the needs of the SME sector in the area of financing and product solutions that may be available. Thank you, Andrew. Welcome.
Yeah, I think I want to take a slightly different angle to this. From my own perspective, I think one of the challenges that we do have is the trade practitioners ourselves, I think, in terms of pushing trade facilities within the bank. And I'll tell you why. A lot of the systems that have been put in the financial institutions are based on debt models, lending long-term loans to businesses, and that has informed the credit models that sit within the financial institutions. Now, if you look at trade finance, we say trade finance is short-term self-liquidating structures. So we should be able to push through transactions within the system by trying to put in trade standards that, trade finance credit standards that then the bank can adopt. And that, I think, is the biggest issue we have in terms of supporting any type of business, whether it's SME or corporate, whenever it comes to trade finance. I'll give you a good example. So for today, if you buy raw material X, add value to it and sell it at a margin, at that point at gross profit level, you should always be able to pay back a trade facility. Because effectively, trade only gives you funding to purchase either raw material or whatever, then sell and immediately make a profit and then pay back trade. But what you will find in the institution is that a lot of the credit models are made at much lower levels of the P&L, which is the EBITDA levels, arguing the way the client cannot be able to pay a trade facility because maybe his profitability is not as much. But remember, he bought, added value, sold, so immediately he paid me back. And I think that is one of the major challenges I see when it comes to innovating or trying to support SMEs that have low profitability margins and are struggling with collateral. But take that now into context and try and see some of the solutions that I personally have seen guys trying to innovate. So we've seen, for example, organizations now trying to look at turnover loans. I think I have seen one of the competitors in the market selling turnover loans, which run on a monthly basis. So I found that quite innovative by looking at just the SME and saying, these guys in a month have a turnover of 500 million, or 500 million maybe doesn't make it an SME. So maybe say 10 million is the monthly turnover of whatever business they are selling, and therefore I, as a trade finance practitioner, can provide working capital up to a percentage of that monthly turnover. As opposed to focusing on the total financial, annual, P&L or financial statements that we get. And somehow you can sell that within the credit team, and somehow it passes through, because you're just saying, look, the client can buy, sell, and within the same month generate this amount of money. For sure, I will be paid back. And that probably tries to mitigate some of the risks that the SMEs are struggling with of lack of collateral. The other thing I've also seen is trying to innovate around existing products. So we have the usual letters of credit, we have the usual bank guarantees, we have the usual vanilla products. And I have seen some organizations or some individuals in the market who've come up with some. I think 2 years ago, I think the UPAS letter of credit showed up. I personally thought that was somebody who really thought it through. I think for the ones who know about the UPAS LC is usance payable at site. So an LC that incorporates both site payment and credit payment within the same letter of credit. It is not covered in the rules. There is no recognition of the UPAS LC. However, the terms of it, which play a part, somehow work. So for the SME that has been required to pay at site, are still allowed to pay at a later date, while the supplier receives payment at the site stage. So some of those things I think come into support. Back-to-back letters of credit, I think that has become a big deal. When I joined banking in the organization that I did, I think you guys now know, it was a taboo to talk about back-to-back letters of credit because of bad experiences I think the institution had had previously. But I think once I joined the local banks, I realized that the local banks have perfected the art of back-to-back letters of credit as a mitigant to try and support SMEs. So long as the SME has a letter of credit that they have received, say from, Kenya Power, for example, and they need to supply, then the bank can use that letter of credit as security to issue a second letter of credit without demanding for additional tangible security. It's not as straightforward as it sounds. It needs a little technical expertise. But I think the idea is that if the trade practitioner is up to the salt of trying and learning and researching on this until you perfect, then you should be able to sell the back-to-back letters of credit to risk teams and somehow get it over the line. It's not easy, but it can be done, and I've seen it being done, especially in the local institutions. The other thing that I've also seen, surprisingly, is the re-emergence of Red Cross letters of credit. I think that re-emergence has shown up in the last, 1 month. So there's a bank that has issued one. I won't take credit, it's not me who issued it. But I saw it, and it was, in my entire trade career, I've never seen a letter, we read about it, but we never saw any. But for one reason, somebody has issued it. I think one of you here knows who they are, but I've seen it. And I was so, it got me out of, I wasn't expecting it until I had to call the particular institution and ask, so how did you guys, or why are you guys doing this? And this is the explanation I got. Now, Red Cross LCs allow for the beneficiary bank to finance the supply. That's what they allow. So it means that the risk has basically been taken by the issuing bank, and they've given me the authority to finance the supply of that letter of credit. Now, the applicant of that letter of credit is a large corporate, and the supplier is an SME that I am banking. So what this bank has done, or in conjunction with the large corporate, is that they've sent me a letter of credit and said, you can actually use this letter of credit to finance this SME client, and we are taking the risk. So give him pre-shipment funding, let him buy whatever materials he requires, and once he then supplies, then you can deduct that from the proceeds of the letter of credit. Now, personally, I sat and I said, you know what, I think there are guys in this market who are overthinking. and some of us are sleeping. But it just shows you innovation, and I think that is part of the things that I'm seeing, that using the existing trade products to try and innovate and come up with solutions that are basically out of the box. And I think that is one of the areas that I see. So, yeah, thank you.
Thank you very much, Andrew, on covering that area. Just before you end up, a quick, something has also come to mind, because now we are strong on innovation to meet the needs, the unique needs of the SME sector. And on the local scene, we also have innovation, where you have the underlying trade transaction being the security for the facility. In other words, we are creating a dichotomy between credit and trade financing. On the local scene, we have examples like the warehouse receipts, which is a big area. We also have LPO financing, where LPOs issued by, let me use reputable, the criteria differs from organization to organization. So LPO financing, warehouse receipts are part of the innovation that you can see the Kenyan economy and the Kenyan financial industry is getting into. Maybe you'd like to expound a little bit on that, Andrew, and then Dorcas, or Dorcas, then Andrew. Thank you.
Thank you. Yeah, indeed. When we talk about the underlying transaction acting as a collateral. I think we've seen a lot of that, especially in the commodity market. And here I'm talking about, the likes of whether you're talking about cereals, whether you're talking about coffee, whether you're talking about tea, where the underlying transaction, that is what you use as a bank as your collateral. So all the SME needs to do is come up with a contract between themselves and the buyer. It could be a local buyer, it could be an international buyer. And, the fact that they are not able maybe to facilitate that trade because of financing, then the bank comes in to support. And all we do is take that as our collateral or as our security. So as long as a bank is comfortable with the risk in terms of what is the underlying contract, are we able to determine when we are going to receive the payments? Are we happy with the counterparty? Are we happy that, we can be able to do the logistics? Then we can actually be able to do what you call commodity finance. And that's where now you will find we will bring in collateral managers and even our partners, mainly in the room, the League of Fraternity, to support especially in documentation, because there again, you will require tripartite agreements between the three parties, that is the bank, the collateral manager, and of course now the SME, because here we are taking care of the underlying commodity. So you have to take control of the goods from the warehouse until the time they get to the final destination. Because if you lose track of that, then the entire collateral, then as a bank, then you're left with nothing. That is one. Of course, the same also applies to other commodities. Then when we come to the warehouse receipt, thanks Meriti for this, I think this is one of the very, very latest maybe innovations, I would say. It is, of course, something that has been there in the longest, but we have not been able, as a bank, been able to do real transactions on this. One was because there was no legal framework around it. However, that has already been done. What we are now grappling with as as the banking industry is being able to maybe get the right warehouse owners, people who you can be able to trust with your goods. The other big challenge that we are having is being able to determine the price, because remember, some of the products that we will be dealing with, and of course the common ones within the market are the likes of cereals like maize, wheat. So where do you get, an index price, a price that you can actually be able to refer to? And because this keeps changing, of course, we will require a lot of goodwill, especially from the government, because things like maize, today you could take in maize at 4,000 or finance maize at 4,000. But as we get closer to the election, that maize could even come down, depending again on what whoever wants to achieve. So those are some of the challenges we are having, and I'm sure once we are able to address that, then warehouse receipts will be something that will really support some of the customers that we see. I don't know if I've addressed all. And yes, there's also the LPO financing. LPO financing, this is maybe the concept that Andrew was trying to put across. Invoice and LPO financing. The difference is that whereas in invoice discounting, you've already addressed the performance risk of the MSME. On LPO financing, you're lending the SME money to go and perform whatever it is they need to perform for them to be paid. But in invoice discounting, the SME has already performed, they have already delivered to the institution. all they will be waiting for is for payment. But because sometimes they are not paid this money immediately, they are paid maybe after 90 days or after 120 days, the bank comes in between to bridge that gap. So the bank pays the MSME, provides money to the SME as they await for the receivables, that is the payment after the 90 days. In LPO financing, as I said, you're financing the SME to go and buy whatever it is. It could be the MSME has gotten a contract with a hotel to provide water, to provide, drinking water. So you give them the money so that they can go and pay for that water and deliver. So there's a bit of performance risk there, which we normally have to take care of, whereas that is not the case for invoice discounting. So what we do as a bank, of course, is to try and determine who is the SME. Is it an entity you're happy with? And if you're happy with the entity, then it becomes very easy for you then to be able to go ahead and finance them. And that is where now the innovation comes in, where Andrew was saying that, we are now seeing situations where if the if the off-taker, that is the person who is, taking over the goods, is happy and they can actually be able to vouch for the SME, then it becomes very easy, because all I'll do is that I'll give the money and hope that, the SME will deliver. So those are some of the things maybe I can touch on, and maybe Andrew, if there's something I've left out on, you may want to add on that. Okay. All right, thank you.
Thank you so much, Dorcas. Andrew, do you have a word or two to close on that?
Yes, so I think Dorcas has covered it quite well, quite elaborate. I don't think there's too much to add. The only thing is that, I'm usually a fighter of credit risk, so I'm always bashing them. So one of the things I've told credit risk is they need to be clear whether performance risk means diversion risk. They need to separate the two, or whether they are talking about integrity. You see, so is it integrity of the client, or are we saying he can't perform? I think taking from the example that Dorcas has given, if the SME has one contract to supply water, every time they say performance risk, then I ask, what is the complexity of that performance risk? If they are buying from Kenneth and delivering to Dorcas, then I don't see the complexity of that. It's very straightforward. But if you're saying you do not trust the customer to buy from Kenneth, then you need to put it across that is what we are fighting about. Because we all worry about diversion risk, but that should be said that we don't trust that if I give Kenneth the money, he will never, or Dorcas for that matter, he will never do it. So sometimes the word performance risk is thrown around by risk, and you get stuck. So I've always been very clear that I need you to say it publicly, that this client, I don't trust him, so that we know what to deal with, Otherwise, you just go round in circles and don't get a resolution. So I know what Dorcas is saying. So the bigger issue is, how much do you trust the client? And what is the integrity of that client? How long have they done business? Are they on CRB? Are you getting any negative news about them, to an extent where you do not believe that if you fund it, then they will not deliver and your money won't come through. So that's one thing. The other thing is that, can you then mitigate a situation where you don't trust? Is there a way to mitigate? So if you tell me clearly, we don't trust the customer to do it, then how do we mitigate? So do I then pay the supplier directly? Do I engage the supplier of my client and ask him, look, if I pay you for this water, can you then deliver it to Pan-Afric Hotel such that the performance has already happened and I don't need to worry on whether Kenneth is going to buy the water or buy a plot? So that's the issue. So even as you're discussing with risk, my issue to them is, please state what the issue is. Otherwise, performance risk is a very wide word. So if the guy is in manufacturing and the contract is very large, then I could argue that he may not be able to meet the order. But if it's a simple stationery, buying stationery and delivering, then what are we talking about? And I think that is where there's a big issue. Now, on the issue so there's a law that came in, I think, about 2017 on Movable Property Security Act that's supposed to give us the ability to take movable property as security. I personally think that law was very instrumental in advancing trade finance, but I don't believe we have used it to its extent. So whenever you go to the legal fraternity, they'll tell you the law is there, and indeed you can't register rights over property that belongs to a certain entity, whether it's inventory, whether it's receivables, and or whether it's any of their assets. It can't be registered using that law, and you can use that as security. But I think we, as trade practitioners, need to exert that law a lot more, because if you don't bring it up, then remember, they go back to the usual debt, any floating security they don't look at it as security, yet it is. So today, if you're funding some of the agro-processing guys, one of the requests, which I'm sure you always get, is, and probably picking from Docas, is we want to buy maize during the season, and this maize will then be processed into flour as the season progresses. But the season for maize is only now, so I need to purchase a lot of tonnage now and then continue processing my flour over the next 3 or 4 months. So can you give me money, and you take hold of the stock, and as I process it, then I'll keep on paying for it over the next 3-4 months. But you will still find risk stuck on the fact that they still want the factory as security for that short-term 3-month transaction. So you need to be able to, maneuver around that, figure out that, look, one, the maize is not going to be there in the next 1 month. Can it be stored very well? Destruction of the commodity, is it insured? What are the margins of converting maize into flour? So how much margins is a guy going to make? So those kinds of things will then allow you to push your transaction through risk, and still be able to register the security under the laws that have been put in place. So that's how I look at it, Chair. Yeah.
Thank you so much. This is a very interesting topic, but we've run out of time. I'm sure the complexities, if Ken was sitting in Russia or Sri Lanka and he's your client, the complexities become more complex on international trade. And we in ICC Kenya will then partner with the ICC, the solutions that Gordon has proposed to be able to facilitate some of these transactions. I think we'll close if there was one Q&A just before we started our program. Mary, if there are any questions on the screen?
I think Dorcas had touched on one of them, which was on financing to women, which also just touches on SMEs as well, and I think she's touched on that. I'm seeing a question on the screen. You can see it, Kenneth?
Yes, I can see the question. I think that would touch, on the next presentation, the URDTT rules.
Yes, so David will cover that.
Yeah, he'll have that.
David will cover that.
If there's nothing else, any other question, then we can wind up on this session. Are you taking questions from panelists, or is it only on screen?
Only on the screen.
Okay.
We are going digital. We are saying one of the issues that we are trying to address as we create sustainability in trade and serving our customers is going digital. But I can see somebody who has a very burning question. I'll allow that one.
Thank you for the flexibility.
then next time, in your next ICC meeting, trust me, we'll adopt your suggestion 100%. Thank you.
Thank you. Somebody spoke about political will. So I think I will implore on all of us as we come to the next conference, at least we can be able to adopt a lot of digital. So can I take one question? One question. Any burning comment, question to the panel?
Yes, we are being innovative now, thinking on our feet. Kindly, some will give you a microphone so you can introduce himself and ask the question.
So in as much as we are looking at structured trade products and short-term financing against cash flow, I think as banks, that question of security always arises, and I guess that's where credit risk comes from. So I don't know, through the ICC or whichever other body there is there a way to perhaps streamline that issue on debtor days? And obviously Nakumat, etc. So
I think that is the question. I think it's not just a question, it is the question. Remember, debtor days is what pays everything. Debtor days pays trade facilities, debtor days pays bank loans, debtor days pays salaries, debtor days pays utilities. So if the debtor days are elongated and they keep going out of control, I don't even think it's a problem of trade. It's actually a problem of the entire business. It's unsustainable. So having said that, I think one of the things that the banks have tried to do is to really keep an eye on debtor days to make sure that they are not getting out of control. I think businesses have now become debt collectors. I think that's the business. Competition has played a big role on it. And organizations, especially the larger organizations, using debtor days for financing working capital. So if I can finance my working capital using my suppliers, then I do it. Now, earlier we talked about sustainability. Remember, that was one of the conversations. How sustainable is it? So those are some of the things that will come through sustainability. You cannot honestly mistreat your suppliers to an extent where they are shutting down. And then that cycle continues. Because remember, once you do it to the suppliers, they do it to their suppliers and goes on and on. Now, a few years back, I think one political party had tried to introduce a cap on debtor days. The law never saw the light of day as far as I'm concerned, if I remember. But I think in the UK, they have tried to do it. So they've said, if you promise to pay by this period, then you can't go beyond that by a certain period of time. I think the country has tried to make it illegal to bounce checks, all in an effort to try and rein in this debtor business. So today, if you give a check, a post-dated check, for example, and you present it, it's a criminal offense if that check bounces. So in a way to try and probably tell the business communities, try and take checks. You'll find the guy really calling you to try and make sure you don't deposit, a check if there's no money in the account, because he knows it's become a problem. We have seen factoring becoming a bigger deal. It's not strong in our markets, where you basically sell the receivable and the person who now owns it does not have a very tough relationship, does not really care about the relationship with the client. So he can push him Because the challenge with business is you want to push for data to be paid, but you don't want to destroy the relationship. And you can only extend it long enough. So for the banks, they'll obviously give you invoice discounting. But the question has always been, how long can you continue extending it until it's no longer viable? The cost of it, basically clears out your margins. So yes, so one, I think my view is lately, please accept checks. I just insist on checks. They give you some level of comfort. Number two, you have to do sometimes what the banks do, which is once it gets to a certain capping, you have to stop. So you cannot continue supplying up to the extent where you purely can't run your business just to save the relationship. But hopefully, depending on the next government, the law on debtor days might come out. I think government is one of the largest culprits. And then that trickles down to every other sector. Because if you remember, there was a time we had a big issue where if government had not paid suppliers and the entire economy was struggling. And then the day they released funds, then, yeah. So it's tough, and I know it's tough on businesses. I don't have a proper solution. We can fund you, but obviously we can only fund you at market rates, which after some point then they become expensive, and it eats into your margin every day. So I think unless we legislate it, and then probably you just tie in your relationship and sustainability, there is very few ways. The other way probably is to get instruments. It's not easy, but sometimes when you have bank instruments that are running on your contract, then sometimes they help. So if you have, promissory notes or, bills of exchange, which the bank can guarantee, it becomes easier. But I know to the normal flow trade of every day, then the instruments don't really work because it's open account trade and you can't really ask for an instrument for everything. We've seen a new innovation on bank guarantees, which I had not told you guys earlier. So we've seen situations where suppliers are asking they've always been asking for bank guarantees as a security for them to offer credit. The problem is the bank guarantee is a stationary instrument. It just gives you it's like a title deed. So you get a bank guarantee, then you keep it in your drawer, and you only use it when there is actual default. But there is a new type of guarantee we've seen, which behaves the same, but somehow allows the beneficiary of that guarantee to draw working capital out of it, and it's not a default. You see, so the guy goes to the bank that issues a bank guarantee and says, I have a security from your customer such that I supply him on credit, but on this side, I have invoices that he owes me that he's supposed to pay in 60 days, and I'm tight on working capital. Can you give me a portion of this, 50, 60%, against the same bank guarantee? Because either way, if he doesn't pay me on due date, I would have claimed. So the logic makes sense. The practicality of it is what banks are still, as usual, we have to think it through. But personally, I think it is doable, and especially for large contracts where you find there is a payment guarantee of, 300 million. I'll give you examples for like guys who supply tires. So the guys who supply tires, you can find a bank guarantee of $3.5 million. Now that is a large amount. So if this guy is getting supplied tires of 100 million, there's a guarantee sitting in a desk for $3.5 million, then he can come to the bank and say, give me some working capital against the fact that you've issued me a guarantee against this invoice. And in case there's a default, then we would claim on the guarantee anyway. So there's such stuff that seem to, to be trying to sort out the issue that you're raising.
Okay, thank you so much. I think to wind up, perhaps, Gordon, maybe perhaps a minute or two, having had the local perspective you could give your input from ICC on the local marketplace and the challenges for a minute or two, then we wind up. Gordon?
I think he's left the meeting, actually.
He's left the meeting. Okay,
Yeah.
I think that winds up for this panel discussion. Thank you so much.
A big hand for the panel. Thank you very much, but you'll still tell us a story, maybe over the lunch, why we had a collateral in fuel which went missing and landed the country in big problems and making the risky people more riskier. And when you take a request, you have to explain, how did fuel disappear? We can have that conversation over lunch. I would like to introduce the next speaker, David. David is currently the Global Head of Trade and Supply Chain Finance at Intellect Design Arena and is a part of the drafters of the URDTT Rules 2022. I think the person who was asking the question must have read this profile. David has 25 years experience in banking, and he worked in France, Belgium, Germany, and is specialized in payments and cash management. And he was credited with having launched the world's first international direct debit service. He later joined other companies where he drove Swift for supply chain strategy, which eventually resulted in the launch of the ICC Bank Payment Obligation. He is the author of ICC Guide to the BPO, and he's also been a member of the World Trade Symposium and World Trade Board, where he co-chaired for 2 years. And most recently, he acted as a co-chair in ICC, drafting the group for URDTT. He's an ardent supporter of Arsenal football. That's where we fight. David, Arsenal, you have many fans in the room. He's also done 3 London marathons. I don't know whether he came close to our own marathoners, but he's welcome to come to Kenya to train with our own marathoners. He's going to be speaking to us on digitization in trade finance. So welcome, David. You can take us through your presentation.
Thank you. Thank you very much for the kind words of introduction. And good afternoon, everyone. And also thank you very much for the kind invitation to speak to you today on the subject of the URDTT. I'm very sorry I can't be there in person, but actually the good news is that I shall be there next month. I'm attending and speaking at the GTR East Africa event in Nairobi. I think it's June 21st and 22nd. So hopefully I shall get to meet some of you in person then. And I don't think we'll be indulging in any marathon running, but please do come and say hello. For those of you not familiar with Intellect, Intellect is a financial technology company, so-called fintech. So we build software solutions for banks, including a combined platform, a digital platform for trade finance and supply chain finance, called iColumbus.ai. So we will be showcasing that at the GTR event next month. So as I say, please do come and say hello. Right, I'm conscious of the fact that we're running a little bit behind schedule. So I have had some bandwidth issues this morning, so I'm not going to share my video while I'm presenting, if you don't mind. I'll just stop the video and then I'll share my screen. I wouldn't want the thing to break down during the presentation. So let me just try and share the screen. Okay. Where are we? Oh, wasn't meant to do that. Okay. All right. Let's crack on. Okay. So I thought it might be a good idea to start with a reminder of why we need digital rules and practices. Obviously, digitalization is very much top of everyone's agenda. It's been a long time coming, but particularly in the wake of the pandemic, there's now a substantial awakening towards the power of going paperless and the drive towards digital. Trade has certainly come a long way from the use of stone tablets in ancient Babylon 5,000 years ago, through centuries of processing paper, to the age of digital, which is all summed up by the simple phrase on this slide. We've left behind the game of rock, paper, scissors, and we're now playing a new game called rock, paper, digital. And here we can just have a quick look at some of those evolving technologies. First of all, I think it's fair to say there is a widespread recognition of the business benefits of paperless trade, not only to reduce the risk of delays and discrepancies, but also to support the increased availability of machine-readable data. We've got next-generation technologies such as artificial intelligence, which will undoubtedly enhance the efficiency and productivity of performing what are otherwise highly labor-intensive tasks, such as document processing and compliance checks. Machine learning, natural language processing can also be used to automate a whole range of processes around due diligence, including regulatory compliance. Then the Internet of Things. There's a lot of interest now in the evolution of track and trace devices that enable us to monitor the location and condition of smart objects in transit, reducing the operational risks which are traditionally associated with the transportation of goods. We can use smart objects not only to track the whereabouts of a container, making sure it hasn't been lost or damaged or been diverted to a watch-listed port, but also to monitor the condition of the goods inside the container, for example, perishable goods that need to be stored and transported at a specific temperature. And what may eventually be even more interesting is the ability to extend this technology back into the supply chain in order to guarantee the provenance of goods at source in support of sustainable trade. Business intelligence and data analytics. Obviously, banks need to leverage big data in order to better understand risk, operational risk, market risk, industry risk, customer risk, and open up new opportunities for growth. This is especially true as banking becomes more and more commoditized. And then we have API-based open banking, which is a transformational change. All of these emerging technologies are designed to address the long-standing issues which have made trade finance a time-consuming, labor-intensive, operationally inefficient business to run competitively. And just to reinforce these messages, perhaps this is a slide I came across a while ago. It's an extract from a World Economic Forum white paper on trade technology. And I rather liked it, as it not only demonstrates where and how different technologies can be applied across the transaction life cycle, but it's very consistent with how this landscape is evolving in practice. For example, extracting contextually relevant data from bundles of unstructured, semi-structured, or structured sources, using a combination of artificial intelligence, natural language processing, deep learning, and optical character recognition to validate data and perform compliance checks. This is something we at Intellect are doing ourselves as part of our iColumbus.ai value proposition. Then advanced analytics to support enhanced KYC and informed decision-making. And many will see the Internet of Things and the use of smart objects for track and trace as being mission critical going forward. And of course, many will see distributed ledger and smart contracts as having the potential to streamline business processes and enhance operational efficiency. So I think this analysis is a pretty accurate reflection and endorsement of where the market as a whole is going with all of this. And at the same time, the regulatory environment is changing, and it's changing largely as a result of the new technologies that are reshaping our industry. It is true that as an industry, the adoption of digital technologies has to some extent been hindered by a lack of certainty surrounding rules and standards. But we now have a growing number of industry initiatives currently in play that I'm sure will enable us to overcome the obstacles. So, for example, in parallel with the launch of the URDTT and the e-rules, the ICC has, of course, also set up the DSI, the Digital Trade Standards Initiative, to support interoperability across platforms. And at the same time, the ICC is encouraging widespread adoption of the UNCITRAL model law on electronic transferable records, the so-called MILITA, to help overcome the barriers to trade document digitalization. And then there's a host of other industry initiatives, the ITFA DNI, Digital Negotiable Instruments, the Electronic Payment Undertaking, EPU, BAS, Digital Ledger Payment Commitment, DLPC. I think it's also worth mentioning the availability of the CMATCH platform, which continues to provide support for bank payment obligations, and even the SWIFT SR21 messaging changes for guarantees and standbys, which came into force last year, will deliver more structured data in support of enhanced data analytics and business intelligence. So there's a huge momentum gathering here to overcome the barriers to digitalization and eventually open up the path to paperless trade. Okay, so now let's turn our attention to the most recent development in the e-rules, the URDTT, the Uniform Rules for Digital Trade Transactions. So first of all, a few words regarding the scope of the URDTT. These rules are not designed to replace existing rules, but rather to be complementary to those rules. And it is particularly important for the rules to be compatible with the model laws which have been established by UNCITRAL, United Nations Commission on International Trade Law. These model laws have been introduced by UNCITRAL with a view to harmonizing national laws and ultimately facilitating global harmonization and interoperability. So probably the best known of the model laws is the model law on electronic transferable records, MILITA. This is a law that is designed to support transferable documents and instruments in electronic form, including bills of lading, warehouse receipts, bills of exchange, promissory notes, and so on. Most importantly, it supports the notion of possession in an electronic environment. And currently, there are several jurisdictions which have enacted the MILITA. In May 2021, the G7 announced its commitment to promote adoption of the MILITA. Most recently, as you may have seen in the UK, the Law Commission was tasked by the UK government to make recommendations to enable the legal recognition of trade documents in electronic form, as a result of which the Law Commission published its Electronic Trade Documents Report and draft bill in March 2022, and that bill has now been placed on the legislative agenda for the year ahead as part of the UK government's plan to prioritise the growth and strength of the economy. And this is seen as a particularly significant step forward, given that a vast majority of global trade transactions and shipping transactions follow English law as a basis for contract law and for handling trade documents. So I think I'm heading off the question that I saw on the screen before I started the presentation. I keep being reminded of going back to the subject of running. In the year 1954, a man called Roger Bannister, I'm sure you know this, was the first man to break the barrier of the 4-minute mile, which was a milestone, if I can use that term, that broke down some of the psychological barriers associated with all of that. And I think the passing of this bill in the UK, similarly, is a milestone. It's a watershed moment that will break down not only psychological barriers, but also bureaucratic barriers, regulatory barriers, legal barriers to digitalization across many key centers of trade around the globe. Because after all, there are, again, some 54 countries which share with the UK, former members of the Commonwealth, which share with the UK a common legal background and are likely to see a change in English law as a signal to adopt similar provisions because the same considerations will influence how legal change will be put into effect. So there's certainly a huge momentum gathering here for the widespread recognition and legal acceptance of documentation presented in electronic form, which in turn will speed the digitalization in trade finance. A second thing to note here about the URDTT, which distinguishes the URDTT from the EUCP and other e-rules, is that the URDTT are intended to be used in an environment that is entirely digital. Okay, that is to say the transactions governed by the URDTT must be fully digitized, fully paperless, end-to-end, from the point of initiation to the point of settlement. And in these conditions, electronic records that comply with the DTT, the digital trade transaction, will serve as evidence of the underlying sale of purchase of goods or services and the incurring of any associated payment obligation. Now, I'm going to dwell on this slide a little bit longer. A couple more things to note, which perhaps distinguish these rules, for example, from the URBPO, and this might be heading off some other question that might come up. Some of you will know that the BPO, the bank payment obligation, is widely considered to have failed for a number of reasons, including the mandatory use of a single technology, which was originally the SWIFT TSU, and the mandatory use of ISO 20022 messaging standards. And secondly, the fact that the payment obligation itself was a bank payment obligation, obligating one bank, the obligor bank, to pay another bank, the recipient bank. Under the URDTT, it should be noted that these rules are technology agnostic, so you can use whatever platform you want, and you can use whatever messaging standards you want. Nothing is mandated. And secondly, the payment obligation is a corporate obligation, representing an obligation of the buyer to pay the seller, subject to the fulfillment of the contractual conditions, and which may be reinforced by something called FSPPU, a Financial Services Provider Payment Undertaking, which we'll come on to in a moment. So one might say that some of the perceived weaknesses in the BPO and in the URBPO, which to some extent may have prohibited traction and widespread market adoption of the BPO, have been directly addressed by these material changes in approach. And what I would also add is that these rules are radically different to any other set of rules previously published by the ICC. Not only are these the first set of rules to govern an entirely digital environment, but they are also the first set of rules to recognize the role of the corporate, as well as the role of the growing number of non-bank providers of financial services who are increasingly active in this space. Now, I've already mentioned that the URDTT are not designed to replace existing rulebooks. There are, of course, a number of platforms such as Marco Polo, We.Trade, which have their own rulebooks and their own interpretations of payment obligations or undertakings. The URDTT will not prohibit the ongoing use of those rulebooks. The URDTT are designed to overlay these other sets of rules and to provide a common framework under which other rules may coexist. In particular, the intention is to avoid the repetitive use of those terms and conditions in individual rulebooks, which can and should apply to all rulebooks. By fostering an alignment of legal frameworks, the intention is to encourage competition across financial service providers, particularly when it comes to the provision of risk mitigation and financing services. So here's a little break from peppering the screen with words and to give you a high-level overview of the process for a digital trade transaction. And later in the presentation, I will endeavor to bring this to life a bit more with a few use cases as they may apply to the world of supply chain finance. So in this example, we have a Kenya importer of machinery from India. So there will first of all be an underlying contract between the buyer and the seller, which ultimately will be satisfied by contractual performance. And within that contractual agreement, there needs to be a reference to the fact that the buyer and the seller agree for the transaction to be conducted making use of electronic records, and that the transaction will be subject to the URDTD version 1.0, being the version of the rules that is currently in force at this time. Now, if the agreement includes a payment obligation, that is an obligation for the buyer to pay the seller, that obligation will initially be conditional upon the fulfillment of contractual obligations as evidenced by the submission of electronic records. And it is possible then for a financial services provider, which could be a bank or a non-bank, to add its payment undertaking to that conditional payment obligation. And as the transaction progresses to the point where the electronic records required under the terms of the DTT, the digital trade transaction, have been submitted in strict accordance with the terms of the DTT, so the payment obligation and any associated FSPPU, financial services provider payment undertaking, will eventually become unconditional. So 2 points to note perhaps. First of all, that the payment obligation and any associated FSPPU are inseparable at all times. They go hand in hand with one another. And secondly, both the payment obligation and any associated FSPPU are separate from and independent from the commercial contract itself. What causes the payment obligation and FSPPU to crystallize is the submission of the electronic records in accordance with the terms of the DTT. Now, here's a quick summary of those data elements that would typically be required for inclusion in the DTT. First of all, the DTT must specify which version of the URDTT would apply. And as I mentioned today, it's version 1.0. Second, the DTT must make use of electronic records to evidence the underlying sale or purchase and any associated payment obligation. The DTT will specify the conditions under which the compliance of an electronic record will be determined. It will specify what records have to be submitted, by whom and when, and it will also specify the applicable law. What's important to understand here, I think, is that the digital trade transaction is not a single event. It is a process as agreed between the buyer and the seller, and the process needs to be sufficiently well defined so as to be able to determine the compliance of the electronic records submitted. And the terms and conditions of the digital trade transaction must also be incorporated into the terms and conditions of the payment obligation. Article 12 of the URDTT specifies details of those data elements that must be included in the payment obligation. These include a unique identifier, currency and amount, the latest date for submission, the payment terms, and once again, the applicable law. Now, we've spoken a lot about electronic records, so here are just a few words to help with the definition and interpretation of what constitutes an electronic record. The first thing to note is that an electronic record must be capable of being authenticated. And what level of authentication and security may be required is a matter for the involved parties to decide and agree. Second, it must be capable of being examined. So the record must be presented in a format that can be consumed by a data processing system. And again, the format used is to be agreed between the buyer and the seller. The rules do not mandate the use of any particular format. The word format can be used to refer to a standard or a protocol or any means that allows one application to talk to another application. Obviously, careful consideration needs to be given in all cases to the presentation of data in a format that can be consumed by a data processing system. So it is essential to ensure that the necessary technological and operational capabilities are in place. So here, we're referring to the role of the financial services provider, the FSP. And remember, we've adopted the term FSP to allow for any provider of financial services, be it a bank or a non-bank. So the role of the FSP may be threefold. First of all, FSP can provide risk mitigation or financing services to a beneficiary or to a buyer or to another financial services provider, FSP. Secondly, an FSP will typically be responsible for effecting payment to a beneficiary. And third, if requested to do so, a FSP may add its FSPPU, Financial Services Provider Payment Undertaking, to an existing payment obligation. And where a FSPPU exists, the buyer remains liable under the payment obligation unless it is otherwise agreed by each of the principal parties, the buyer and the seller, and any other beneficiary. If a financial services provider is requested to add a FSPPU to a payment obligation, but is not prepared to do so, it must inform the requesting principal party or any other beneficiary straight away. Also, it's possible to have more than one FSPPU in support of a single payment obligation, in which case each financial services provider will be severally and individually liable to the extent of its own undertaking. Technology, as we've already mentioned, the rules themselves are technology agnostic. The parties to the transaction can adopt whatever technologies they wish, as long as those systems are capable of examining and authenticating records. Obviously, systems must be maintained and kept available at all times, the only exception being a possible force majeure, we've heard that term already today, in which systems become temporarily unavailable. And this is provided for in the rules. In the case of a force majeure, a buyer that has incurred a payment obligation or a FSP that has incurred a FSPPU will remain liable upon resumption of its business to fulfill any obligations that may have become due during the unavoidable interruption to business. A few words on legal implications. As mentioned, applicable law will be as specified in the terms and conditions of the digital trade transaction. And the URDTT themselves will act as a supplement to those laws. Again, coming back to the question that was on the screen before I started presenting, will act as a supplement to those laws insofar as they are not prohibited or in conflict with such laws. So in the unlikely event that something in URDTT is prohibited under the applicable law, then URDTT would become null and void since it would be unenforceable. And it's possible to change the applicable law by mutual agreement. As with all ICC rules, applicable law will always prevail. Okay, coming to the end, as I promised, I'll just present one or two use cases here under supply chain finance by way of illustration. Before we get into the illustrations, just a few words of background perhaps. So Personally, I've participated to the URDTT drafting group that has been responsible for drafting the rules, which have now been approved by the national committees and have therefore been officially adopted. The next step in the process, obviously, is commercialization. And there is another working group, the commercialization group, that is responsible for driving that. As you will know, there has been some criticism in the past about the adoption of ICC rules as a market practice and the fact that some things are not fully commercialized. So obviously none of us want to see rules being left on the shelf and not being applied in real life. So work is ongoing within the ICC to encourage commercial adoption of the rules. I think educational sessions like this one will hopefully enhance that process, accelerate that process of market adoption. And obviously, if you're using intellect technology, then of course I'm more than happy to work with you to speed that adoption. So here I wanted to focus on supply chain finance, where the URDTT are again agnostic towards any choice of financing solution. Of course, compared to traditional trade finance, supply chain finance is a highly digitized business, relying heavily on the exchange of electronic data rather than paper documents, and typically applying straight-through processing with minimal human intervention. So here again, we've got our Kenya importer and our India exporter with a commercial contract agreed between the two. And we have a conditional payment obligation subject to the DTT submitted to a supply chain finance platform or data processing system. And with this conditional payment obligation in place, a financial services provider, subject to satisfactory risk profiling, may be willing to take advantage of the opportunity to offer pre-shipment finance based on that conditional payment obligation. Now, in a slightly different scenario, later on in the transaction, we will have electronic records submitted by the seller which satisfy the conditionality of the payment obligation. And there is also the possibility of additional records being submitted by a third party, such as a local invoice registry. At this point, the payment obligation becomes unconditional, and there is an opportunity for the financial services provider to provide an offer of post-shipment finance based on the now unconditional payment obligation. Okay, so now we go to the third scenario, where again, we have the same underlying commercial contract and the same conditional payment obligation. But in this instance, a financial service provider has added its FSPPU, payment undertaking. So here we've got both a conditional payment obligation and a conditional FSPPU. Then the conditions are again satisfied through the submission of electronic records. The payment obligation becomes unconditional. The FSPPU also becomes unconditional. And you've eventually got a somewhat safer opportunity to provide post-shipment finance, relying not only on the unconditional payment obligation, but also on the unconditional FSPPU. Okay, I hope that's not been too overwhelming. It's a lot of heavy material to digest in a short period of time. But that's it for the presentation today. So thank you very much for your attention, and I will stop sharing the screen. Thank you.
Thank you, David. Let's see whether we have any questions. And as we bring that up, I would like to notify all of us that immediately after lunch, we'll be running the quiz. We mentioned that we have 2 scholarships to be awarded today. I know most of you would want to be alumni of the ICC, and the same will be run on the platform. So the first person to get the questions that we'll be posting will be the one to be awarded. Okay, so that will be our Form 16A. So looking at the questions on the chat, the first one is there a sustainable, affordable credit insurance to cushion suppliers and therefore secure banks to provide trade products? I think I'll allow Andrew or Docas to take that question. You've seen the question?
Yes.
Okay, thank you.
Maybe I'll read the question first. Is there a sustainable or affordable credit insurance to cushion suppliers and therefore secure banks to provide trade products? What I can say on that, yes, indeed, I'm sure the insurance sector also is really working on some of these the sustainable agenda. Remember, this is space for everybody. So what I can say at the moment, I wouldn't say I have experienced one that we have done, but indeed we have the likes of ATI, the likes of AGF. I know AGF is big on green finance, so definitely they are supporting us on that. Actually, yes, AGF is. It is a guarantee insurance fund, and they are really supporting the agenda on that. And if you look at the de-risking they're doing, they're actually taking a higher, they are taking a higher risk, even higher than the banks. So they're going up to 75%, where on the ordinary trade and the ordinary business, they are de-risking up to 50%. On sustainable solutions or sustainable trade, they are going up to 75%. Yeah, that's what I can say for now.
Thank you, Dorcas. Let's see whether we have another question. I think this goes to David. What happens where full digitization is not possible in a particular transaction? Is that still covered under the URDTT rules?
Right. I mean, this is why we have different sets of rules for different types of transactions. So, as you may know, there is a supplement to the UCP called the EUCP, which caters for transactions which are partly paper and partly digital. So the URDTT, as a set of rules, solely applies to transactions which are totally digital, as I think I said in the presentation. URDTT applies only to transactions which are fully digital, end-to-end, completely digital, completely paperless. You have the UCP for transactions which are totally paper-based, and you have the EUCP, which caters for a sort of hybrid environment where it may be partly paper and partly digital.
Thank you, David. Let's take the last one. I saw one more question. I think this is also for you, David. With digitization of trade, how easy is it to undertake due diligence? And is there a platform for trade due diligence information such as on rules of origin?
Well, due diligence is quite a broad subject, isn't it? I think I mentioned briefly in the presentation that we at Intellect, we make use of artificial intelligence to perform compliance checks, which would be in line with performing due diligence. So certainly there are technologies available, but it would depend on, which vendor you're working with. We have our own solutions within the company that I work for, where those processes can be automated largely through the use of artificial intelligence and natural language processing.
Thank you, David. Before we go for break for lunch, I would like to acknowledge our partners in this conference. First, Kenya Bankers, ICC Kenya, KEPSA, NCBA, Spire Bank, and UBA Bank. We've also seen a very huge participation. We have over 15 represented entities in today's session. We have 24 participants who logged in online, and I also want to acknowledge the entities that are participating in this conference. Absa Bank, Kenya, Addis Ababa University, ABC Bank, Bank of Africa, Blue Desk Kenya, Carl Bank PLC, Clarency Singapore, Cooperative Bank, Credit Bank, Diamond Trust Bank, DIB Bank, Environmental Institute of Kenya, Evershades, FinTech Kenya Limited, Fortescue Future Industries Kenya, Housing and Development Bank of Egypt, ICC Academy, ICC Kenya, INM Bank, Jijenge Credit Limited, J. Miles and Company, KCB Bank, Kenex, KEPSA, Lumalas, Achieng and Kavere Advocates, Middle East Bank, M Orient, NCBA, Nyachoti and Partners, PTA Bank, Saudi National Bank, Shule Soft Limited, Spire Bank, Stanbic, Swift, TBN, Tintra, Triple O, and Company Advocates, UBA Group, UBA Kenya, and Ultravetis East African Limited. So you can see the kind of people who are in the room with us having this conversation today. Allow me to release you now for lunch, and lunch will be served one floor by the poolside. Somebody from KEPSA will be giving us the lunch vouchers at the door. I'll urge us to have lunch for 40 minutes, actually 35 minutes, then we can be back by 2 p.m. We still have quite a bit to cover this afternoon. But thank you so much for your participation. I saw people still following, even when we were talking about the new rules in the global trade. We promise to keep time and ensure at least we finish the program within the set timelines. Enjoy your lunch, and let's meet at 10 minutes past 2. Thank you. ICC, ICC Kenya, KEPSA, NCBA, Spire Bank, and UBA Bank. We've also who is Winnie, well done. She was the fastest and got the answer correct. She is the winner of a scholarship. Congratulations. Where is Winnie? You can stand for everybody to see. Okay, congratulations, Winnie. So you see how digital documents work. Where we are moving to. from 16A, you know. Yeah, so you need to be very quick on your fingers at that. So welcome to this session. And I would like to introduce the next speaker. We'll be talking about risk AML and compliance in trade. That's John Oganda. He's the head of compliance. He has 13 years extensive experience in developing and implementing successful risk management policies and AML CFT programs. He's also a member of the ICC Kenya Finance and Banking Commission. Over to you, John. We forgot to say what was the correct answer. Maybe Winnie can tell us what was the correct answer. You know, for those who are wondering, you know, you walked away with the prize. What was the correct answer, Winnie? Thank you.
Okay. Good afternoon, everyone. I have the difficult task of trying to keep you awake after that lunch break. Yeah, so like Mary said, by way of introduction, my name is John Oganda. I am the head of compliance and also the MLRO for UBA Bank. So basically I wear two hats. One is to look after regulatory compliance, then the other one is on money laundering aspects. So Lloyd, maybe you can put up the slides. Then you can move to the next. Yeah. Okay, so when listening to the presentations in the morning, Andrew mentioned about the group of invisible bankers who work behind the scenes, and their work is just to say yes or no. I forgot to mention there's another group of invisible bankers who don't say yes or no, but operate in more of a covert way. And our work basically is to look at those suspicious transactions in those trade transactions. So when you guys process them, go via credit, you get the approvals, we come in behind the scenes just to filter out the names in those empty 700s, the letters of credit, and try to identify what are the suspicious transactions. So I will, in my presentation today, I'll just discuss, because I was given the task to talk about the AML risk and compliance within the trade finance. So I'll look at the trade concepts and then how to identify those suspicious transactions, and then identify some of the techniques that from us in the financial crime space have seen over the years. And then some of the red flags, and then how do we then address those issues and concerns. So you can move to the next slide, please. Lloyd. Yeah, so Mary introduced, so we can go to the next slide. Yeah, so when you talk about global trade, so over the years, global trade has grown significantly. And if you look at the statistic today, and the leader in global trade today is China. China has been able to grow their share of wallet of global trade from 2% in the 1990s to currently 20%. So they control about a fifth of the global trade transactions. Now, from the UNCTAD statistics, Africa as a region, our share of wallet with the rest of the world is around 760 billion. Then if you look at the other regions, Oceania is around $4.1 trillion, Europe about 1.5, and America 6.8. Now, even though Africa, in terms of the statistics, I think we are still way below the rest of the world. What that means then for us in financial crime, the way we look at it is that is the value of global trade that has been transacted between Africa and the rest of the world. And therefore, we're trying to look at, are there any instances where we've had trade finance transactions that have origins with illicit funds and issues of terror financing. Now, the other issue that we've seen, if you look at the statistics from UNCTAD, they estimate around $1 trillion annually in illicit flows, with most of the losses due to trade fraud. Now, we have issues of course, under invoicing and over invoicing, which also has an impact on the tax and the customs declarations. So, from a financial crime, that's what we look at, and that's what we try to monitor. So trade finance has been defined. Basically, as banks, we come in to facilitate the exporter and the importer. And in the morning when Dorcas was talking about the roles bank plays, I think she dropped to that point, that we come in to bridge, to facilitate the importer and the exporter. And that's our role as financial institutions. But then that is for the teams within trade finance. For them, they've met their targets, but for me now is to try to identify those trade finance transactions they've approved. Do they have any illicit crimes or any money laundering concerns that we need to know as a bank? So we can go to the next slide, please. Yep, the other one. Yep. So this is trade finance in a nutshell. So you have the exporter and the importer. So basically, the concerns or where the banks come to play in is to try and, finance or to intermediate between the exporter and the importer. So the exporter basically is worried about upfront payment. If I export my goods to country A, will I get payment? And then the importer, on the other hand, is also concerned about if I pay upfront, will he deliver? So banks come in to mitigate that risk for the importer and the exporter. And so once an order is placed, the financer pays upon the guarantee of goods, and then the goods are shipped, the buyer receives the goods, so both buyer, importer, and exporter are happy. So this is a typical trade finance transaction, but we have those complex ones that originate, have multiple banks, have multiple people who are behind these transactions. Now, how trade finance helps buyers and sellers? When I was researching this topic, the key common challenges that are there for the buyers and the sellers. So we have the ones that will be common for both the buyer and the seller. And one is on currency volatility. So, of course, if you're importing or exporting, you're most concerned about currency volatility. Currently in the country, we're experiencing dollar shortage. So people who are importing goods have been looking for that dollar in the market. And I hear there are some caps, although that is not the official position from the regulator. Then issues of lack of liquidity, political stability. But for buyer-specific challenges, what they are concerned with is one issue of delivery of goods. So will the goods be delivered if I pay upfront? And then breach of contracts, the goods can come, but they may be of poor quality. And then working capital tied to inventory lead time. But on the seller side, the challenges that they experience are on financing and acquisition of materials, and then issues of buyer default. Now, so those are the challenges that these people face. But now for us, people in the financial crime space, we are concerned about whether those transactions have patterns or are proceeds of crime. So how we identify that is we look at the Financial Action Task Force definition of what is trade-based money laundering. So for those who don't know, the Financial Action Task Force is a multi-country organization that comes up with recommendations for money laundering, which is applied across the entire world by financial institutions. So the way they've defined trade-based money laundering is it's a process of disguising the proceeds of crime and moving value through the use of trade transactions, so in an attempt to legitimize the origin or finance of those activities. So when you see that letter of credit, the LC that you've approved within your institution, so from our perspective, what we are trying to look at is this buyer or this exporter trying to move value from country A and B, and the origin of that transaction, the underlying transaction, could be an illegitimate or an illegal activity. Now, in Kenya, the Pokamla Act has defined what money laundering is. So for money laundering, first of all, to exist, there has to be a predicate crime. So the predicate crime is a legal activity that will give rise to this cash. So what we try to pick from those activities or those LCs is to try and identify those issues. And again, today, because of geopolitics and the international sanctions, we all know what's happening between Russia and Ukraine. The US has issued a lot of sanctions against some Russian entities, Russian people. So trade finance is basically the mode of transfer of value that is used by people who are trying to circumvent. If you do wire transfers, it's quite easy for me to identify. So I'll see the party, the remitter, I'll see the beneficiary. But because of the nature of the trade finance transactions, the documents, it's quite difficult for you to identify who the ultimate beneficial owner is in this transaction. So, and some of the examples that we have is, so why trade finance is used by money launderers is because of just that, the complexity. We have multi-jurisdictions. Sometimes you'll find a vessel originating from China, having docked in Singapore, went to this other jurisdiction. So then from a finance crime perspective, how do you identify that this ship did not dock in Russia and it's carrying, say, wheat from Russia, for instance, and therefore you are facilitating circumvention of the current sanctions that we have. Now, how we do that is we use some KYC utilities, tools that will help us to track the vessels, and I'll talk about some of those tools. Lloyd, we can move to the next slide. No, the next one. You're going back. Okay, so from our perspective, so I've identified some of the techniques that are used. So from a financial crime perspective, these are the things that we try look at. I've identified 4, but there are more than that. So the 4 are just simplified techniques that are used so that at least we can appreciate the kind of the risks that we look at when we approve those trade finance facilities. So the first one has to do with over-invoicing, and we have the others for under-invoicing. And I'll explain how this works in the next slide. So when you're talking about over-invoicing, so you'll have a company. Move to the next slide, please. Yes. So when you get an LC, and one of the things that we try to identify is under the technique of under-invoicing or over-invoicing. So you'll find a company, say company X, that ships goods to company Y, and the goods are valued at 10 million shillings. But the invoice, company Y, but invoices, company X will invoice company Y $9 million, right? So the difference there is 1 million. So company Y will pay company X the $9 million, but then will sell those goods because they are valued at 10 million and get that 1 million shillings, $1 million, sorry, and then disburse that $1 million to company Y in an agreed account somewhere, either overseas or locally. So if you look at this example, from the definition I've given, so when you're talking about trade-based money laundering, we're trying to look at how a money launderer will try to move value from country A to B, but then use the trade finance products to try and move that value. So in a simplified way, so you have someone who has over-invoiced, but then gets, has supplied goods for 10 million, but then under invoices at 9 million. So the recipient on the other side will sell those goods and get value of 1 million, and then the $1 million will be disbursed to the other party. Then if you go to the example 2, you can move to the next slide. So what we've seen again from the financial crime space, we've seen issues where people do multiple invoicing of goods and services. And this is where someone will use one invoice across multiple banks to support payments. So you'll find a customer has gone to, say, Coop Bank, given an invoice of $1 million to support inflows. He's also moved to UBA to give the same invoice to support the same inflows. But because banks don't collaborate and we don't talk to each other, it's quite difficult to detect. So this is one of the examples that we've seen where people use multiple invoices. And most of the times when you discover this, they will say there was an issue with the invoice, there was some things that were altered, the transaction is still, the invoice is still the same, but it's because we agreed on some different things, you know. So it's quite difficult to identify. So what we try to do as much as possible is to sensitize our trade finance teams on how to scrutinize these documents. How you identify the prices, you can look at the price index. So if someone is saying he's shipping in a container worth of shoes, and the value that is indicated there is $10,000 per pair, of course that is quite high. So you can easily cross-check that by Googling. Just try to check what is the price of shoes in country A, and you can see the average price. And then you can be able to know whether the invoice you have is actually being used to facilitate trade-based money laundering. So you can move to technique 3. So under technique 3, we have where the customer will try to, we call it the over and under shipment of goods and services, right? So under this technique, goods and services, it involves creating a mismatch in the quantity of invoiced goods versus the amount of goods that are actually shipped. So you can over-invoice goods for, say, $10 million, but then the quantity, you can say you invoice, say, 1 ton of maize or 1 ton of whatever it is. But then the actual quantity that is shipped is different from what you have in the documents. Now, if you take this to the extreme, the seller and buyer may collude and arrange for routine processing of shipping and custom documents for a ghost shipment containing no goods at all. Now, from where I see it, sometimes we receive a lot of inquiries also from the tax authorities when they want to confirm the documents we use to support payments for what a customer was claiming to be shipment. So we have a lot of collaboration again with the KRA Customs Department just to validate some of those custom, the IDF documents that we receive from our clients. And then the last technique, which I want to talk about, which is the 4th technique, is the one on falsely described goods and services. So under this technique, you'll see company X ships electronic items, say produced in China, under fictitious documents to receive VAT refund, say in their country. The exported device could actually be broken or obsolete. Now, for electronic equipment, it's quite difficult to, when you look at the documents as a say, compliance person, to know this shipment of electronics, is this the latest TV or the latest electronic item that is there. So sometimes you will see instances where people import or they export obsolete items and then support them with these documents. So these are some of the examples that we've picked from a trade-based money laundering and from a financial crime perspective on how we try to monitor and see to flag out some of those suspicious transactions. Next slide, please. So what are the risks that are associated with trade finance? So one, we have the operational risk. Like I said, trade-based finance is document-based, and therefore it has a lot of manual checks. So the trade finance teams receive a lot of documents from the customer, IDF documents, bill of lading, all those things that you need to verify and check. So also because of the issues of TAT, you want to turn around the customer request quickly. Sometimes we overlook these documents, but the documents have a lot of information that can help you flag some of those suspicious activities. Now, the gap that we have is it's not possible to transfer all of these documents in the automated transaction monitoring tools because of the volumes of documents and the text that is there. For the people who do financial crime monitoring, what we look at will basically be focused on the MT700s and just try to look at the names that are there. But when you scrutinize the original documents, you can actually see something that will make you either stop or approve that document. So the gap that we have then is how do we sensitize the frontline staff to be able to scrutinize these documents and identify those gaps that are there. So again, there's a risk of fraudulent documents. As bankers, most of us are not handwriting experts or document experts, so we receive what the customer has given us. It's difficult to identify what is legit and what has been faked. And then from a compliance perspective, of course, we have the issues with the regulators. So non-compliance can lead to regulatory sanctions. And then you have the reputational risk if your bank, again, is mentioned in these transactions. So how we try to manage the risk in the financial crime space is to try as much as possible to increase the bar on our customer due diligence processes. So how do you conduct due diligence on your customers? So due diligence is not just about the customer filling in the form and you are happy that you know the customer name, the name of the company, but it's about going over and beyond to try and understand the customer's business. So if the customer is in trade business, try as much as possible and understand the corridors where they import or export. So what are the dynamics in that space? So if it's China, what are the cyclical patterns for trade in that area? So there'll be times where you will see there's no activity from the customer. There are times you will see there's high activity. So for you as a trade finance person, you really need to understand your customer better to know those kind of patterns so that you can be able to flag those things. Then the other thing is enhanced due diligence. So we don't just do customer due diligence, but enhanced due diligence means you need to obtain additional identification documents to verify the authenticity of what you've received from the customer. So the burden is on us as bankers and mostly the frontline people who receive those documents. So you really need to try to go over and beyond to try and understand the documents that you've received from your customer are legit and that you can actually vouch for that customer. In terms of the red flags that we identify as people in the compliance space when it comes to trade finance risk. So from a customer perspective is we try to look at the addresses. The addresses are very key for us because then they can be able to identify for you suspicion or whether the transaction is legit. So for example, you have different transacting businesses sharing the same address. So if you have importer, exporter, same address, or party A, party B have same address, then it means those two companies are related. So you really need to find out why those companies are related. So the address is, most of the time, it's ignored, but it's a crucial piece of information that can help you identify some of the suspicion. Of course, the obvious ones are customers acting aggressively when you try to ask for more information. And the common complaint we get from customer is the transaction is time-based. You need to do it quickly for me. I will lose this business. So those are some of the red flags that, as a frontline person, you need to look at. Now, some of the goods that are vulnerable to money laundering, we have things like games, people who import precious metals, tobacco, electronic equipment and appliances. Like I said, for electronic equipment, it's quite difficult to tell whether these items are obsolete or these items are quite current. From a documentary perspective, some of the red flags that we try to pick is, as an example, is indication that the description of the goods are coded or disguised. Sometimes we have significant discrepancies between the description of the goods on the bill of lading and the actual goods shipped. So like I said, the people who receive the documentation, those are the teams that you really need to train and sensitize for them to be able to flag out these suspicious transactions. The other things, red flags that we've seen in documentation, you have, as an example, a transaction involving sanctioned entities. And again, like I said, right now we have all this Ukraine-Russia war, and we have so many sanctions, it's actually difficult to keep track on who's sanctioned or who's not. So it's very important then for us to be able to keep up with those sanction lists and then try to scrutinize those documents as thoroughly. And then in terms of the best practice that we try to apply, so like I said, key thing is sensitizing the frontline staff. So number one is your trade finance teams. You need to sensitize them on the potential red flags. For us, people who sit within the compliance space, we don't have access to those documents, but the people who receive them, the credit teams, the trade finance teams, they really need to scrutinize them to identify the red flags. And then the underlying staff should review all underlying trade documents. I know some of the challenges that we have is the documents are quite heavy. And because of the TAT, you really need to turn around that transaction quite fast. So most of the time we don't scrutinize all those documents, but it's quite critical for those people within the space to try and scrutinize it. And then from a sanction procedure perspective, like I said, right now we have a lot of sanctions being announced every other day. So how then do you keep up with those sanctions? How do you identify that the parties that are within that trade finance document have not been sanctioned? The challenge with that is in trade finance you have multi-jurisdictions. So you have people in different countries, which is quite difficult then to try and flag out suspicion in those transactions. So basically, it's up to how far do you want to go as a trade finance person or the credit person to do your review and try to identify what are the suspicious transactions. Sorry. And then lastly, on the voyage checks. So like I said, trade finance involves a lot of shipment of goods. So some of the tools that we try to use to be able to identify suspicion is to do the voyage checks. Now, like I said, we have some of KYC utilities that we use. So we have tools like World Check. Today we have even better tools like Panjiva that will let you know who's importing, from where, and it will give you the import history of the customer. So it's quite important for financial institutions then to employ some of these KYC utilities to be able to flag out those suspicions. And again, so the ports are also quite important. So we have some of the watch listed ports. So for instance, if you have some items that have docked in the port of Mogadishu, coming to Mombasa, you'll be interested to know what was that was being dropped or picked from the port of Mogadishu. Or if a ship docked in Yemen, for instance, as a trade finance person, then those are the jurisdictions that should alert you that this ship moved from China, Yemen, came to the port of Mombasa. So you really need to look at those details and try to identify and flag out those suspicious transactions. Yep, then I think I'll stop there. And then I will open the floor for questions, if any.
Thank you. And I think what I'll do is for John's session, you can go again to menti.com and put your questions there. We have one of our panelists for the next session who would like us to take their presentation. Then we'll come back to the Q&A for this. Okay? So for the next session, I'll actually skip ADR. He'll be after this. Let's at least accommodate our colleague who is online and has been waiting for some time. We'll move straight to the presentation on the global rules from paper to digital, the rules and process. And we'll be taken through this by Julius Ochako and Gary Collier. Julius Ochako is a senior trade finance officer at PTA Bank and has about 20 years experience in both commercial and development banks. And Gary Collier is the CEO of Collier Consulting Global Limited, and they'll be discussing with us on the topic that I've highlighted. So over to you, Julius and Gary. They are both online. Let's see whether they are online.
Hi, yes, I'm online. It's Gary.
Julius?
Can you hear me?
Yes, we can. Julius?
Okay.
I think, Gary, you can walk us through your presentation now. Thank you.
Okay. Let me... Okay, hopefully you can see my presentation. You can, yeah, I can see it on the right-hand side. You've already heard from David Henner this morning regarding the uniform rules for digital trade transactions, which is the most recent set of ICC rules in relation to digital processes. In the time that I have available here, I'm going to try and take you through the other rules which are currently out there in the name of ICC, and some of them have been, a couple of them have been there for some time now. And we need to look at the reasons as to why maybe they have not been used, or why there is a lack of uptake in relation to the use of those particular rules. And not just look at the rules in the context of, well, what's in them, what do I need to look for, but also, it's not something that's going to happen that you finish work on a Friday evening and you finish your last paper transaction on Monday morning, you will be transacting digitally for everything. There's a lot of preliminary work and there's a lot of other work that needs to be put in place in order for that to be achieved. And it also needs everybody that's involved in a trade transaction to come to the same table and agree on the methodology that's going to be used and the platform that's going to be used in which that trade transaction can be adopted and applied from one corner of the world to the other. So when we start looking at the digital rules that exist, we have effectively 4 ICC sets of rules. We have the EUCP that's been around for just over 20 years now, with, I think it has to be said, very minimal usage. I can remember when the EUCP was put together. It was the fastest drafting of any set of rules for the ICC. We completed the process in 18 months from start to finish, from a blank sheet of paper to the rules being implemented in the March 2002. Now, 18 months may sound a long time, but given that the ICC at that time only met every 6 months, That meant the first meeting they agreed that we could start drafting the rules. The second meeting after 6 months was effectively to look at how the drafting was going. The following meeting after 6 months was almost the final draft and then the implementation. But the rules were built on the premise that everybody was saying, we want to go digital. We want to do things electronically. But the reality is here we are 20 years later. And in particular for what we would class as being the traditional trade products of letters of credit and collections, we're still very much buried in paper. And at the end of the day, the question is, can we see the light at the end of the tunnel where we can see a dramatic shift from that basic position? You know, we have the EURC, which came in 3 years ago in July. Again, from what I'm hearing, not a great deal of usage. I think in a way that is maybe endemic of the uniform rules for collections. You know, a lot of banks have either exited dealing with documentary collections, or they have shifted the process of the creation of the collection instruction and the sending of the documents to a presenting or collecting bank to the principal. So instead of the principal providing a collection instruction to the remitting bank and the remitting bank simply copying what's on that collection instruction onto their letterhead, effectively they ask the principal to do that work for them, and all the remitting bank does is effectively chase for payment or acceptance. And that has been because the way in which banks are looking at the collection product and saying, there's not a lot of money to be made in collections. Therefore, what can we do differently in order to make sure that we can still service the client if they want to utilize that particular product? The third one on the list is uniform rules for bank payment obligations. For the first two, I was a co-chair for the drafting of those rules. And for the URBPO, I was the chair of that particular group. Those rules came in July 2013. And again, the expectation at that time was that uniform rules for bank payment obligations would provide the banks with an insight into the open account transactions that their customers were actually performing at that moment in time. Because if we look at open account transactions, banks have very little data in relation to where and with whom their customers are actually dealing on an open account basis. Yes, the banks get involved in either making a payment on behalf of their customer or in receiving a payment on behalf of their customer. But the actual involvement of the documents, the movement of those documents is all handled by the exporter. And occasionally that exporter will come to the bank and say, would you be willing to finance these invoices for me? Or from an importer's perspective, would you be able to provide some funding for these particular invoices that I've got to pay under these particular open account transactions? So in a way, the URBPO rules were seen as a means of providing some visibility in that exporters and importers would upload into a proprietary system at the time, which was the SWIFT Trade Service Utility. They would upload their details of their open account transactions so banks could actually see exactly what the customer was doing. They knew what LCs they were doing, they knew what collections they were doing, they knew what bank guarantees they were doing. But for open account, it was a big void of understanding exactly what was out there. And potentially having this product would give them an opportunity for the bank to then say, okay, for these transactions, do you realize we have a relationship with your counterpart in this country? We could provide financing, we could do a payment obligation for you, et cetera, et cetera. So that was seen as the first way of doing that. Now, the difference with the URBPO as we see at the moment is that the system was built upon data as opposed to examination of documents. So data would be extracted from documents and uploaded into the proprietary system, i.e. at that time, the SWIFT Trade Service Utility. And I'll talk about that in a moment. I'm not going to talk about the URDTT, A, in the interest of time, and B, because this would have been covered by David earlier in one of your sessions. If we look at the EUCP, as with any set of rules, apart from the bank payment obligation rules, they're built independent of specific technologies. You know, the ICC does not get involved in saying you must use this platform or that platform or whatever. That's the choice of the parties. And by parties, that's buyer, seller, banks, etc., whoever's going to be involved in the transaction. And they have to agree on that technology or platform. The rules, because we have no real knowledge of, you know, where we want to be with digital, where we see it in 2 years' time, 3 years' time, 5 years' time. The rules have been drafted to meet what we believe to be the perceived demands of the market. And in that respect, the EUCP, the EURC, the URBPO, and now the URDCT have been drafted on the basis of version numbers, on the basis that we don't want to necessarily complete a full review of the rules every time. But when a certain aspect of those rules changes, we can do a quick, for want of a better word, fix, and effectively amend the rules and create a new version, only changing that one particular aspect of the rules. And therefore, there would then be an audit trail that would show version 1, version 2, version 3, etc., for those particular rules. If we look at electronic documentation that will be used under EUCP, you know, organizations such as SDOCS and Bolero have for a number of years developed systems which enable the issuance of electronic bills of lading and to facilitate the uploading effectively in a PDF format of other documents such as the beneficiary's invoices, packing lists, certs of origin, inspection documents, etc. Now, when I talked earlier about, you know, 20 years of EUCP and very little usage, to put it into a little bit of perspective, in the April 2022 Banking Commission meeting, the representative from SWIFT made the announcement for the MT700s issued in 2021, i.e. the issuance of documentary credit. Less than 1% of those MT700s made a reference to EUCP. And primarily, I would suggest that at this moment in time, the only sort of companies who are taking a vested interest in moving from paper to digital and the use of EUCP are the commodity companies, where they're talking about large value transactions. They want to get funding received a lot quicker than what they would do from a paper environment, and doing things electronically obviously makes sense, especially in their field. But there are questions, and you know, a lot of these questions don't necessarily have answers today. You know, what are the concerns or inhibitors to change from paper to electronic? And I think these will change between different types of client, between banks, maybe knowledge of what needs to be done in order to move from paper to electronic. You know, is it a cost or resourcing issue? I talk about, you know, cost is something clearly that there will be. I talk about resourcing because someone has to help manage this to happen. This is not going to happen by itself. You know, will a customer of yours have the ability to understand what's needed to move from paper to electronic? It may need a bank personnel to step in, or a fintech personnel to step in, or a consultant, may I say, to step in and say, right, okay, here's the transaction today. These are the documents that are called for. This is what is necessary for this transaction. What do we need to do to get all of these documents onto a specific platform in order for them to be dealt with electronically? Can we do it with everybody on the same platform? Because if we can't, we then have to look at, well, how do we do the workaround? We then have to look at the fact that one client may be conducive to, say, joining, as I've mentioned here in the fifth bullet point above here, of having it on the Bolero platform. Your next customer may say, I want to do it on SDOCS. So will banks need to join more than one platform and therefore more than one set of costs in order to facilitate all of their underlying business? And the chances are the answer to that will be yes. You know, I think the fundamental question here is, in today's world, everybody's talking about digital. But the reality is people are then saying, yes, I want to do digital, but, and the but is, how do I do it? And who's going to help me do it? And they're looking around for that answer, and they're not going to find it necessarily. But they have to start somewhere. And that's what some of the things I'm going to raise here are about. You know, if you look at the EUCP, it does not cover the movement of the documents from the beneficiary to the bank or from the issuing bank to the applicant. That's outside the rules. The rules cover what happens once they're received by a nominating bank, confirming bank, issuing bank. That's the scope of the rules. How they get to the bank, again, is now another issue that you have to address. How are they going to be delivered to the platform directly, or will the bank join the platform and the bank will upload those documents on behalf of their customer? How is this going to work? And clearly, you know, if you receive an EUCP credit, it's not, oh, this is great, electronic. Can you actually examine the documents that are required? Because under the EUCP, every electronic record has to indicate, or the credit has to indicate for each electronic record, the format in which it's to be presented. Are you capable of reading or examining that document in that format? And clearly the EUCP is not an independent set of rules. It is a supplement to the UCP and relies extensively on what is in the UCP 600. The EURC, again, does not cover the presentation from the principal to the remitting bank, from the collecting or presenting bank to the drawee. Those are all outside of the rules. But clearly, in today's environment, we have another issue. If I'm a collecting bank or a presenting bank sitting in London, I do not know if I'm going to receive any collections today or not. Absolutely no idea. Because there are no pre-agreements. There are no pre-sets of guidelines. There's no upfront applications like for an LC, etc. They just land on my desk. Now, in an EURC environment, that cannot happen. You cannot just send a collection instruction to a bank and say, this is subject to EURC, without knowing that that bank can actually deal with the electronic records. So now, under the EURC, there is a requirement that before you even do it, you send the collection instruction, you must ensure that the recipient bank is capable of handling an electronic transaction. And what will be the format that is acceptable to them for those electronic records. So therefore, there is, under EURC, an additional element of work that is not apparent in the in the URC, because you have to check that the bank can do it. In an EUCP situation, the credit comes in, it says EUCP. At that moment in time, the advising bank knows, but in a collection, that is not happening. The URBPO, as I say, is based upon the matching of data. So effectively agreeing up front what data elements are relevant for an importer to pay under, say, an open account transaction. You know, today they receive documents, invoices, packing lists, search of origin, insurance documents, bills of lading, but they don't examine them like they would under an LC. They only look in those documents for certain pieces of data. And those pieces of data are then agreed up front as the baseline information, and I'll talk about that in a moment. And against that is what the transaction or electronic matching of data will happen. So when we start talking about the bank payment obligation, it does not replace the DLC. It may have done in the future if BPO had been developed and have moved on. But the reality is the original concept was it would sit between open account and letter of credit, because ultimately there will be open account transactions that will remain open account, i.e. they remain the obligation of the buyer to pay, but there would also be effectively some open account transactions that will be subject to a bank payment obligation where the bank will say, yes, if the data matches, I will pay you. And they would do that on behalf of their buyer client. So BPO is effectively a set of rules that would operate for importers and exporters, but effectively built upon the premise of a data match. So when we talk about how this happens, let's talk about how we establish the criteria. There's an initial baseline. I've done it here that is coming in from the buyer's bank to the seller's bank. But this could come the opposite way. It could come from the seller's bank to the buyer's bank. Notice on this slide, you don't have buyer and you don't have seller. The bank payment obligation, and probably one of the reasons why the rules didn't take off too much, was that they were strictly bank to bank. So again, the data flow from the buyer to the buyer's bank and from the seller's bank to the seller was outside of the actual rules. So when we start talking about the initial baseline submission, the buyer would have submitted to its bank that submission, i.e. would have said, almost like, you know, I hate using the analogy, but it's the one that people will relate to, that it's like an LC application. It would consist of, you know, when do I want the shipment made by? Where's it going to be shipped from and to? What is the goods description? Now, remember, being digital, this could be as long a description as you wanted it to be. It could be individual items by individual size, by individual color, etc., etc. It would also list the data elements for commercial data like invoices, packing lists. It would also list all the data that you would normally see in a transport document. And those would be the elements that would be extracted from the documents when the goods are shipped, and the system would then attempt to match. So for this particular level, there's an initial baseline submission by the buyer, made by the buyer's bank. At that point, there's nothing to match it against. So it's sent out to the seller's bank, who is part of the actual baseline submission, the details of that bank, who would then send it on to the seller. The seller would then look to say, is this in line with my contract? On the basis that it is, they would do a baseline resubmission, which would be basically resubmitting what they received. Let's take it that they agree. The system will then be able to match one against number three and say, yes, there are no mismatches. It will then give a report out to the buyer's bank saying that the seller's bank has made a submission, and then both banks will get a report saying, yes, both sides have now agreed that the data elements are correct. And effectively at that point, we've agreed the baseline, i.e. against which the data will be examined. The buyer's bank under this would now, under the URBPO, become the obligor bank, and the seller's bank would be known as the recipient bank. So effectively, they would change names within the rules. Then, when the goods are shipped, a data set submission is made by the recipient bank, remember the seller's bank, on behalf of the seller. Now, this would include the invoice data that was asked for in this initial submission, the transport data that's been taken from the bills of lading, for example, i.e. what's the port of loading, what's the port of discharge, what's the date of shipment, etc. And that will be loaded into the transaction matching application, which at the time of the rules was the SWIFT trade service utility. And at that point, the system will be able to look for a match. Does the data submission match with the baseline that was agreed earlier in the transaction? It will then send a report out to the buyer's bank, i.e. the obligor bank, saying that the data set submission has been done, and will then send a report, in this case saying there's no mismatches. So all the data complies. Say, for example, the wrong port of loading was used. The data set match report would show a mismatch. It would give a report saying the port of loading is different. And that report would still go to both sides. So everything that goes in, everybody sees. You cannot hide anything. So if the seller puts in its data set submission and it's wrong, the buyer's bank will know about it. They can't hide that fact. Whereas in an LC situation today, the beneficiary presents its documents and they're discrepant. The issuing bank and the applicant will never know if the beneficiary then arranges to correct those discrepancies. The applicant and the issuing bank would never know the documents were originally discrepant. In a BPO transaction, they would, because the reporting would go both ways. And when you've got zero mismatches, there's a baseline report saying there's zero mismatches, and at that point, the obligor bank, i.e. the buyer's bank, will be required to pay at a site or to undertake to pay on a particular due date. I want to quickly spend a few moments on the last ICC survey that tackled the issue of digitalization. The survey was the 2020 survey, so basically based upon 2019 data. But here you get some idea of where the rest of the world is in relation to their views on where they are with digitalization. If you look here, the second last bullet point, technology solutions implementation is not on our agenda at this time, 5%. 34% within the next 1 to 2 years. Only 14% said we've successfully implemented a digitalization program which has resulted in a reduction of time and cost. 19% are struggling to implement technology solutions. But what were those technology solutions? And you've got a list here and the actual percentages. If you want to look at the actual full survey, I've given you a link to that particular document. Here, it drills down to levels in different types of trade transactions. So documentary trade, it fundamentally probably letters of credit. The level of digital channels are being used. The dark blue is significant, and to the orange on the right-hand side, where there is none or little. And clearly, there's a lot to be done for basically every form of transactions. Globally, for documentary trade, the number is quite high, 55%. But then it drills down, to local banks being only 39% for documentary trade. To what extent has a bank removed the use of physical paper? Again, the dark blue is still way in the minority. And clearly, what we would be looking for is in a future survey that dark blue line is moving gradually to the right-hand side. But the reality is this isn't going to happen for 1, 2 years. If we're only seeing less than 1% of MT700s mentioning EUCP, the issuance and advising of LC, that dark blue is not going to significantly move to the right-hand side. So, to wrap up for the last couple of slides, there are questions, and I think these are questions that each individual organisation needs to look at. Is there a perceived or actual need today for us to do this? And who are we going to use to do that? And do we actually know what that need is? Are we looking at a URDTT, a URBPO, an EURC, or an EUCP? Are we looking across all products? Or are we only going to focus on a specific product itself? How do we deal with contrasting needs of an applicant or beneficiary? Clearly, if I've got site letters of credit today in a paper world, a beneficiary is lucky if they get paid probably 3 to 4 weeks after shipment. By the time they've got the documents together, they present them to the banks, they've gone through to the issuing bank pays, and the nominated bank pays the beneficiary. In a digital world, I ship this morning, I present this afternoon. That's the reality that can happen. Now, the impact on an applicant in that respect is quite significant. In a paper world, they've effectively got 2, 3, 4 weeks credit, for want of a better word. Digitally, that disappears effectively. Will that make a shift from more site LCs to usage transactions in order to facilitate this quicker turnaround from an applicant? But again, you have to look at what are the needs of the applicant and the beneficiary. What is it they want? How are you going to deliver them? Do we need to create a product differential? What will differentiate a bank from its peer banks? If everybody's using the same rules, the same platform, where's the choice? What do I make different in my offering that will encourage people to use my services rather than the bank next door? Which rules are going to be applied? Who are we going to do it for? come back to the issue of resources from a budget perspective and personnel, because this isn't going to happen without some input and a lot of input on the part of individuals within banks and corporates to make it work. And let's say, what platforms are we going to use? Because fundamentally, I doubt very much if the whole of a bank's business could be managed on a single platform. And lastly, how do we diminish the reliance that exists for paper? Everybody loves paper. You look at the sets of documents that are presented, and every word is ticked in pencil. They love paper, but the reality is we have to move away from that. How do we overcome this maybe a perceived lack of desire, knowledge, technical know-how in order to move to a digital environment? We have very small percentages of letter of credit transactions, and I say mainly this will be confined to commodities. What do we need to boost that solution? Is it a major supplier or a major buyer saying to each of its clients, I want to go digital, and we are going to go digital if you want to deal with me? Maybe that's what's needed in order to kickstart a lot of this, but in volume terms. Today, do banks have the resources to help clients? Probably not. Not as much as they would probably want. Not full time anyway. Will all issuers of documents be able to use the same electronic delivery channel? Are we talking electronic documents where you're still going to be examining from the top left-hand corner to the bottom right-hand corner? Or are we going to be talking electronic data, which is more BPO? And, are there lessons to be learned from previous experiences with EUCP and URBPO? And by that, I mean, there was this perceived need that we needed to develop these rules immediately because people wanted to use them. But the reality has been far from that. And how do we overturn that? And a lot of these questions on this slide and the one before effectively need to be answered in order to address that. As has been mentioned, unfortunately, I can't hang around too long because I've got other calls lined up after this. But if people have any questions, they can send it to me, and I'll be willing to respond. But hopefully, I've not outstayed my welcome too much and given you a little bit of an idea as to where the rules are, and more importantly, what needs to be considered in order to make that move from paper to digital. Okay, thank you very much.
Thank you very much, Gary. And again, if you have any questions, please post them on menti.com. We'll take those questions afterwards. At this point, I'd like to introduce the next session. We want to listen to the lawyers. We've talked about trade, we've talked about supporting SMEs, we've talked about regulations, but we need to know how to be able to arbitrate this when things don't go how things are supposed to go. And to take us through this panel, I want to invite Tabitha, who will be the moderator for this session, to introduce the panelists. And Tabitha is a senior associate, dispute resolution with Anjawala and Kana, and an ICC young, trying to get the full name. Okay, WAF, but I'll read what that is. She has 7 years experience in legal background, and has worked for supporting corporate, commercial, and project and infrastructure departments within Anjawala and Kana. She advises on arbitration disputes, litigation matters, and represents parties before different courts and tribunals on commercial litigation, intellectual property, employment, probate, land, and human rights. Tabitha was appointed as the International Chamber of Commerce Young Arbitrators Forum. So I've gotten the initials now. Young Arbitrators Forum, representative for Africa 2021-2023. I think we are privileged actually to have somebody who has done this even at the Pan-African level engaging with us this afternoon. She's also a beneficiary of the Association of Young Arbitrators, second mentorship program, and a dedicated member of the Africa Arbitration Academy, assisting in various initiatives, including the Africa-wide litigation costs and disputes funding survey. She also runs with the moot programs for both Strathmore University and Nairobi University. So over to you, Tabitha, if you're in the room, to introduce your esteemed panel to take us through the next session of discussion. Thank you.
Hi, everyone. Good afternoon to also the attendants joining us online. Thank you so much for that kind introduction. So now you will allow me to introduce our other panelists. So this is a ADR stroke arbitration session, and our panelists here are well-known names and faces within this sector. So the first person I'll introduce, I know he's been very active at this conference today. So we have Kenneth Miriti. Kenneth, if you're around, you can come and join me. So all protocols observed, I'll give a short introduction. As you know, he's the chairman of the ICC Kenya Banking Commission Steering Committee. He is a member of ICC Kenya ADR and Arbitration Commission Steering Committee. He's a member of Chartered Institute of Bankers and a member of Kenya National Chamber of Commerce and Industry. He is a banking consultant, a trade finance consultant, and offers consulting and advisory services to organizations and businesses involved in imports and exports. He is also a member of the Chartered Institute of Arbitrators and an independent arbitrator specializing in financial and commercial dispute resolution. Welcome, Ken. Now, our next panelist is Jacqueline Waihenya. Jacqueline, if you can come on board. As she comes, I'll read out her profile so we can introduce her properly. She is a managing partner of JWM Law LLP. She's an advocate of the High Court of Kenya, and she is also a fellow of the Chartered Institute of Arbitrators Kenya branch. She's a very accomplished mediator with several mediation experiences. This includes she's being certified by the International Mediation Institute. And she recently joined the inaugural FIFA approved mediator list, and she is the sole Kenyan, the only one on this list. Now, in addition to that, she is also a chartered mediator with the Institute of Chartered Mediators and Conciliators, and was one of the pioneer Kenya Judiciary accredited mediators. In addition to that, she also has a very decorative arbitration experience. She is currently the vice chairman of the Chartered Institute of Arbitrators Kenya, and also the vice chairman of the Kenya National Chamber of Commerce and Industry, Mombasa chapter. Now, she holds an LLM from the University of Nairobi in Public Finance and Financial Services Law. She is currently pursuing an LLM, another one, in International Dispute Resolution at Queen Mary University of London. Welcome, Jackie. Our next speaker is Eunice Lumalas, and she's joining us online. I don't know if IT team, we have her on board. She can maybe say something so we know that the speakers and mics are working.
Hi, Tabitha. Hello.
Hi, how are you? Hopefully we'll be able to see your face on the screen as well.
I'm here. Thank you so much.
Okay, I think as we work on seeing you live, if possible, I will go on to introduce you. So Eunice Lumalis is the partner in charge of dispute resolution and strategy at Lumalas, Achieng and Kaveri Advocates. She is an advocate of she's an advocate of the High Court of Kenya and an arbitrator with experience in both international and domestic litigation, arbitration and mediation. She undertakes exciting assignments representing clients in arbitration and has also previously served as an arbitrator. She is certified in international and domestic arbitration and draws her experience from the public and private sector. Now, with respect to the public sector, she has served at the coalition government of Kenya as the head of secretariat and legal counsel for the Speaker of the 10th Parliament of Kenya. She has previous work experience at Mohammed Mukai Advocates and Stanbic Bank, Kenya Limited. So Eunice, I think we can see you. So welcome. Now, our next speaker is Nikhil Desai. Nikhil, you can come on board. He is a director at John Miles and Company and also the vice chair of our ICC Kenya Arbitration and ADR Commission. So he has over 9 years experience advising both governments and the private sector in international arbitration, specifically relating to corporate transactions, energy and natural resources, trusts, and FMCG. He is also an advocate. He has represented clients at the High Court of Kenya and the Court of Appeal. Now, he has significant experience in fraud and asset chasing, and he's represented clients at the Capital Markets Authority of Kenya and private entities and cross-border forensic investigation. He was also instructed by the London Stock Exchange in collaboration with the Kenya Ministry of Energy to provide an overview of the environmental, social, and governance, or ESG, framework in Kenya. Welcome, Nikhil. And last but not least, of course, Deborah. Deborah is well known to you guys in these circles, so Deborah Jwang. Deborah has a career in banking that spans over 13 years. Actually, 15 years, sorry, there's a mistake there. She has served as a legal and company secretarial expert in several top-tier banks in Kenya. Now, before she ventured into this corporate world, she was in the private legal sector and the NGO sector as well. She championed the rights of women and children. She is the immediate former company secretary and country head of legal and company secretary, UBA Kenya Bank Limited. I don't know if, Deborah, you should sit in the middle. You know, you're giving us the balance here between the lawyers. So you guys can see that we have a very accomplished team here. And this is because there's just a lot to unpack. And we want to have these discussions. You know, we understand that these are necessary discussions, especially right now. There's a growing trend to have disputes within your industry managed through ADR and arbitration. Now, the first thing that we're going to do is we're going to have a brief overview of the status quo with respect to banking and finance disputes. And Ken, you're going to talk us through that. So I'll give you the mic.
Thank you so much. Good afternoon to everybody once again. My overview will be from perspective of the banker's view. I'll put my hat now in the banker's side. The banker's view on arbitration. A recent survey showed that arbitration, particularly ADR, is not widely used in the banking sector. Few organizations practice it, and there's a need to sensitize the industry on, first of all, what arbitration is about, what are the benefits of arbitration, because the practice in the banking industry for the last 50 years or so, the default mode is let's go to court. I'm sure you're familiar with that. Let's go to court. That's the default mode. However, the world has since moved on. Financial sector has moved on. There is an alternative, and that is mediation and arbitration. That's under ADR. And for us, we are here to share what ICC Kenya can do, both at country level and at international level. When we discuss trade finance, definitely there'll be international disputes between clients, between the banks, and so on and so forth. And in that area, how can ADR assist the financial institutions resolve these disputes, and what are the benefits, since it's not widely used? So as a panel, we encourage as many questions as possible online, so that at least you can take home after this session a wealth of information to share with the organizations on the scope of ADR. Thank you.
Thank you. So I think on that note, I want to invite Jackie, if I can ask you to speak, because you know, Kenneth has rightly said that we need to actually understand what is ADR, what is arbitration.
Okay. Thank you so much, Tabitha and ICC, for allowing us this opportunity to discuss about ADR and in particular arbitration. I think what I'll start by saying is that we commonly hear these two terms being used interchangeably. But the truth is they are two distinct terms. One is a component of the other. And ADR, just briefly, states alternative dispute resolution. We're growing into the space where we believe, I believe, and I hope I can convince you to believe that ADR is actually something that we should refer to as appropriate dispute resolution. So what is it alternative to? ADR is alternative to litigation. We are very familiar with the court process. You know, my day in court, if you don't pay up, I'm going to enforce my securities against you. I'm going to take you to court because you have done what we didn't agree. So the enforcement procedure is done through litigation, through court, through a public space, and it's done by a judge who is appointed, usually by the state. The bank and many other institutions who go to court have no control over who is appointed to hear their matter. It is adversarial, which means that we want to win. So I win, you lose, which means win-lose. What ADR tries to do is to give a lot more control to the parties who are concerned. Because we do realize that when you use a format or an approach or system that enables parties to control the process, that is quick, relative to court, is flexible, and allows you to even pick somebody who has technical experience or know-how, the outcome is more palatable, and there's more opportunity for a win-win solution. So that when everybody walks away, they walk away with a lot of benefit, and hopefully to retain the relationship. Because you know, we're in business. We want to continue being in business and expanding or enhancing what we have been able to accomplish and grow. So the alternative dispute resolution mechanisms are several. And I'll start with the easiest one, the one we use on a day-to-day basis. That's negotiation. Negotiation is basically two parties. You know, we engage back and forth until we come to an acceptable solution. We have resolved whatever would have been probably a conflict. So that is the first mechanism, negotiation. When parties cannot agree through negotiation on their own, then they can involve another party, who we call a neutral person. A third party, neutral, somebody who is not involved in the dispute, but is able to help them talk through the issues or the conflict that they are facing. And the third party neutral is called a mediator. The mediator does not decide. So negotiation and mediation are non-binding alternative dispute resolution mechanisms, and they allow the parties a lot of control. Even if you choose the mediator is not going to decide. So those are the non-binding mechanisms. Then we move on to another mechanism called conciliation. Now, conciliation is like mediation because you have a third party neutral who helps the parties to speak, but even as they are talking and as they are facilitating the discussions, they give them proposals. You know, I'm an expert in this field. Why don't you consider, don't you think, perhaps if you looked at this solution, I can propose 1, 2, 3, 4, choose one, and then the parties choose one, and sometimes the conciliator pushes the parties towards a certain conclusion. The best example I can give, because we're all Kenyans here, was a conciliation called a mediation in many spaces that was done by Kofi Annan when we had the post-election violence. He pushed the coalition government agenda until it was accepted by the parties, and then we were able to move on. So all these ADR mechanisms speak towards, let's look towards the future. Now, arbitration, which is the one I know we are most familiar with and which is addressed a lot by the ICC statutes, is a situation or a mechanism where a third party neutral is appointed in a private capacity, many times also in a non-national basis, and the arbitrator hears a party almost in the same approach that you have in court, but in a private setting with more confidentiality, more flexibility. Arbitrators, as I had mentioned, a third-party neutral can have special expertise or qualifications, and then they make a decision which is final and binding. Now, all alternative dispute resolution mechanisms are consensus-based in the sense that you volunteer to get into the ADR space. So the parties will put in their contracts an arbitration clause, a mediation clause, or a conciliation clause. And it usually starts with, unless the parties otherwise agree, this is what is going to happen. And that is based on negotiation. So you can also build in a negotiation phase and say, we will first try to negotiate for the first 21 days. If we don't succeed, then we can move to mediation. And if we don't succeed, we can go to arbitration, which shall be final and binding. Now, all these mechanisms have a lot to go in, and I know we have limited time, but I'm hoping that we'll have an opportunity to discuss them in greater detail. But that is a quick snapshot of what alternative dispute resolution is. Thank you.
Thank you. Thank you so much for that. And now I want to move on to Eunice, because Eunice is a firm believer of arbitration for the commercial sector. And, you know, we had earlier mentioned benefits. So I don't know if she can give us an overview of what some of these benefits are. There is also a slide. I don't know if IT team can show us that on the screen. Eunice, over to you.
You can hear me, Tabitha? Can you hear me?
Loud and clear.
Fantastic. Now, Tabitha, I am very excited about this conference, which comes hot on the heels of a meeting I'm attending currently. I sit in the Public-Private Petitions Committee, which is the arm of the Petitions Committee, of the Petitions Unit under Treasury, that resolves disputes arising out of public-private partnership projects. And we were looking at, project financing in Africa. And we had the privilege of sitting with a number of players in the industry, project advisors, lawyers, lenders, and banks, as financiers. And one issue came up, Tabitha, which is that it was alleged that African banks, particularly the African Development Bank, would be very hesitant to have disputes between lenders or foreign investors and financiers with African parties be resolved in certain African countries. And that really raised a big concern for me, because it shows that there is a lot of sensitization that we need to make. Why am I saying that? Because whether we like it or not, we are increasing in terms of globalization, climate change and the rest, there are new emerging areas of funding, of finance, and I've had a bit of that earlier this morning, and of projects for bankers to get involved in. And that's growing. So far, there has been no better form to resolve transnational disputes than arbitration for commercial disputes. And therefore, it's about time we got to understand how it operates and some of the key advantages. Because of time, allow me to just mention some of them. Like one of them, you do not have to leave Africa and go to London, for example, to have your arbitration resolved in London. Why am I saying that? Because just in the continent of Africa, we have over 70 arbitration institutions, okay? And Mr. Miriti spoke in the morning about whether it's ad hoc, that is an arbitration that you can, arbitrators can be appointed by the parties, or whether it is a dispute resolution mechanism of, arbitration where an institution such as ours, ladies and gentlemen, we have an arbitration institution in Kenya known as the Nairobi Center for International Arbitration, which can resolve international disputes. The Chartered Institute of Arbitrators can similarly resolve disputes between Kenyan nationals and international parties. But so having said that, you can have a properly drafted arbitration clause or dispute resolution clause where you can say disputes, for example, will be resolved amicably where parties disagree. Where it's not possible to resolve that dispute amicably, then parties can then opt for mediation for a given period of 30 days, and if not, then they can dispute through arbitration. And you can be handled by the Nairobi Center, for example, or Chartered Institute, or each party will appoint one arbitrator, and then a third arbitrator, if there are three, to be appointed by the institution or the two arbitrators, whichever form. What am I trying to say? I'm trying to say that arbitration gives parties fantastic opportunity for flexibility that you cannot get in any other form of dispute resolution that is binding. Because commercial parties want a quick business solution for their dispute. This you can find in arbitration because it's flexible. It can allow you to sit wherever, whichever country you are, particularly now because we are having a lot of matters done online. You can have dispute resolvers from anywhere, and you can decide even to have a sitting. For example, if the dispute is between a businessman from Uganda and another one from Kenya, you can have a venue of Kenya because that is probably where you'll find a lot of witnesses to come for the case. And you can decide to have English law if you so please, and you can apply it right there in Kenya. So that in arbitration, we have concepts like the seat of arbitration, which means not the venue. And Tabitha, I hope you'll create more opportunities for us to learn about the seat and the procedural law, which is the law that governs the process of arbitration. And then you can have the venue, meaning you can decide to sit in Nairobi and resolve the dispute using Ugandan law, okay, if you so wish. And that is a great opportunity to develop our own local industry, to develop our own local arbitrators, to give business to our taxi drivers, our hotel industry, and it's a good thing. Now, what other advantage do you have in arbitration? Another advantage would be the confidentiality and privacy of arbitration rather than court, for example. Court cases, as you may all understand, are held in public, and therefore you can have bloggers coming to listen to your business and litigating on Facebook and Instagram. And you want to avoid all that if you're dealing with certain confidential business matters. So for that reason, you choose arbitration because you will have confidentiality as a rule and privacy, and no one would be allowed to go and discuss what you're doing in that room while you're resolving that dispute. Another aspect of arbitration that makes it extremely attractive is that you have an opportunity to have an award that once rendered is enforceable and binding. Now, you won't get a automatically binding resolution when you're having adjudication, for example, or mediation, unless you make it so. But arbitration is final, is binding, and it's not easy to appeal. Actually, you can only set aside an arbitral award, and you can only set aside that award on very limited ground. When you look at our act, for example, the Arbitration Act, and I want to encourage all of you to get interested, get involved, look at that Arbitration Act. You will find at Section 35 very limited ground of setting aside an award. It must be on a point of law and on specified grounds that have been given. Maybe the process was not done properly. Maybe one party was not heard as they are supposed to be. There has to be equality of both parties. So if that is not done, then you can set it aside on those grounds. You also have an opportunity to appoint an arbitrator or a dispute resolver who is different from the parties. So if that you're having both parties are from a certain area or a certain group or a certain tribe, then you can get someone from a different region. I got recently very lucky to be appointed an arbitrator under the Kigali International Arbitration Center because the parties, one of the parties was Nigerian and a public body of Kigali, and they wanted an arbitrator from a neutral country like Kenya. There I was able to get lucky and get an appointment because I was in the list and they needed someone. So you see, I didn't have to travel or go elsewhere, but I was able to resolve that dispute in a very flexible and timeous manner. So I think you save costs and you save money in terms of time if you manage the process effectively. And therefore, Tabitha, I've spoken a lot, but there is a lot more to say actually, but I'll leave it there. Thank you.
Thank you so much for that. There is a lot, to be honest, and I think that as lawyers we can spend the whole afternoon talking about this thing, but I think it's appropriate to say that time is money, so we won't go too much into it. But there's one thing that I just want to clarify there, Eunice. Some people might not be so familiar with the term setting aside. So in general, I can say you want to nullify an award or you want to make it not binding. So it's like you never actually had an arbitration in the first place. So that is what we mean now. Now, Nikhil, I want to bring you into this conversation because some people do say, why should I go to arbitration if I'm going to end up in court anyway? So now, it's a waste of my time. You've just elongated me getting, a final resolution. And I wonder if you think that's one of the negative perceptions of arbitration.
Sorry, so the question was, sorry, if you could just last.
So in terms of the negative perceptions or ideas about arbitration, specifically the idea that I usually hear from my friends that are not lawyers, why go to arbitration? Why don't I just go to court? I know Eunice has pointed out a lot of benefits, but some people don't feel these to be so tangible.
Sure. Thanks, Tabitha. I think with any form of dispute resolution, there are disadvantages. But with arbitration, you need to remember that you're in control of the dispute resolution process. So I won't say there are no disadvantages. What I will say is that unlike a court system, you're in control of how you want your dispute managed. Now, one of the key issues people raise is that arbitration is very expensive. And, that could be true because, unlike the court system, you're paying an arbitrator, you're paying lawyers from, your own lawyers, you're paying for a venue that the arbitration will take place, and, the witnesses coming from different jurisdictions, and that does increase costs. But for each of those instances, and we'll talk about a bit later about the arbitration clause, but for each of those instances, you can actually deal with those issues, right? So, as Eunice mentioned, costs can be cut by reducing the procedure involved in the arbitration, right? You can pick rules such as the ICC rules, which have strict timelines to ensure that an award is rendered in a timely manner. And the ICC is actually very strict about ensuring that they stick to those timelines. Other ways of avoiding excessive costs is stating in your arbitration clause, where you want your arbitration to take place, and that also reduces all these issues. So you have control over this. Another disadvantage, or what people consider a disadvantage, is that you can't appeal a decision of an arbitrator, right? And that, as Eunice mentioned, is true to an extent, in the sense that you can't appeal the award, but there are limited grounds, like in the Kenyan Act, for example, if you put, if you allow for an appeal on a point of law in the arbitration clause, that could be a possibility. But is that really a disadvantage? When we go to court, we take years and years. It could take 8 or 9 years for finality, right? Here you're actually choosing your arbitrator. You can choose someone who's in the banking sector, who's respected, and you already know that he has the relevant experience and the rest to actually render a fair and reasoned award. So is there a need for, will the need for an appeal arise? If obviously issues such as bias come in, you can set aside the award. So you're not totally limited in that regard. Another perception, perhaps, and potentially true, is that since arbitration is, a sort of dispute resolution where parties agree on everything, what about the court powers? We always see courts holding people in contempt for failing to appear in court, or giving other orders against parties if they're not appearing or taking things in the manner they're meant to be done. But again, I think this can be dealt with. Arbitrators are given wide powers under local legislation, like the Kenyan Arbitration Act, and under the ICC rules. And, we'll talk about the seat of an arbitration, but a seat of the arbitration means which courts will have jurisdiction to assist the arbitrator with carrying out his mandate or her mandate. So, for example, if you have an issue with a party, or if you want to subpoena a witness, the courts in that country can always help. And in fact, the Kenyan courts are very pro-arbitration. So if you needed an order to actually compel someone to attend, for example, you can get that subpoena from the court, right? So it's not, that perception is not fully accurate, but yes, it does take a bit more time. But then again, getting similar orders in court in any event takes a lot of time, right? We spoke about the other powers of, similar powers that a judge has, an arbitrator doesn't have. But I think that it can always be dealt with in the arbitration process, and you can always, look for the rules that give arbitrators wide powers, and that could help alleviate any concerns that parties have.
Thank you, Nikhil. So now I want to move on to Deborah, and you've sort of seen this at both worlds, having practiced as a private lawyer and then moving in-house. And I'm thinking whether, based on your experiences, you've noticed any positive or negative experiences or encounters with arbitration and ADR that maybe you could share with us.
Thank you, Tabitha. I have noticed both negative and positive. First, as a general statement, I would like to say that I think arbitration is an alternative dispute resolution, but we need to make it the alternative dispute resolution. Why do I say that? Because sitting from the perspective, so today I'm going to wear the hat of the banker. I know we are sitting here and you were told there are lawyers sitting here, but I'm going to wear the hat of the banker. So when we look at an alternative from a business perspective as a bank, you're looking for 3 things mainly. You're looking at time, cost, and efficacy. And what I've found, having sat on both ends, and especially now on this other end of the banking side, is that many a times it hasn't met that objective. So we go into it and we say, okay, this is the alternative. And as you explained earlier, it's the alternative to litigation. So I'm expecting it will be faster, it will be cheaper, and it will be more effective. But what actually happens? I end up spending more time. In some cases, it becomes more costly, and it's not effective. And why? At the risk of stones being pelted towards me by the lawyers, I think what has happened is that most of arbitrators are lawyers. Yes, there are people who are non-lawyers, but most of them are lawyers. And unfortunately, we have complicated the arbitration process. We've made it so technical, which is what we are trying to move away from. So unfortunately, when we were looking for the alternative, we've ended up complicating that process. But there are options of how, so I'll go into, that's the negative. The positive is that if done well, I have seen scenarios where you can actually have an arbitration process going very fast and not being as costly. But the catch is this, and since I'm speaking to people who money is important to them, I can see Mary nodding her head. She's probably the one who's going to approve the arbitrator's fee note, is the way we package arbitration. To the banks or the financiers, we must package it in a way that, one, we sell the value proposition, and the value proposition should be, we're going to take this time. How do you do that? You can actually limit the time, the duration. You can actually say, this arbitration will take this process. I'm not an arbitrator, by the way, but having done many of these, I have learned the hard way, actually. I've learned the hard way because I've had to protect my client, who is the bank. So I've had to come up with ways of protecting the client from, exaggerated costs, so that I sit with the party representative. Then remember, we have the arbitrator, which I will pay, and then I have a party representative representing the bank. And then I have to pay for the venue. So those are costs in 3, right? So how do I go around that? 1, I can limit the time that it will take. We can agree upfront. This will take this duration of time. 2, we can agree on the cost, so that we say we will not go beyond this cost. Yes, sometimes it might be difficult for you to say, because things happen along the way, like with any dispute. Scenarios will change, different facts will come up, etc. If that happens, you leave a little wiggle room, But by and large, you know that this is what you're expecting. And, the finance person is able to actually factor in and plan for that cost, accrue for that cost. And then finally, efficiency. And when I talk about efficiency, I mean, for example, you can reduce the issues. I know lawyers, sorry guys, I'm really sorry, but we can be very complicated, and we will want to, go into details and go into, sometimes you find that a very big dispute can be reduced into 5 issues. So if you sit down at the onset and say, okay, this dispute looks like it's so huge, but let's actually sit down as party representatives and determine what are the major issues that if we resolve, this dispute goes away. And we reduce them to 5, that reduces the back and forth that you have, so that you reduce the amount of billing hours, because every time the arbitrator comes, every time you call Jackie and she's on phone, she's going to raise a fee note because she is spending her time. And as you've had her, you listen to her CV, so she must, all those degrees that she has must be paid for. She has so many degrees, but she still has more. So, every time you call her, it's not just a casual call, it comes with a bill after that. But you can minimize that once you agree on the issues. So I hope that gives you an overview. Those are the, the pros and cons I've seen for arbitration.
Yeah, no, actually, thank you for that. I think the issue of costs is debatable, and I'm wondering if I can get Kenneth here on this conversation, because, you know, we have the ICC, you know, we have chartered, and we've also talked about NCIA, but I'm thinking in terms of policy initiatives and strategies that some of these institutions, and let's focus on the ICC as well, have adopted to try and help parties effectively manage arbitration, particularly in terms of costs. I'm sure if you can comment on that.
Thank you very much. The discussion is getting interesting. I will speak. I do not have a legal background, so I will bash the lawyers a little bit. Today I'm the banking. Yes, there are ways you can reduce costs. There is a perception that arbitration is expensive. It can be expensive. There are three ways, actually, costs nowadays can be managed. One, arbitrators have fees which are guided by the Chartered Institute of Arbitrators. We now have fee guidelines. The arbitration, that's for ad hoc arbitration. Ad hoc, I mean an arbitrator standing as a private judge. That's what they are. Then you have institutional arbitration, like the ICC Court of Arbitration, Nairobi Center for International Arbitration. They also have their own fees, and which are available even if you check their websites, so that then you can be able to a certain extent predict the costs of your arbitration. There are other ways you can manage costs without, you know, within those guidelines, like Eunice has mentioned, reducing paperwork. Let me share a few tidbits to the bankers here how you can reduce costs. There's something called self-representation in arbitration. Self-representation means you do not need a lawyer when you appear before the arbitrator. Yeah, the lawyers, okay, yes. That's an implication, obviously, on the fee. But every bank has in-house lawyers. Those are available to assist the bank. Now, banks are also very good at documentation, procedures, and processes. So you can also have document-only arbitration, no oral representation, so that reduces the time. Every bank definitely has a document on everything. Your customer also has a document on everything, be it a loan application, be it a bank statement, be it a check, everything. So if you have a dispute, each party submits their documents to the arbitrator. All the documents that you feel are relevant, plead your case in writing, and leave it to the arbitrator to then sit and decide on the basis of the evidence before him what the award is going to be. So again, that's another way, a second way of reducing your costs. Having said that, even at international arbitration level, all these remedies are also available. And in fact, the ICE International Court of Arbitration, I had mentioned earlier, they have what we call, just using the English language, assessors, who go through the arbitral award, and they also give you timelines. Any arbitrator who is accredited by the International Court of Arbitration, you will have guidelines, and you will be monitored on how you are adhering to those guidelines. So unlike ad hoc arbitration, under institutional arbitration, there will be a check on how long you're taking to, to conclude on that particular arbitration. They also have limits on how many arbitrations each arbitrator can do simultaneously. So they tend to, spread out the arbitrations among different nationalities. They mix. If you have a dispute in Asia, you find the arbitrator is not from Asia. They tend they're cognizant of this kind of so-called public bias and opinion. So in those kind of areas, you'll find that arbitration can actually be very useful to the institutions. Thank you.
Thank you. I wonder if anyone else on this panel has anything to add to this, because we're taking some bashing here. So, Eunice?
I do. I certainly do. I have enjoyed listening to comments made, and I have just a few to make. Now, I would really be happy at the end of this if we are able to make Kenya and ensure that Kenya is seen as a hub for resolving international disputes, whether it's arbitration or mediation. Because now, as we all know, we have the Singapore Convention that makes enforcement of international mediation possible, okay? So now with that and with the institutions that we have, it is our duty to support them. The ICC rules can be used in any mediation, even here in Kenya, in Nairobi, and they are used world over. So it's about time we promoted Kenya as a center of excellence in arbitration. And just to take on my sister, Debbie, because she's truly my sister. When it comes to the question of arbitration being costly, for me, it's never a question of whether or not it is expensive. It's not. Because oftentimes you may wish to travel or to transport an arbitrator somewhere, and they'll be flexible if they know what the value proposition is. And you use the term value proposition because that's what actually is the result of a well-managed arbitration process. Now, who decides on who will resolve a dispute? If you sit in a bank, then you take some responsibility to the nature of the arbitrator that you choose. Sometimes you choose someone merely because they are called senior counsel, or you choose someone simply because they have 30 years of experience in one thing or the other. That is absolutely wrong. Arbitration allows you to pick someone with the requisite skills to resolve your dispute. So it's good to look for someone who has gone through training of arbitration, that they are able to manage time and the process effectively. When they manage the time effectively, then they bring down your costs. But you have the power under party autonomy to both hire an arbitrator and fire that arbitrator. I mean, it's only parties. You know, sometimes it's very interesting when parties come together to fire an arbitrator. You know, sometimes you find an arbitrator has been hired and soon they are charging maybe something exorbitant. You can agree among yourself. It's the only thing you can agree to fire that arbitrator because you have party autonomy. So when you're picking an arbitrator, be cautious. Look at that arbitrator, look at their CV, look at their experience, and pick someone like yours truly here who's able to effectively resolve your dispute in the time that is needed. Right. Now, in terms of our courts, you know now we have the commercial division under our judiciary, which is very effective and it supports arbitration process. So when you look at our jurisprudence, and we are coming up with a matrix, you find that our judiciary has really woken up and is very supportive of the arbitration process. And this is something that you need to market out there, that we are able to resolve international disputes right here. What about international panels? You can pick a French, Kenyan, in English arbitrator right here in Kenya to resolve your dispute. Tabitha, shall I stop there?
I think, you know, we would like you to continue and to just, you know, continue telling us about these, your arbitration services. But I think in the interest of time, I have two questions.
I want to continue on the issue of the cost.
Yes,
yes.
That's why I think I will stop there.
Yes. I'll allow Jackie, if you can take the floor.
Yes, I just wanted to, well, I know we've come under a lot of bashing from our colleagues here, and I don't want to break ranks with my fellow lawyers, but I think the challenge on costs actually arises from both sides. And it starts from the minute you write that arbitration agreement. Some of them are so difficult to even implement that we say that the clause is pathological. It has many, many challenges, almost like somebody who is in a serious medical condition. So I believe the first place to start is to make sure that the arbitration agreement says what the parties actually want. Just this week, I got a request to arbitrate a matter where there was a seat, there were two seats, one in London and one in Dubai. The cargo, because it related to goods that had been brought in, was in Mombasa, and it said that it was going to follow English law. So the first thing that we'll have to do is to sit and figure out whether it's possible to appoint me to that arbitration. So what that means is, like Deborah said, I will consider. Your lawyers will have to also give their submissions on that. At the end of the day, that means that we have spent time incurred costs, and we are not actually dealing with the issue that is required to be considered and the dispute that requires to be resolved. And then typically what happens and now I can now wear the hat of an arbitrator, the lawyers never agree. I don't understand why. These are some things that we can just agree on a letter, finish with that story, that cost is just going to be dealt with in the final timesheet as a letter, as opposed to we're talking about 3 weeks with time accumulated. You can also adopt rules that, limit the timelines. And what I wanted to add, because I know we've spoken about the ICC rules and the strict timelines, there is a provision which we have come up with in the CIAB arbitration rules of 2021 to allow you to fast track your arbitration. The fast track really only applies to matters that are below 10 million shillings, which means that if you bring yourself within the rules, then it means that you will pay a maximum of 500,000 for that arbitration. So I will request you to ask your legal counsel to familiarize themselves with the CIAB rules of 2021. It means that you just allow the matter to proceed on a basis of the documents that are available. You have all that. And when you start the whole process of, okay, give me your claim, give me a response, everybody has 7 days. I have 7 days to call you to come for that first meeting. You have 7 days to put in your statement. They have 7 days to do the reply. I have my 30 days to write an award if necessary, and we can also limit that. So let me challenge all of us to be, come together and work towards making the costs more friendly to the pocket for everybody concerned. Thanks.
Thank you, Jackie. So I think, Nikhil, if I can bring you here, because there are two things that have come out from what's just been said. The first thing is a pathological arbitration clause, and then the second thing is the fast track process under CIAB. And I believe in legal terms, we refer to that as expedited procedures. So what I would like to understand is now when you're drafting your arbitration clause or you're reviewing an arbitration clause that you've just received from your lawyers, what key features do you need to make sure you have in that clause to, even in the future, allow you to manage costs? So I don't know if you can comment on that.
Sure, thanks. The arbitration clause, I think I even saw it on the banner. It's the key starting point for any arbitration. It gives the arbitrator jurisdiction, and it determines how your arbitration is going to proceed. So we always tell clients, pay as much attention to the arbitration clause as you would to the arbitration when it takes place, because that will just lead to costs and pathological clauses. Now, there are two things. We always said that you can manage your arbitration by catering for X, Y, Z in the arbitration agreement. That's true, but at the same time, you don't want to put too much in there, because then you would be complicating the entire arbitration agreement and limiting yourself. So say, for example, we talked about, we can limit the costs by appointing an arbitrator from X institution. But at that point, you're not contemplating what the dispute would be. It could end up being a dispute for 10 times more what was actually considered. At that point, you would want to, get a formidable institution and formidable arbitrator. So just jumping right in, what are the key things to include? So I think everyone's aware, but there are two sort of sets of rules that you use. So in the court system, you have the civil procedure rules, and those govern, filing of a statement of claim, a defense, how a discovery takes place, all that. And in the arbitration, in institutional arbitration, like the CIAB or ICC, you have arbitration rules, and they contain all that information, right? How do you start the arbitration? How do you appoint an arbitrator if parties don't agree? So if you choose institutional arbitration, be familiar with all the relevant institutions. There's the CIAB, there's the NCIA, the international institutions like the ICC, LCIA. Those may come in if you have international transactions, right? Or financing arrangement in projects where the foreign party may say they want ICC arbitration in there. Secondly, you have what's called an ad hoc arbitration, and that's where you're not referring to any rules or an institution per se, but you could be referring to, for example, UNCITRAL rules, right? You could say there's no institution that's going to manage my arbitration, so there's no one that's going to monitor the whole arbitration process and provide that administrative service. We will handle the whole process, and we will use X rules, right? We will use the UNCITRAL rules, we'll use any other rules. So that's the first thing to put in your arbitration clause, right? Is it going to be, is the arbitration going to be institutional or ad hoc? Okay. Secondly is the seat of the arbitration. As I mentioned, the seat of the arbitration is, it's a legal term, and it deals with which court or which laws will govern the arbitration process, right? So which courts can you go to if you want interim remedies or if you want assistance in the arbitration? Those are the courts that will govern the arbitration process. So that's quite different from venue, by the way. You could say that the Kenyan, I'll have a Kenyan seat, so Kenyan courts and the Kenyan laws would apply to the arbitration process, but we want to have the venue being London, for example, for XYZ reason. So you'd want to include that. Thirdly, you'd need to consider arbitrators. Is it a big transaction, in which case you'd want 3 arbitrators? Is it a smaller transaction where you want 1 arbitrator? And you can say how that arbitrator is going to be appointed. So if it's 1, the parties can try and agree, and if they don't agree, for example, the ICC or CIRB can assist with appointing. So that's another important point. In finance transactions, let's look at a simple transaction of a loan agreement, where you have a loan agreement and say you have an arbitration clause, and then you have a separate guarantee, where you have the same arbitration clause. If you're dealing in those sort of related transactions, and it comes up a lot in finance transactions involving banks, just because of the number of agreements that are taking place, it may be prudent to consider consolidation and joinder. So, you must be aware in court, if you have that similar situation, you can simply tell the judge, I want this party who's the guarantor to join this case, right? I don't want to start a separate case. In arbitration, that's not automatic. So if you consider that many parties and many agreements consider joinder and consolidation and how you want to put that into the arbitration agreement. And then I think, as we've talked about earlier, there may be things that are quite unique to your transaction, right? So, addressing all of the issues of the time and cost involved, let's use the ICC rules as an example. Article 30 provides for an expedited procedure, right? So if you were to put the ICC as the rules governing your arbitration post, I believe it's 2020, if I'm not mistaken, you're automatically agreeing that you agree to the ICC expedited rules if the value of your claim is 2 to 3 million, right? The different scenarios and whether it's 2 to 3 million. If that's the case, then the arbitrator could say, actually, by agreeing to the rules, you agree to this expedited procedure, and we're going to use that expedited procedure. Now, what's the expedited procedure? It basically states that once an arbitrator is appointed, within 15 days he has a case management conference, you agree on how the arbitration is going to proceed. The arbitrator has discretion to say there's not going to be a hearing, there's going to be limited discovery, we're going to have a document-only arbitration, no submissions, and within 6 months from that date, we want award, right? And that the ICC court will make sure that that award is delivered within 6 months, right? So that deals with a number of issues that were arising, and you should know, even if you don't have that clause, or you're not, relying on the ICC rules, it's open to the parties to say, once the arbitration is started, you can agree that we want it done within X amount of time. Now, obviously, if you're the claimant, you would want that to happen. If you're the defendant, you want to make life difficult for everyone. So that, it's about avoiding those issues by taking into account all these things at the start in the arbitration agreement.
Thank you, Nikhil, for that. And I hope that some of us were taking notes, because some of these things you really have to think about them. They always say the arbitration clause is the midnight clause, and that's why people end up in the problems that we've just discussed. So I think we need to wind up. And if I can invite you, Deborah, to give us a parting shot now on this discussion. Perhaps you can comment on raising awareness on arbitration ADR within this specific sector.
Thank you, Tabitha. I think this is a good forum. This is a good start. I'm happy to see that there are more bankers in the room than there are lawyers. That means that we have demystified this animal called arbitration, and of course, by extension, ADR. And because from a banking perspective, you're the ones who own the business, you will spread this gospel, I can see you nodding your head. So when you calculate the cost of doing a transaction and you look into the possibility of a dispute, you'll also factor in that it can be resolved by, the alternative, process, which now we have demystified, which is arbitration. And now you know that there are ways of making it cheaper, making it less costly, making it more efficient, and making it timely. So in terms of looking ahead, I think we're in the right space because we are having this conversation. I think it's Miriti who mentioned that all along in the financial sector, we've always looked to litigation. The solution is I will sue you. When you think about it, if we disagree, what is my solution? I will sue you. But now that conversation is changing, and I think we all need to be champions of this kind of process, alternative dispute resolution. And so this is a good conversation that we are having. And as some of the people in the room, of course, we have decision makers in the room. So I know when I go to Mary, for instance, for approval, she will not send me back. I can see her smiling. She will not send me back with that arbitrator's fee, because she will have understood the value that we are giving to the bank. And the value being this will be resolved in a timely way, in a less costly way, and less costly does not always mean cheap. I learned that recently. Remember that less costly does not mean cheap, because cheap can be expensive, right? It just means that we are giving the institution value for the money that they are paying. Yeah, so thank you.
Thank you. I think we have one more comment from Kenneth.
Yes, thank you very much. As we wind up, I just want to share with the fellow bankers in this room a bit more information on arbitration. Especially, we discussed earlier today the SME sector. It would be good to know that you can arbitrate also small amounts. Arbitration is not only for the large corporate deals, even the small clients, the SME sector. In fact, arbitration will be very useful to them, provided that you have put an arbitration clause in your dealings with your customer. You cannot so-called drag somebody to arbitration or mediation. There has to have been either prior agreement in your documentation, or at the time of the dispute, both parties agree to go for arbitration. So I'd advise banks to now revise their policies and procedures and put arbitration clauses in all your documentation, account opening, your loan documents, your LPOs, and so on and so forth. We put in an arbitration clause, a simple, effective arbitration clause, so we don't put pathological clauses. If you'd like examples of those clauses, they are widely available from the institutions who practice arbitration. Another issue is that you can arbitrate any dispute that is of a non-criminal nature. So yes, criminal matters cannot be arbitrated. The lawyers will tell us. And I think land, isn't it? Yes. Yeah, she'll touch on that. So practically, apart from fraud in the banks, you can arbitrate all your other disputes with clients, your correspondent banks, and so on and so forth. Even HR disputes are arbitrable. You need not go to rush to the labor court as a first resort. So the scope is wide,
And there are a lot of benefits, again, like it was mentioned, confidentiality. A lot of clients and banks would not like to wash their dirty linen in public. So you can see all these benefits are there. Yesterday I was reading about a certain matter in arbitration which ended up in court. And now everything has spilled out. Yes, the arbitration was done in a huge amount for confidentiality, I can't name it. But if you read the Business Daily, I'm sure you've seen that matter which has ended up in arbitration. The arbitrator completed the process in about less than a year, I think 11 months, a dispute of about 700 million. And once he gave his award is what we call judgment, once he gave his award, just before execution, because an arbitration award is enforceable through the High Court. Just before enforcement, a bank comes in and says, no, this property you're arbitrating about, we have a charge on it. They were not party to the arbitration. So automatically, the matter goes to court. Now it is in the Supreme Court, 10 years later. The property in question, I do not know what state it's in. It's wasting away, so forth, but the arbitration, you can see, had completed his work and done everything. If all parties had been involved, perhaps that arbitrator would have dealt with all the matters at one sitting, in dispute. So you can see the beauty and the advantages of having an arbitration clause and going for arbitration. Lastly, there's also this example of the gunny bags. There's a company that was supplying jute bags, actually, and it was a government body. So when they supplied the jute bags, there was a dispute about the quantity and the price, and they were late and so on and so forth. So the government body refused to pay. The matter ended up in court. It was not too much. Jute bags are not too expensive, but there were 500,000 of them. But this order was the lifeblood of the client. By the time that matter was resolved in court 6 years later, the jute bags had rotten away, had been eaten by ants and so on and so forth. They had lost value. So either way, he still could not supply. So you see, it was a lose-lose situation there. Had parties gone for expedited arbitration, like we'd call it, where you have fixed timelines, fixed guidelines, and it's very predictable, some of these issues then would be avoided.
Yeah, so just a quick, I think, add-on to the comment about what can be and what cannot be arbitrated. We call this arbitrability. I think just as a rule of thumb, it's important to know that family matters cannot be arbitrated, neither can matters that are of a criminal nature. And then when you look at, what we can expect to come before you, okay, let me mention that criminal matters include sexual harassment claims, so that's not an employment issue. You can say that we can do HR matters and send them to arbitration, except sexual harassment matters. Other issues which have difficulties in getting arbitrated, even though they are subject to contract, are issues that are affected by insolvency, bankruptcies, winding up. So it's difficult to say that an arbitrator is going to sit over that because there is an aspect that needs to be handled by, I guess, what we call in our jurisdiction, the official receivers. So also labor relations, union matters, those ones are not arbitrated. However, they can be subjected to conciliation because that's what the Employment Act provides for. So other than that, many of the other matters and the ones that I've mentioned could be sent to mediation. And of course, a lot of the matters that you handle are subject to negotiation as well. But within the commercial space, it is important to exclude anything that would be affected by some of those issues that I have mentioned. So please keep that in mind also when you're thinking that let's now effect an arbitration agreement, in which case then you'll have to send it to court. And then in court, you might go and find the court annexed mediation program. Hadn't had a chance to speak about that, but that's a complete animal on its own that would require unpacking in more detail. But it is there, and it does affect any matter that is taken to court, whether commercial, family, labor. So you can expect to be called for mediation. So don't say that we're told that these matters are not taken to arbitration. And remember when I said that it's usual for many people to, use those two terms interchangeably. So I'm hoping that now that we are done, you appreciate the distinction and you're able to use it to make your workflow better, to serve your customers, and to make sure that we keep the wheels of business moving. Thanks.
Thank you. Thank you so much, Jacqueline. And I think we have to wind up. I think we can just thank our speakers and give them a round of applause, including Eunice, who's joining us online. Thank you so much, everyone, for making the time. I think we'll take questions at the end, but in any case, all of us here, including Eunice, you can always engage with us and obtain contact details through the Secretariat. So thank you very much.
Thank you so much, Tabitha and team. There are actually many questions. I've taken them down. I think I'll share them with you, so at least you can be able to address them. We have about 20 minutes to wrap up everything. There's another event for this evening. That's why you're seeing I'm trying to speed up the conversations for today. The rest, we can answer questions as we take tea. And at this point, just before I introduce the next speaker, I also want to acknowledge some of the organizations that we left out. We had SBM with us. We also had Chartered Institute of Arbitration. They are represented. And we have CalSTIC also with us today. So our next speaker, Mr. Tomasz Kobiak, is going to be taking us through the trade register. He's a policy manager with the International Chamber of Commerce. And Tomasz, I'm giving you 5 minutes and 1 minute to wrap up. Over to you, Tomasz.
Hello, everybody. Thank you very much. I will be very quick indeed. I just want to congratulate you to regarding the organization of this commission event. It's really appreciate all the different panels and discussions. So I'm going to quickly talk to you about the ICC trade register. I'm going to just quickly share my slides that you can see probably. Yes. So the ICC trade register is perhaps the biggest project that the ICC Banking Commission is running. It is first of all more than a 10 years project, and it's the goal of the trade register is actually to collect trade finance data on different products at really granular level in order to draw a picture of the low risk nature of trade finance. So this is this project started already in 2008, 2009 after the great financial crisis, and it's a consortium of several banks. We have today around more than 20 banks, major international banks, gathering together their data on an annual basis in order to draft a report, a yearly report. We are lucky to be cooperating with the Global Credit Data (GCD), which is a consortium and are driving really the data submission from those banks. And together also with the BCG, the Boston Consulting Group, we're able to draft and provide to the market our yearly report for now more than 10 years. So the data collected is short-term trade finance as well as medium-term export finance data, and it enables us to draw a data estimation on default rate, transaction exposure, and obligor level. What do we do with this data and this report? There's several uses. First of all, it builds a data collection and methodology. It manages to improve the analytical content of the report. We are aligning our data with the regulatory guidance of risk modeling, and we're enhancing the scope of different products, including supply chain finance. what do we achieved so far with the trade register? We managed to really showcase the low credit risk of trade finance products, including the credit conversion factor at 20% that is currently being negotiated at EU level. There's also different leverages and accounting clarification. I will just summarize. So we're currently in the data collection procedure currently, and we're hoping. There's key changes. We make sure that our 24 current bank are the easiest access to the data, and it's the process of submitting data is the easiest as possible for them. And we're trying to be to be as user friendly when it comes to the data submission. There's also a new business model that was developed last year, which will incentivize banks to join and contribute their data in order to grow the panel and the data that we currently have. It is estimated that we have, for the time being, around 30% of all the trade finance activity in the world. So the data in question are about various products, the import LCs, export LCs, performance guarantee, and supply chain finance as well. Quickly, what the trade register shows is that the low risk nature of trade finance, even though we could showcase last year that the COVID-19 crisis and well, the pandemic that we still living through had a slight modification in the data, but it remains overly low risk default. And you can see as well what I just mentioned, that there are different products that are showcased in the report on yearly basis, and we're trying to have also in time different figures. So quickly, I'll quickly wrap up as you mentioned earlier. What the trade register is really an unparalleled source measuring global risk in trade finance and export finance. It uses a rich data-driven approach, and both on short-term and medium long-term products. It is a relevant tool in order to discuss with regulators and have a conversation in order to shape relevant policies, and so they can have the most accurate data available at the time. Finally, I will perhaps just mention that we are always looking to onboard more banks. As I mentioned, we have 24 banks, but it's still not enough. We need to onboard more banks if we want to have a better quality report. If we have more granularity in the developments, in the assessment we're making, especially at regional level. We currently have 2 banks in Africa, but we would be really welcoming more banks in order to have a better idea of what are the particularities in every region of the world, including Africa. So my final message would perhaps be to encourage any bank, any Kenyan bank willing to participate to this data submission to contact the ICC Kenya to put me in contact with you, and we could see how we can concretely onboard your teams in order to submit data. The submission is a bit it's some work. It requires some work and time. It's an effort. It's not as easy as it just sounds, but it's worth the effort if we can in the end get a better data set and enable a relevant picture of what trade finance is at the given moment. So in a nutshell, that's what the trade register is. I'll just pass over the mic to the next speaker then. Thank you very much.
Thank you, Tomasz. Very good students. You've kept to time. and I think as bankers, you've had a call for us to register. I think it's a good thing. For us to tell our story as African banks, we need to really participate in this. And if you saw from the earlier presentation where we saw trade moved from documents used to be from Morocco, documents, now we are going to digitization. So for us to achieve that, we really need also to play our part as Tomasz has requested. And I think we'll work with the banks locally to ensure at least we provide that data. For ADR team, even as we take the next speaker, I want you just to note these two questions that came up. One was, what is the preferred mode of dispute resolution in the banking sector? So we'd want you just to break that, even as we go for tea after the last presentation. Then the other question was on what increases the cost of poorly drafted arbitration clause. Some agreements have identified Paris or London as the place of arbitration and select arbitrators from outside. Can we have other places, alternative places for arbitration? That's a question to you from the comments that we've received, so you'll be able to address that. I'm going to introduce our final speaker for today, and as we do that, technical team, probably you can put the video up. The final presentation is on SWIFT, and we are going to be taken through that by Sita Lango, who is the regional manager SWIFT for East Africa, and she has been in SWIFT and working in the region for 7 years. She has also worked for financial institutions specializing in customer relations and account management, which focus on ICT security solution. She holds a degree in technology for Middlesex University. So over to you, Sita, but I think even as you come, we can have the video play shortly. And again for you, 5 minutes. Sita, are you there? Oh, okay. I actually thought you're online. Sorry. That's what I'm wondering.
Code would like to present all this information in a single instruction, with a single payment setting the entire net amount outstanding. Using today's MT. Payments are entering a new era with ISO 20022, the new language for domestic payments and correspondent banking. And corporate customers are set to benefit thanks to the advanced reconciliation and treasury opportunities the new standard makes possible. Let's take an example. Coffee Co. is a boutique importer, roaster, and distributor of coffee beans based in London. Coffee Co.'s supplier in Indonesia has asked to be paid in US dollars to its local account. Coffee Co. is happy to do this, and to make life easier, has agreed with its supplier to aggregate multiple invoices into a single payment. The batch of invoices to be paid includes one invoice that is not correct and needs adjustment, and a credit note from a previous transaction that needs to be reconciled. Coffee Co. would like to present all this information in a single instruction, with a single payment setting the entire net amount outstanding. Using today's MT standard, they would not be able to do that. There is not enough room in the remittance field to describe all that is needed in a structured way that can be automatically processed. With an ISO 20022-based instruction, though CopyCo can pay all outstanding invoices, apply a credit note and contest a line item on an invoice. A single payment can describe multiple rich and structured elements, including dedicated fields to differentiate between commercial invoices, credit notes, and invoices that need adjustment. Declare local purpose codes required to report to the Indonesian regulator. Uniquely identify invoices in the buyer's ERP for easier reconciliation, and, in cases of dispute, the amount to be adjusted and reason for adjustment. All parties in the payment chain know exactly what is being paid and settled, and there is no need for a single phone call or email. All this information can be reconciled and immediately posted to CopyCo and its supplier's ERP system, significantly driving supply chain and working capital efficiency. Corporates are ready, and with the adoption of ISO 20022 in correspondent banking and all major reserve currencies, end-to-end payments will be rich and structured, enabling the next generation of treasury services and a new era for corporate payments. ISO 20022. Quality data means quality payments.
Thank you so much for that. I was expecting some more vibrant. There you go. Thank you so much. So as you have been told, my name is Sita Lango, and I represent SWIFT in the East African region. With me, I have my colleague, Amani. Amani will just wave. Amani is a senior technical expert based in Nairobi, taking care of East Africa and the Middle East. So thank you so much for inviting us for this session. And one of the key reasons why we are here is basically ISO 20022. So as much as I like seeing my face on the screen, I'll kindly request us to put the slides, if that's possible, please. Okay, I can talk over what I know is supposed to be on the slide. So ISO 20022. So how many of us know SWIFT? I know we have bankers here and we have lawyers, but how many of us know what SWIFT is about? You do. So I can assume almost everybody here knows SWIFT, so no need for background. But I'm going to give us a brief background on the messaging, because that's where ISO 20022 touches on. So in the early 1970s, for banks to exchange instructions between each other and across regions, they use telex. Who was there during those period? I'm sure. Oh, come on, really? Sure. No, you aren't. You don't look. No. So yeah, and I know that the challenge. No, you aren't. You look like you are. I don't believe you. So I know that some of the challenges. I don't doubt you. I know you're a lawyer, so I don't want to offend you. I don't doubt you. So I know some of the challenges that banks experienced was, of course, the language barrier across regions. Of course, the message, you could put some instructions in a message which meant different things to different people. It could be the same language, the security challenges, and of course, the issue of delays and time taken to exchange these messages. And that's when SWIFT came to be with the network. Now, one of the things that SWIFT came with is the network and the standards. So the standards that SWIFT has been using since the 70s is the MT standards. These are structured messages that are very restricted in terms of what can be put in this message. They're universally recognized with different message types that have different functions. So I'm sure as bankers, you understand very well how these messages work. However, there were some limitations with these messages because, as we said, they were extremely limiting because they are proprietary messages, proprietary to SWIFT, and so they're extremely limiting, not just in what you could put in these messages, but also in terms of how they can interoperate with other systems within the network. So with MT, you could only use it with SWIFT messages and not with other message platform. Now, the reason why we are moving away from MT to ISO, which is, of course, SWIFT is the custodian of these messages, the MT, but with ISO, it is more open, more structured, with a lot of information that are put in this message. I had a very interesting slide. I don't know why the technical people don't want to put my beautiful slides up. They would accompany what I'm saying, but I'll try as much as possible to be detailed in what I'm saying so that at least we can picture, because the time is also limiting, so I'll not wait for the slides. But with the ISO 20022 messages, one of the things that we are trying to achieve is to help financial institutions be able to use this message format with other systems. They can interoperate with other systems. This makes it easier for reconciliation of messages because you can be able to use it with multiple systems within your environment. The other thing that we are cautious about and we are very, very passionate about is screening for sanctions, because we know that the message that is within the MT is very, very limiting, as you have said. Okay, not very, very, but let's use the word very limiting in terms of the content of what you can put in the message. With ISO, you can put as much information as possible and as much detail as possible within the message. Now, for those of us who know the compliance as far as screening is concerned, you know that the more information you have, the more details that will be screened. Because when the information is limited, that means information that should have been screened and should have raised an alert might come through secondary channels, meaning they will not be screened, you know? And so with ISO, a lot of information is put in and it's screened. And so from end to end, you're able to screen your message and to reconcile the details within the message. So that is where we're migrating to. I know for those of you who have worked with us through this journey, you know in 2017, we introduced the unique reference number within the message, the empty message, which is also migrating in the ISO format. Now, the reason for that unique reference identifier, and I'm making assumptions here that we all understand what I'm talking about, so please forgive me for that. But with the unique identifier, you are able to not only track your messages as it goes through the different institutions, but you are also able to track if there are any charges that are deducted. You are able to track the time taken for the message to go from one point to the other. Now, some of the issues that we have with visibility and traceability is the fact that as soon as the message leaves Bank A, you lose visibility of that message, and so you are not able to communicate to your customer where the message is. And sometimes you call your correspondent bank, and they tell you they already released the message and someone is just sitting with the message there. You have no way of proving it. And so with the introduction of the unique reference number within the message standards, we are able to help banks track, have that visibility from end to end. And this is what is provided using the GPI tracker. And that's something that we are working with this journey as we move into the ISO 20022 world. So the concept of SWIFT, or the strategy of SWIFT, is to provide frictionless payment. So that is what we are trying to do with the introduction of visibility and introduction of ISO 20022. We are trying to make it as smooth as possible for banks to be able, and also organizations, because we have to connect banks, we connect corporates, and we also connect the securities market. So we are trying to provide the smooth the smooth transfer of messages from institution to institution, enriching the data to help banks store as much information as possible within a single message. Have I delivered value in what I've said? I'm glad, because I'm going to stop there. I'm really trying to think about what I had in my slides so that I can be able to cover as much as possible on the detail, but I think in high level, that is what our structure, our payment strategy is. Amani, would you like to add anything? Thank you. Thank you guys for your time.
Thank you very much. And probably what you needed to say is, what do we need to do, or when do you get into, are we ready to go live? Can we plug in? For the bankers, when are we expected to be live on this new platform? I think that is very key.
Thank you. I honestly made an assumption that this is not the forum for that. And I remember we discussed it with my colleagues and my colleague, and we said this is not the forum for that. However, I'm glad to respond to that. So with the ISO 20022 migration, we are going live in November 2022 this year. So it's 2022. So it's quite, You see, it's quite unique here for us to migrate to the new standards. So we have what is called the transaction management platform. So with the transaction management platform, this is an additional layer. So all these will be carried through the TMP, what we call the TMP, the transaction management platform, is the new layer in which we are migrating towards, which will be carrying these messages, and banks will be able to access these messages, not only using FIN, but also using APIs, using the transaction management platform. And to achieve the frictionless payment structure, we are also going to be enriching these messages, screening these messages, so in transit, to ensure that banks save time. And so because some of the issues that arise that causes delays for message in transit is information about the message could be wrong. Maybe the account details is not correct, the IBAN, the BIC information is not correct. So we are introducing pre-validation, where banks can be able to pre-validate details of a particular payment before they release the payment from the environment using APIs, so they can do a quick query pertaining to any particular message before they release it. We are introducing case resolutions, which can help banks be able to resolve issues where they cannot be able to trace a particular payment and they cannot get feedback on this. So instantly they can be able to trace a message and they can be able to search details about a message. So this is an entire ecosystem which you are migrating towards, and the entire strategy is to achieve frictionless payment. Did I answer the question?
Thank you very much. I think we've all noted down, and we'll be working closely with yourselves, at least to ensure there is seamless transition to the new platform. I mean, it's good news to hear that we are moving from what we had from 70s to something in 2022. So it's really a good year for us. So we've come to the close of the program, and Leod, I hope you've kept time. I was under strict instructions to ensure that we finish by 5, and I believe we've delivered that. And with that, I wanted also to acknowledge the steering committee of ICC Banking Commission, the members of that committee in the room. You can stand. I think you've done a great job. And you stand. Leod, you are the convener of this committee. You can be seated. I know you've done quite some work in a very, very short time to have the kind of turnout that we've seen, and also to have the material and the content that we've seen today. I think next time we will listen to you. I think you had suggested for 2 days. I think we really squeezed the program towards the end. But we'll make sure at least next time we've learned from this, and we'll be able to create more time to ensure that we discuss and engage on some of these issues very well. I'll also want to thank our partners, ICC Kenya, KEPSA, KBA, UBA, NCBA, and Spire Bank. I think the support we've seen from yourselves has really enabled us deliver the conference today, and we also urge more members to join us. We need more hands to be able to deliver this. Today's topics, I think, have been very, very engaging, and I believe most of you have now understood what ICC is in general, what commissions are there, what has already been launched in Kenya, what is in store, and where you can actually play. We need many people to play in some of these commissions. And if you look at even the discussions that are going now, US, Kenya, free trade agreements, they're also touching in line the same topics that we are looking at. So it would be very good to see more people coming on board to enable the launch of most of these charters and commissions to drive that agenda for the country and the continent at large. On sustainable finance, very new topic, but again, if you don't carry anything else, but you can remember, even as you look at any transaction, looking at the key 5 players that were highlighted, the seller, the buyer, the goods or services, the transportation model, the purpose. So at least you're able to define, are you playing in that space of sustainable finance? Moving to access to trade and finance, I believe we had a very engaging discussion. Again, looking at the continent and Africa, and seeing that SMEs control between 80 to 90% of the businesses And we as financial institutions need to look at ways of how do we support these entities. Getting innovative, calling for innovation, not asking for securities, but looking at the transactions themselves, the underlying transactions, and seeing how do we support these businesses within this space that really, really need our support. On compliance, we looked at compliance in terms of how do you identify issues of AML, compliance, even as you deal documents from where you sit. It shouldn't only be the work of the compliance team, but the front side as well, even as we engage the customers, looking at what transactions and documents that they've already given you, do they conform to what they are doing? Do they conform in terms of pricing, in terms of the source, to ensure that we don't get into trouble with the regulators and that. On the ADR, I think my key take out there was on appropriate dispute resolution, not alternative. And although the debate would have gone on and on, understanding from where we sit as banks and defining very well what our output is and the timelines that we are looking at in terms of delivering the resolutions that we are looking at. And also ensuring that we have representatives that understand the subject matter on the same. On the trade register, Tomashk has made a very good ask for us as bankers to be able to sign up into that as we move to digitization to ensure at least we have the information that we need on that. And lastly, on SWIFT, CITA has made a very great appeal and also notified us about the launch of the new ISO 20022 that will be coming into November, and I think that calls for us to be ready in terms of migrating to the new platform to be able to achieve some of the efficiencies that we are looking at in the banking sector. And with that, I would like to bring the conference to a close. We'll be engaging with you, and just to thank everybody, both online, the speakers that really did a lot of work in terms of researching the various topics that we gave them in a very short time. The secretariats, I think they've done a very amazing team. And for all of you in this room, I think we've seen a very engaging session with yourselves, and we'll continue as we take our tea. So I'd like to wish you a lovely evening and a nice weekend. Thank you very much.